and Massorange have held informal talks on a potential deal for Vodafone Spain, and this morning Telefonica hiring AZ Capital to analyse that potential deal. We've also had the WPP CEO Mark Reed announcing his retirement, so we'll keep an eye on all of those stocks when we get the open, Guy.
Okay, let's pay attention to what is happening with this open Monday morning. Does it give us a sense of direction? I'm not sure it's really going to give us much of a sense of direction. So markets are open. The opening trade is upon us. FTSE 100 doing absolutely nothing, going nowhere in a hurry. We were expecting this market maybe to pop a little bit higher, 0.2%. Not really anything that you can hang your hat on, though. And what you're seeing basically is an incredibly flat open. As I say, it is Whit Monday, so there are kind of holidays to factor into your thinking as well. The Stock 600 flat as a pancake, no action there. We'll see how long it takes the CAC and the DAX to get open. Feels like a very sleepy start to a big week coming up with some massive auctions that we need to be watching out for. We've got trade talks taking place in London between China and the United States to factor into our thinking as well. CAC opens down 0.1%. DAX opens down by 0.3%. The Dutch market down by 0.2%. But I think the market is sitting, waiting for those catalysts, Lizzie, maybe to emerge midweek, and there's a lot of them before we get a clear sense of direction, certainly emerging for equities, which at least globally sit at elevated levels, you could argue.
Yeah, so let's break it down by sector across the European continent. We've got about half of sectors in the green this morning. Travel and leisure at the moment leading the gains, but it's only up about 0.4%. Basic resources just stealing the lead, about the same amount up as well. Bottom of the basket, though, you've got tech down 0.5%, autos and parts as well in the losers category this morning. Just a couple of those names that I was mentioning earlier. We've got WPP shares down 0.7% after we had the announcement that the CEO Mark Reed's looking to retire, and they're looking for a successor now. This, of course, one of the world's biggest advertising agency groups. I also mentioned Alpha Wave because we've got Qualcomm agreeing to buy Alpha Wave for $2.4 billion in cash. Alpha Wave shares up 2.9% at the open, so embracing that deal, it would appear.
Let's just kind of pick up on that and think about what is happening there. What does it take to get the London market moving? FTSE 100 is underperforming, continues to underperform. It's up on the year, but in a week we've got London Tech Week coming up, when we're kind of focusing on London, trying to figure out what is happening. Trade talks are happening here. What is it going to take to get the London equity market moving right now? Because it doesn't feel like it's the big focus. The Labour government is making some changes, but are we going to see enough of the kind of the regulatory unleashing that they talked about a couple of months ago in order to get the market moving?
I mean, you could argue that they haven't been radical enough when it comes to getting growth, right? They had 14 years in opposition to come up with a blueprint, some big ideas, and yet so far we just haven't seen that kind of growth that they promised was going to fund infrastructure investment in the UK. We've got the industrial strategy now having been postponed.
Yeah.
It was going to be on the same day as the spending review. It's now going to come at the end of June. We're waiting for big ideas from this government.
Absolutely. Well, let's try and figure out where those big ideas come from. Sharon Bell, Senior European Equity Strategist at Goldman Sachs, joining us around the table. So Alpha Wave, like another delisting, another stock leaving London. The London market's had an okay performance so far this year, but it's underperforming. What does it take to get this market moving? Should investors be looking at it and saying, actually, here is a heavily discounted market still that I can invest in?
Yeah, absolutely. I mean, it's underperformed the rest of Europe largely.
Yep.
Obviously, Germany, the DAX has done extremely well with a big fiscal spend. But of course, the UK government doesn't really have that option. You can't really do a large fiscal spend at the moment when you've got such a tight budget. And I think that the big issue for the UK stock market, though, is not so much economic growth in the UK, it's more the lack of domestic investors that want to put their money into risk assets like equity.
Yeah.
Many years ago, pension funds, insurance companies used to be the big buyers of UK equities, and now that's not the case.
In Europe, we're starting to see European investors taking their money out of the States and bringing it back to Europe. Why is it not? It's not happening here.
It's not happening here. So in the case of Europe, I would say absolutely. I mean, European investors have spent the last 15 years taking money out of Europe and putting it in the US. But the last few months, absolutely right, they've been doing the reverse. They've been going back domestically into Europe with that better catalyst that you're getting from more fiscal spend in Germany. We're not seeing that in the UK. We're not seeing UK domestic investors come back to the UK market. It's really actually, I mean, the UK market's also been bought this year, but it's been foreign investors actually that have seen the value in UK stocks rather than domestic buyers.
Yeah.
I was speaking to the Chancellor last month and she said never say never when it comes to mandating pension funds to invest in UK assets. And then we had the announcement that the UK does actually plan to require pension funds to invest in private markets and the domestic economy. Do you think that actually mandation puts people off? That it has the opposite effect? If you've got to mandate it can't be that good.
Yeah, I mean, I understand exactly what you mean. You need to get... I find that the markets globally that have the highest valuations are the ones with what I would describe as the most domestic buyers and domestic bid and domestic ownership. And the UK used to be in that situation and no longer is. And it's a little bit of a chicken and egg situation. If you don't have those domestic buyers, you don't have the good growth stocks that want to list, that expect to get a good high valuation. And then if you don't get those list, then equally domestic investors don't want to invest there because they think, well, there's no good growth stocks. So it really is trying to remove the UK from that vicious cycle, but it's quite difficult to do so.
So maybe the catalyst comes from the White House. I was interested in your notes to see that you're saying Section 899 could encourage UK corporates to consider relisting in the US. Sorry, it's the other way around. That could even make it even worse.
I think it's a combination of things. So Section 899. If you're 50% or more US owned, then you shouldn't be subject to the extra taxation. Therefore, how can you get yourself 50% or more US owned? Go stateside in terms of your listing is an obvious way to do so. Although there are many listed UK companies which are already skirting that 50% anyway, could easily get there even without relisting. But I think the other thing that Section 899 does is if I am a European or UK investor and I am worried about my dividends when I invest in the S&P being taxed more because I'm a European individual and I might be subject to this Section 899 tax, I might decide actually it's not worth it and I'm going to invest more in Europe or the UK. So I think there are two things here. One is what the corporates do, and if you're a substantial business with a big US presence, you might want to relist, or you might want to up that US shareholder base. Alternatively, you're an actual domestic investor in Europe, and you invest in the US, then actually you're worried about my dividends being taxed a bit more, and that makes Europe look a bit more friendly as a place to invest in.
You talk to a lot of investors. Where are their heads right now on this? Are they just waiting to see what happens in terms of the legislation?
Yeah, I mean, their heads, obviously, it's a huge week this week, as you point out, loads of macro data points. The key thing, I think, for investors at the moment is a potential trade deal or not between US and China, and also US and Europe as well. We haven't yet signed a trade deal there. So, those things, super uncertain still.
In terms of where equity markets are, though, the S&P's at 6,000. I find it amazing, given all of the tail risk that exists right now, but equity markets in the States continue to do very well. And I'm wondering we get to the point where actually European investors just have to look again at what is happening and have to get pulled back into that narrative.
Yeah, do you not have FOMO over the summer? If the S&P keeps going up, you don't want to miss out on this.
No, you don't. I mean, look, to be clear, though, Europe has still outperformed the US
by a long way.
By quite some way. So it's not as if we need worry about that right now. I think the US is having a little bit of a catch-up. That's fair enough. I do agree, though, US back up at 6,000. Given all the risks around, that seems like quite a quick move upwards. And we think if you look at, say, beneath the surface, cyclicals versus defensives, they seem to be pricing to us about a pace of economic growth in the US around 2%, which is high, considering all the risks at the moment, considering all the data that we're getting. Even with those slightly better payroll figures last week, we've still got very weak survey data. ISM, manufacturing services has been weak recently. So I think growth pace in the US is probably more like 1.5%. if that's the case, then the market's slightly overpricing at the moment.
But you've got the July 9th deadline. All sorts of trade deals could be done before then and push it even higher stateside. As I say, surely what you want is just to be in on that action, not sitting on the sidelines.
Yeah, although there are risks. You've seen the volatility. I mean, we talk about the market having recovered the Sharpe ratio this year. So if you look at performance divided by volatility, it hasn't been fantastic return at all in US equity. And at the moment, of course, you can get a good yield on US Treasuries. You can get a good yield on cash.
Everything yields the same as far as I can tell.
We're seeing money market flows very, very strong,
yeah.
which you can view either way. You can say, well, actually, that means investors are going into other safer forms of investment. Or you can view it as, wow, there's this huge embedded amount of cash, which is on the sidelines, as people might say, that could re-engage in the equity market if they see risks come down. But, risks are still very high, and we haven't yet seen the economic damage, not properly, of this trade uncertainty.
But everything does yield the same. I'm getting basically the same yield on equities as I'm getting in bonds, as I'm getting in money market funds.
But equities are riskier.
I agree. In theory, equities and credit should be riskier, but they're all kind of delivering the same number at the moment. The differentiator appears to be currency, which I find amazing.
That's a fair point, yes. That's a very fair point.
And I'm just wondering if the euro continues to appreciate from here, this is the question I keep asking, because the numbers are just amazing. The S&P is it's at 6,000 and it's up 2% in dollar terms, but it's still down by 7.5% in euro terms. If the euro keeps appreciating, does that just encourage European investors to bring money home?
Ironically, because I think there is this expectation that if you've got your currencies rising, that's bad for your companies, particularly as European listed companies are very international, they make a lot of dollars. Yeah. So you might see actually the second quarter earnings season be hit a little bit by that sort of translation effect. You're making a lot of dollars, you're translating that back into sterling or to euros or to other European currencies, and they've all gone up. But yet, as an investor, a lot of European investors, when they invest in the US, invest unhedged, because that's absolutely been the right thing in the last 10, 15 years. You want to invest in the S&P and you want to invest unhedged because actually the dollar has gone up, and now both of those things have not happened this year.
Talking of euro strength, though this isn't necessarily what's driving it, if the ECB doesn't cut again this year, how much does that hold back European equities? Or does it, if it's actually a growth story?
Yeah, I don't think... No, my view is it wouldn't. We do actually expect... I know there was a slightly more hawkish ECB meeting. We do still expect the ECB to cut. We expect them to cut now in September. We had previously expected July. So, yes, we pushed that out. And it's become a lot less certain, I agree, with all of that. But I think if they don't cut, it will be because of better economic growth. And that will be, on balance, much better for equity.
Good news is good news. All right, Sharon Bell, lovely to see you. Senior European Equity Strategist over at Goldman Sachs. Sharon Bell, always a pleasure. Well, let's check on some of the individual stocks that are on the move at the open. Joe Easton is here with those. Joe.
So we have got a big move in Alpha Wave today, giving us some excitement on what is pretty much a quiet Monday. But this one getting a takeover bid from Qualcomm in the US worth a couple of $2 billion. Now this, as we said earlier, is a company that makes the communication systems and the semiconductor materials all linked in to the semiconductor space. A supplier really to the sector is what Alpha Wave is, and it's listed in London. Went public back in 2021, was part of the big cohort of London IPOs in 2021 that has actually underperformed. So the stock IPO'd at around 400 pence 4 years ago, now coming up today to 181, the bid price at 183, so a big move up, a big move higher in terms of the gain today, but over the longer term really suffered in terms of the returns on that one. But Alpha Wave really the big mover today. Then we have got the telecom space in the radar as well, that news of a potential deal for Vodafone Spain, Telefonica and Massa Orange, the unit of Orange or the part-owned company, looking at that business. That is owned by Zegona Communications, only actually seeing around a 2% gain in that one at the moment. Telefonica not really giving us much to cheer about at all. We've got a big unch on that one, so no movement on that one, but Zegona a little bit higher, so potentially feeding through. Then WPP in spending ad space, of course, Mark Reed stepping down after 7 years at the helm of one of the world's largest advertising companies, coming as a bit of a surprise, judging by that share price. So seeing a bit of weakness. They have been trying to turn it around in terms of a decline in advertising spend, particularly by the tech companies. So this potentially just more uncertainty for WPP, with Mark Reed standing down. So that one is down at 1.4% here in London today. Then I had my eye on defence, because actually I was looking more at luxury following the China data, but defence really the weakest sector today. Now, traders were reminding me that some of this is a bit of a catch-up play, because Sweden was closed on Friday, so Saab coming down almost 5%, catching up with declines on Friday. We did have a note out from Deutsche Bank saying that all the positivity on defence spend possibly priced into the market. So actually we saw weakness on Friday, kind of catching up. But we are seeing Hensoldt in Germany, Dassault in France also lower, BAE a little bit as well. So that's really the weak sector for me today. And then finally in Germany, there was a little bit of a move lower in Fresenius. They are facing a recall of one of their devices that is used for transmitting medication to patients in hospitals. The US FDA recalling it on the highest level of recall, saying potentially could actually be a little bit dangerous. So that is recalled. Fresenius was called a bit lower. It's only down 0.1%. Pretty quiet market in terms of the movers, but Fresenius a little bit lower in Germany this morning.
Joe, great stuff. Thank you very much indeed. Paris Air Show this time next week. The defence stocks will be firmly in focus as we all gather at Le Bourget. Joe Easton joining us on all the equities we're watching this morning. Up next, we're going to talk a little bit more about what is happening with the European equity story. Got a little bit more banking activity. Portugal's fourth biggest lender, Novo Banco, attracting bids from BPCE and CaixaBank. We're going to discuss what the acquisition would mean for cross-border banking deals in Europe, even in the Iberian Peninsula. That's what's next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session, and equities not doing much. The Stoxx 600 weaker 0.1%. So let's dive into a particular sector where there is some action happening, and that is banking. Bloomberg has learned Lone Star's Portuguese lender Novo Banco has attracted 2 bids from French banking group BPCE and CaixaBank of Spain. A preliminary decision on a winning bidder or taking the IPO route is possible as early as this week. So let's get more on this. We're joined by our Portugal Bureau Chief, João Lima. João, just tell us what's coming next in this sale process then.
Hi, Lizzie. So basically, there's various options open, as you mentioned. We've reported that there were 2 bids received, BPC and CaixaBank of Spain. And then there's also the IPO, the possible IPO. And what we've reported in the past, the Novo Banco CEO has said that Lone Star will likely want to keep all options open, as further down the process as possible. So we're expecting this will take, we don't know exactly. We reported that the decision could come as early as this week, but at the moment that's where things stand. All options open in terms of the 2 bids and the IPO as an option also. Just to give you an idea of size, JB Capital said in March that Novo Banco could be valued at between 5.5 billion and 7 billion euros.
Let's talk about the significance of this and what it would mean for Portugal, what it would mean for Europe, like a cross-border deal. We haven't seen many of those.
Right, for Portugal, this bank comes with a lot of history. It used to be Portugal's biggest publicly traded bank, Banco Espírito Santo, which was then rescued and broken up, and that's what led to the formation of Novo Banco about a decade ago. So if Lone Star decides to go for the IPO option, and for Portugal particularly, this will be significant. It'll be Portugal's first major IPO in 4 years and the biggest since 2008. So it'll be definitely a big mark in terms of IPOs. Looking more broadly, across Europe, as you've mentioned, governments in the region have tried to hamper deals recently, both within borders, like Spain opposing the takeover of Sabadell by BBVA, in Italy also, and then Germany, as you know, has said it's against the potential acquisition of Commerzbank by UniCredit. So if this goes ahead, it'll be an important mark. If BPC or CaixaBank get to buy Novo Banco, it'll be an important mark in terms of cross-border deals in Europe. In Portugal, the finance minister has said that Spanish banks shouldn't further increase their presence in the country. That obviously singles out CaixaBank, which already has a unit here. But it's not a position against takeovers per se. He's mentioned specifically being against the Spanish banks further increasing their presence by acquiring Novo Banco. So yeah, if this deal does go ahead, it'll be an important mark in Portugal and across Europe.
João, great stuff. Thank you very much indeed. Portugal's Bureau Chief here at Bloomberg, João Lima, joining us from Lisbon. Let's kind of talk about, I broaden the lens, figure out what is happening with the euro. I'm not sure how you quite make this connection, but we're going to do it anyway. Valerie's here to talk about the euro. We're at 114. Okay, so let's just talk about the kind of context of where we are.
Up 12%.
We're up 12%. The dollar is on the back foot, yet US assets are doing relatively well. I kind of pull this all together. People at the ECB are talking about this being the kind of the euro's moments. Yeah. Valerie smirks and smiles. How big a shift would it require to take some of the halo?
We just heard from our reporter there in Portugal, João, talking about how complicated it's been for European banking consolidation. And if the euro really does want to be, compete with the dollar in terms of a dominant player for a reserve currency, it needs deeper capital markets and it needs a more liquid bond market. Joint issuance. That was another thing that ECB Schnabel brought up this weekend. If they really do want to capture this window of opportunity, deeper bond markets and a more consolidated banking playground is really something that's going to need to draw more foreign capital into Europe.
So there's work to do in Europe. Meanwhile, S&P E-minis now over the 6,000 level. It's remarkable, really, as we're constantly debating, Val, that the stocks, US stock rebound continues. Of course, we had the payrolls data on Friday, but when you're looking at what's on the docket for this week, what could dent that rally?
I do think a lot of it is down to these China-U.S. talks going on today in London. I think that for the market to really trade strongly off of this, there needs to be some sort of hint that this meeting is laying the groundwork for a Trump visit to China. We haven't even heard a confirmation from China that Trump was actually invited to China, something he claimed after they had a phone call, 90-minute phone call last week. So that's a really key thing for the markets. Again, we do have a lot of other things to contend with. The bond auction on Thursday will be a big one. Not only we also get CPI as well. You know, the market might overreact to any small hint of goods inflation coming out of CPI. But we also have to keep, you know, the labor market in mind. Friday's payroll report, you know, really surpassed people's expectations. Immigration really does play into that in terms of keeping the unemployment rate at a steady level. We know that deportations have been happening. That really will cause maybe some labor market tightness and might be the thing that could postpone those Fed rate cuts. Many people think that it's the unemployment rate that needs to tick up in order to invite those Fed cuts in this face of tariff-induced inflation that they're worried about.
Okay, Valerie, we thank you. Bloomberg's Valerie Teitel there. And I want to pick up on that immigration theme because the tensions in Los Angeles have escalated over the weekend amid these protests sparked by sweeping U.S. immigration raids with fresh clashes between law enforcement and demonstrators. You can see them now. President Trump and California's Governor Gavin Newsom are trading barbs over Trump's deployment of the National Guard. Newsom calling the action a serious breach and demanding Trump rescind the order, and Trump defending the move.
We're going to have troops everywhere. We're not going to let this happen to our country. We're not going to let our country be torn apart like it was under Biden and his auto pen.
What's the bar for sending Marines?
The bar is what I think it is. I mean, if we see danger to our country and to our citizens, we'll be very, very strong in terms of law and order. It's about law and order.
What we're seeing in L.A. is chaos caused by the administration. People should exercise their right to protest. That's their First Amendment right. But people should also exercise that right peacefully. We do not want to play into the administration's hands.
For more, let's talk to Bloomberg senior editor Bill Ferries. Bill, you heard from the president there threatening to send in the Marines. Just talk us through the legality of all this. He's already sent in the National Guard. It's the first time since 1965 as presidents deployed the National Guard without being asked by the governor first. Just bring us up to speed on the latest.
Yeah, I mean, as you pointed out there, the White House says it authorized the deployment of 2,000 National Guard troops to Los Angeles and California. It sounds like only about 300 of those have been deployed so far. It is a highly unusual move. The last time we really saw it was during the civil rights era when state governors were opposing the reintegration or the integration of schools there, and the White House stepped in. Talking about having the Marines go in would be even more unusual. There's a U.S. law from the 19th century, the late 1800s, that basically bars the deployment of the U.S. military on American territory against its own citizens. So I don't know that we've ever seen anything like that, and I don't know that we will this time, but I think the rhetoric really shows where things are going, and we've seen protests get more violent later in the day, and that's where people are trying to see if they can de-escalate somehow this situation that's become more tense.
Bill, great stuff. Thank you for the update. We'll look forward to what happens a little bit later. Bill Ferris on what is happening in LA. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The opening trade. We're 30 minutes into today's session. As you can see, it's red across the screen for European equities so far. We're waiting for those US-China trade talks taking place in London today. Particular underperformance, as you can see, for the DAX in Frankfurt. And if you look at it on a sectoral basis, tech is the bottom of the basket this morning, down 0.5%. And that is where we're going to go to next. The UK Prime Minister Keir Starmer is set to appear alongside the NVIDIA co-founder, Jensen Huang, at London Tech Week today. They're going to mark an agreement in which NVIDIA helps the UK train more people in AI and expands research at universities. Across it all is Tom McKenzie, who's at the event for us. Tom, just talk us through what to expect from London Tech Week. Really, it seems quite the feat that Keir Starmer's secured this sit-down with Jensen Huang.
Certainly this is a feather in a cap for the Prime Minister Keir Starmer, who, as you say, will be joined on stage at around 9:05 UK time, so we're counting down to that. At the stage just behind me here in Olympia, of course, in West London. And we're expecting to hear some announcements around NVIDIA's commitment to the UK market, whether it's training up people for that AI revolution over the next 5 to 10 years, whether it's committing more money to their R&D centre. But we're going to be hearing from other executives as well, other teams globally who are coming here to London to double down on what the government hopes will be that AI shift that can power and lead to growth that, of course, they are so desperate to see. And it comes at a time, of course, when they're putting more money aside for science, technology and innovation, something that I've been speaking to people on the ground who have broadly welcomed. There's a lot more that needs to be done, of course, when you think about the capital markets, when you think about scale capital, seed capital to get companies started up, not such a problem here in the UK, but it's that growth and that scale funding that's so important. So yes, we're going to be listening to whatever Jensen Huang has to say. He then goes off to Paris, interestingly, so there's a bit of rivalry between Paris and London. He's going to be at Viva Tech there as well, so we're watching for that. And then towards the end of the week, Founders Forum. But let's get to our guest right now, somebody who's very well placed to talk about some of these themes, really with a finger on pulse in terms of the venture capital and the fund flows. And that's Erin Platts, the CEO of Octopus Ventures. Erin, thank you for joining us here, of course, at London Tech Week. What are you seeing in terms of fund flows into AI here in the UK? How strong is that? How convinced are you that the UK is positioned for this theme?
Yeah, firstly, I would say absolutely optimistic and really confident that the UK has a right to win from an AI perspective. So in terms of capital flow, AI has been one of the drivers of venture capital in the UK for the last number of quarters. And we're seeing that mostly at the application layer level, but whether it be the talent that we've got in our universities, like I said, the capital that's going into this particular space, the hype is real. The buzz on the ground is absolutely there. There's some challenges that come with that, but I think we should be pretty optimistic around our ability to create some global category leaders out of the UK.
Okay, so the hype is real. What do you say to your portfolio founders who come to you and say, look, the US is now a significant market for us. We're not getting the growth capital we might need to really scale. We're going to go to the US. We're going to double down there, and maybe that's where we exit. Do you stand in their way, or do you encourage them to stay in the UK? What do you say? What are the solutions?
I think there is a bit of both. So what we usually find is our UK companies, they first need to scale and get product market fit in their home market. So whether that be the UK or a combination of UK and Europe. And where there's always, it's good to have rivalries across the different tech ecosystems. Collaboration is key. So what we usually recommend is companies get a little bit of scale before they go to the US. The US is a huge, absolutely mission-critical market, and we would never get in the way of our companies, but they have to be ready. They have to be ready from a product perspective, a depth of capital, and the ability to attract world-class talent in the US. And that's where we've seen companies fail, is when they go too early, they don't have the right access and network, and they end up usually hiring the wrong team. So the U.S. it will continue to be a massively important nexus and market for our innovation businesses, but we need to make sure that they're prepared for it.
And where, for Octopus Ventures, where in that AI tech stack are you finding the most value right now?
Yeah, so we're sticking in that sort of AI application layer. So if you think about the amount of capital that's needed for more infrastructure plays, from the average UK domestic fund, and we're about $2 billion of AUM, we really want to be staying at that application level. And what we're seeing is companies that are really going vertically deep into one particular sub-vertical. So whether that be fintech on personalization, healthcare, so we've got a really interesting company we just invested in called Lyrebird that's taking clinical data and clinician data to make doctors more efficient. Legal services, so a company Detectify that we've invested in. Again, really expertise to go in to make a workflow more efficient, more accurate, and more cost-effective. So that's really where we're spending a lot of time and seeing really fantastic A, opportunities, but B, growth. And I think that's really a really important indication of sort of that product market fit.
The time frame between founding and getting that initial funding and exiting has stretched from 7 to 8 years to about 15 years.
Yes.
What is that doing in terms of the liquidity squeeze?
Yeah, it's tough. So I would say exits across the global venture capital and private equity ecosystem continue to be constrained. Now, there was some decent news data in Q1 in the UK, but it's I think it was the second best quarter in 12, but it's still marginal gains. So this sort of stagnation around exits is just making everything more difficult, because it means that venture investors are needing to find liquidity to be able to raise their next round, which is putting capital constraints on for new investments going into founders. So this is a topic that every single investor is looking at. Now, the positive sort of side is looking at macro data. So interest rates coming down. This is a big driver of this ecosystem. The number of U.S. IPOs, usually UK and Europe, is a laggard from the U.S. So that's all really positive stuff that we're keeping an eye on, and hopefully we'll start to see some unlock. I wouldn't expect anything dramatic before summer, but maybe going towards the end of this year into early next.
I want to draw on your experience, formerly as CEO of HSBC Innovation, but also at the coalface in terms of thinking about the UK capital markets and how to reform them, because you're working with Julia Hoggart and others on an advisory board linked to the London Stock Exchange at a time when we've seen Wise, for example, moving its primary listing, or at least think about moving its primary listing to the US. We've seen what's happened with companies like Darktrace taken over by private equity, in the delivery space as well, Deliveroo. How much concern is there right now that the capital markets are not fit for purpose?
Yeah, so I'm always of the mind where if there's an issue, you can either throw stones or you can lean in and try to be helpful. So I joined the Capital Markets Task Force earlier this year in the aim of how can I help? How can we as an ecosystem come together, because we have to have a vibrant, healthy public market.
I mean, how urgent is this?
I would say it's really urgent. So you can look at every single one of those cases and explain it, right? It probably makes sense for the company, the shareholders, whatever. But thematically and from a cumulative basis, we really do need to find ways to continue to drive much more capital into our public markets, make sure there's reduced friction going from private to public markets, and at least be competitive with other global capital markets. And then if you layer on AIM, and there's a 30-year anniversary of AIM coming in, there's also needs to be a conversation around not just main market, but AIM, and really how do we drive capital and growth into those markets. And there's no silver bullet, right? I think there's a suite of interventions, many of which have been talked about around looking at regulation, looking at how does Mansion House Accord now actually not just fuel private but public markets, but we really need to see a change immediately.
Are you seeing the impact of those Mansion House changes now? Is that starting to come through?
Not yet. In pockets, I would say real positivity with respect to the Schroders Phoenix joint venture that was created. There's a lot of good momentum with respect to British Business Bank, but not the actual capital going into the funds at scale yet. I still think we'll need to see another 12 to 18 months. But if we don't start to see the outcomes in that time frame, I do think that we'll need to look in the mirror and figure out, why aren't we seeing the outcomes we expect from this? What is a fantastic and positive initiative?
And for the reference for our viewers, of course, part of this is about a non-compulsory agreement amongst many of the pension providers and funds to invest a proportion into UK markets around infrastructure and taking on higher risk, and tech may fit into that. Does there need to be a compulsory agreement, or at least a compulsory piece of policy that comes through to compel pension funds to invest more in this space?
You know, it's an interesting question, and my personal view is not yet. So with Mansion House Accord, so this is kind of 2.0, we actually saw more pension funds than DC pension schemes sign up. I think it was 11 versus maybe 5 or 6 the last time, and actually signing up to a higher percentage of their contributions, from going from 5 to 10%. So I think there's a willingness and desire, and the pension funds I speak to, an excitement about deploying capital into this vibrant ecosystem. So I think we need to wait maybe another 6-12 months, and then from there we'll have to keep all the options on the table.
Okay, so this time next year we'll check back in with you on this. Before I let you go, deal volume as you project out 6 to 12 months, what's that looking like?
So deal volume is going up, but it's bifurcated, right? So we're personally seeing, although the data is flat, huge excitement in the pre-seed and seed round. So we've got our own first check fund, which is going unbelievably well. But then you start to see this lag in sort of Series B, Series C, and then growth rounds getting bigger and much more just larger and more sizable. So you're seeing that barbell approach. So I think we'll hopefully start to see an uptick. Again, I think it's slow and steady for the next couple of years. I don't expect a huge uptick like we saw in 21 and 22, but hopefully slow and steady, much more diversification of funding sources into a broader range of companies is, I think, will show that we're on the right track.
Okay, Erin Platts, really excellent insights. Thank you very much indeed. The CEO of Octopus Ventures, with a feel in terms of some of that liquidity challenge when it comes to startups here, what to look for in terms of some of the growth opportunities as well within the AI space, how the UK can lean into that. Guy, Lizzie, back to you.
Bloomberg's Tom McKenzie, we thank you. And a reminder that Bloomberg Tech, Tom's show, Bloomberg Tech Europe, launches later on this week. You're not going to want to miss it. The first episode coming at 6:30 a.m. London time on Friday morning. So do stay tuned for that. I want to stay on tech, though, because Bloomberg has learned that Meta is in talks to make a multi-billion-dollar investment into artificial intelligence startup Scale AI. The investment could exceed $10 billion in value. And Matt Bloxham, Bloomberg intelligence analyst, joins us now for more. Matt, just tell us why Meta's betting on Scale AI. Is it just because the CEO was Sam Altman's roommate?
Yeah, hopefully it's a little bit more than that. I mean, I think what we're seeing with Meta is that they're looking to extend their reach into all parts of the AI world, and people might not be familiar with what Scale AI does, and it kind of operates in what I'd call the unglamorous part of the AI industry. It basically employs humans to train and label the data that's used to train the AI engines. And actually, we do a lot of that at Bloomberg too. So, you're trying to help the machine understand what it's ingesting. And historically, that used to be kind of very simple. And I think Scale AI was, caused some controversy around where it was employing people and how much it's paying them in other parts of the world. But increasingly, they're employing PhDs to kind of do much more sophisticated training of these models, testing them, setting quite difficult, complex tasks for them, and then essentially grading them on their answers. And that helps the models to kind of get more sophisticated, reduce hallucinations, and open them up to more sophisticated applications in the real world. So I think that's really why Meta is interested in increasing its investment in this business.
There's a great story in the terminal today talking about the idea that the Chinese are turning off their AI models while the exams are on, which is amazing.
Tell your teenagers, Guy.
I have to say, it's a big feature of the landscape, I have to say, these days, with exams and revision. So I find that story absolutely amazing. Apple, though, feels like it's still out of it. We've got this big event coming up this week, and you're just not getting the buzz around Apple in the way that you are with other businesses.
Yeah.
Any way that gap gets closed this week?
I don't think so, no. Yeah, we've got the Worldwide Developer Conference later on today, and I think people would be hoping for a big splash on the AI developments, but I think that's going to play second fiddle to something much more familiar to us, the operating system, what you look at on your phone every day. And I think it's going to be quite a big radical shift. So we're going to all have to get used to how to work our iPhones again once this new operating system
I don't have this problem, by the way.
comes out. Yeah, and I think they're doing that because the hardware isn't really evolving at a particularly great pace. So a good way to kind of stimulate fresh demand for your phone is to create a new operating system that needs faster processors, bigger memory, so that you upgrade to a new phone and they can keep the sales momentum going before maybe next year.
So this is a precursor. Where are we in terms of Apple phones now?
We're at 16, so 17 this year is going to be, I think, another kind of relatively modest upgrade.
Okay.
And I think the kind of, the 20th anniversary is 27, I think, and that's kind of where maybe the speculations are leading up to a much kind of bigger...
We're looking all the way out that far?
Yeah. I mean,
in terms of getting the market doesn't like to wait that kind of length of time.
No, they don't. But I guess depending on what they say about the OS today, I think the market will get that software is a really important part of the ecosystem, and that they can probably do a lot to kind of maintain, if not enhance, the appeal of the platform.
The problem is that increasingly software is spelled AI, and that's kind of
and it's going to be a soft AI event for them for sure.
Absolutely. Matt, great to see you. Thanks very much indeed for stopping by and updating us. We'll look forward to that event a little bit later. I know we've got some great coverage coming up. Matt Bloxham from Bloomberg Intelligence. What are we going to talk about next on this show? Will the UK Chancellor of the Exchequer, Rachel Reeves, have to raise taxes later this year? We're going to look to the government spending review. It's due out later this week. We're going to have some of the details that we're anticipating in that review next. This is Bloomberg.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. Welcome to the opening trade. Welcome to Monday morning. There is not a lot happening when it comes to the equity markets, certainly here in Europe right now. At the moment, we are barely budging on the FTSE 100. We are down less than 0.1%. The CAC 40 is down 0.1%. The DAX is down a whopping 0.3% this morning. So there's a lot of activity happening out there, but it is basically, feels like we're basically in a situation where we're waiting. Monday is going to be a kind of wait day. Are we going to see some details coming out of these trade talks? We are waiting for obviously big events coming through midweek in terms of the auction, the CPI data out of the United States. Got plenty of things going on this week, just not this Monday morning, which is why Valerie's going to be here for the rest of the show to kind of set us up for the rest of the week and give us an idea of what we should be focusing on. I struggled to see a lot of activity on the screen in front of me this morning.
Yeah, to me, it's the U.S.-China talks, which I know we're going to get to speaking about in just a moment, but that's key for the equity market today.
But I don't know when we're going to see a result from that.
Yeah, exactly. No, that is a good point. I mean, hopefully there'll be a readout at some point later today, but you know, the equity market has rebounded so strongly because trade policy uncertainty has dropped so rapidly, and I think today will be a key test in whether that continues.
But basically, do you think that the market's hopeful heading into these talks? Because the market's
I think so. I mean, look, Lutnick's there, Besant's there, Jameson Greer is here. You know, they brought the A-team. So I think that sets us up for optimism, frankly.
I don't know which one each of the A team, each of those characters
Who's
would
on the
be.
B team?
I don't know. I don't know who's on the. I don't know who is on the B team. Let's talk a little bit about what else is happening as well, because we've got the spending review this week as well.
Yeah, so that's happening on Wednesday here in London, and the UK Chancellor Rachel Reeves may need to raise taxes again later this year because of the weak growth in the UK economy. She's also got higher borrowing costs and increased spending on public services. But I have to say, her overhaul on the UK non-dom tax regime is already spurring some wealthy residents to leave the country. And I've been speaking to someone who really personifies that change. So Gary Landsberg sold the Mayfair Arts Club, and then he opened a new private members club in Milan, the Wild. So here's part of our conversation on the latest episode of Wall Street Week.
Well, I think, you know, for someone that was pretty much heavily invested in London, I'm completely divested from London. I have nothing here. I have a few real estate investments, but I'm certainly not looking at this stage to invest back into London in the short term.
So you've got this move of the rich and internationally mobile from London to Milan, partly because of what Milan is offering Italy as a whole, this flat tax regime of €200,000. It went up from 100,000 to 200,000, and really spelling a nightmare for the UK when it's dismantling the non-dom regime.
Another policy that the UK government, the Labour government, put in place and is now struggling to deliver upon, and that's but that's the spending review writ large. This is just emblematic of a wider challenge. They came in with a kind of a unconvincing plan that is frayed at the seams and is now starting to come apart. And the evidence of that is going to become, I think, pretty clear this week in terms of the numbers we're going to see from Rachel Reeves.
Yeah, because it's going to be such a difficult choice between all of those ministers who are asking for more money for their departments, and she's going to have to say, I'm prioritising health and defence. But, you know, with the non-dom policy, I spoke to her about this. She was convinced that you're not going to have this wealth exodus from the UK. In that film, we spoke to the Centre for Economics and Business Research. They say if more than 1 in 4 non-doms leave the UK, it's going to cost the Treasury more than it raises, this policy. So even more of a nightmare, self-created by the Chancellor.
Are we going to get to that number? Or are we already at that number?
we're not already at that number. It doesn't look like yet. But when you look at the anecdotal evidence of people going...
They're still trying to sell their houses before they leave. They're having a bit of issue with that.
They've got to do that. But look, there's not just Milan, there's Monaco, there's the Middle East, and everybody's in this global competition for the rich and wealthy, rich and mobile.
So I think the next kind of piece of this is going to be students, I think, which is going to be really interesting. The US is putting students off travelling. Does Imperial College, does Oxford, does Cambridge attract people into the UK as a result of that? Or does actually a more hostile policy from the UK on students actually present challenges as well? So I think there's a kind of various ways of looking at this. It's a multi-fronted story in terms of the way that the UK is positioning itself at the moment, and it feels more hostile. You've also got the school fees story. There's plenty of things, I think, that are putting people off right now. Let's talk about the trade story that Valerie was just mentioning as well. What is going to be key this week in terms of the way that the markets are set up? US and China negotiators are here. Apparently it's the A-team that are here. Where are we talking about trade, or are we actually talking about other things? Beijing's rare earth export restrictions, chip exports, students actually maybe a factor as well. The Trump administration wants to restore the flow of critical minerals, but what does it need to give up in response? That is the key question.
Those exports of critical minerals have been getting released at a rate that is, higher than it was, but not as high as we believe we agreed to in Geneva. And President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up, and then we'll clear up what you don't like that we've agreed to release on our side.
Kevin Hassett, speaking on what is happening with the rare earth story and kind of where we are in this process. Brendan Murray joins us now, leads our global trade coverage. Brendan, we're not even talking about trade anymore. We're talking about trade in other things. This isn't about, tariffs. This is about rare earths and chips and students. And the picture gets more confusing by the day in terms of the relationship between these two.
Yeah, exactly. So both of these delegations now have a mandate from their leaders to make progress in these talks. So both sides have arrived here over the weekend to London. They have no incentive to have these fail. So I think what we can see is a couple things. First, on substance, they both sides need to get those critical supply chains rolling again. Yep. The U.S. for its in magnets and rare earths and those kinds of things, and China wants access to the technology that it needs to develop its artificial intelligence industry. So I think they're going to sit down at the table, hammer those two things out, make sure they're on the same page, and then the second thing is the style or the tone of these talks. Can they sit across from each other? Howard Lutnick, as was mentioned, is here. He's the sort of more tough-talking New York finance guy. Scott Bessent is the more diplomatic as Treasury Secretary. Can they sit across the table from their Chinese counterparts and set an agenda over the next several weeks where they can see they can make some progress on very difficult issues? The U.S. wants to move it. The U.S. wants to move very quickly. China, has an incentive to slow things down.
Valerie, if we don't get it, time is a real issue here. Yeah. How quickly does the market need to see something coming out of this?
Look, I mean, that's a hard one because we did get that China export data today that showed exports to the U.S. did fall by some 30%. It's not a trade embargo that some were worried about. So maybe that gives them a bit more time, and that trade is happening, at least in the month of May. But I do think that it's going to be important on whether this does lay a groundwork for a Trump visit to China. I think that's what could really boost equity markets.
In terms of kind of, if they last longer, is that a good thing? What I can't work out is if they're here for a long time and they're talking about a lot of things, is that a good thing? We're kind of talks are ongoing.
Surely it
depends
on
thing.
all the little snippets that come out of it when Lutnick gives a little voice.
Are they going to talk? Are they not going to talk? Are they going to brief? They're not going to. I don't know.
Well, a joint press conference would be nice, but I doubt we're going to get that today. It'll be kind of an individual readout from either of the parties. I think that's what Brendan expects as well. Yeah,
Brendan, great to see you. Thank you very much indeed. Valerie as well. Lizzie and I wrapping the show up. I just want to tell you what is coming up next. Jensen Huang is going to be in conversation with the UK Prime Minister. We're going to bring you that live from the conference that Tom Mackenzie's at down in Olympia. That's coming up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
London calling. Fresh trade talks between China and the United States begin in the British capital today. On the agenda, tariffs, tech, restrictions and access to rare earth minerals. Los Angeles is rocked by a third day of anti-deportation protests while President Trump and California's governor exchange blame for the unrest. Plus, a London Tech Week kicks off with the UK Prime Minister appearing alongside NVIDIA's CEO Jensen Huang as the British government looks to put AI at the heart of its growth agenda. We are going to bring you that conversation live on this program. Let's talk about the markets and figure out where we are this Monday morning. Obviously, we need to take into context what we saw from Friday, and that was a big equity push higher, 6,000 on the S&P. This morning, we're looking at S&P futures absolutely flat. We need another catalyst. Is that going to come from the trade talks? We'll talk about that in just a moment. The US 10-year around 450. There you go, 447. Big auction coming up on Wednesday for the 10-year. Then we've got a 30-year auction as well coming out of the United States as well. How well will those auctions be received? A key question for the week. Euro dollar 114.23. We've got inflation data out of the States. Does the euro continue to gain ground? The US labor market looks good. What about the inflation picture? We're going to fill in the blank there. Oil absolutely becalmed. We are waiting to see, I think, probably what happens on trade as to see where the next catalyst comes from on that front. It is Whit Monday, which means you've got a number of European equity markets closed today. Switzerland and Denmark are 2 notable ones. So quick look at what we're seeing in terms of the story here in Europe. It is a picture of stasis, of waiting, of watching, of looking for that next catalyst. So where does that next catalyst come from? Is it tech? Is it what happens with the trade talks? We're going to debate that next. Let's get the show going.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
This morning, it's me, Guy Johnson. 2 minutes into the show, let's talk about where we're going from here. US stock futures holding firm, actually, at fairly decent levels. Investors very much focusing on what is happening with these trade talks between China and the United States. They're taking place in London. We're looking for signs, basically, of a cooling in the trade standoff between these 2 huge economies. Vasiliki Pahaturidi joins us now, head of EMEA iShares fixed income strategy at BlackRock. Good morning.
Good morning, guys.
Nice to see. We've got this amazing week coming up. It's quiet this morning, but we've got this amazing week coming up in terms of the catalysts that we're watching out for. Is it US inflation? Is it what is happening with these auctions? Is it the trade talks? What are you focusing on in terms of setting the agenda for this week?
Yeah, absolutely. I mean, yes, we do have a week packed of economic data, particularly eyes turn to U.S. markets and the implications for the U.S. bond markets in particular. So the auction, as you mentioned, the inflation. When it comes to kind of the inflation data, we don't expect like a spiraling out. I think inflation is kind of like anchored, obviously, above the Fed.
But it stays sticky, yeah.
It stays sticky. It is above the Fed's target. I think the point around the auction, it is another signpost to see investors' appetite or appreciation of how the U.S. is going to continue to finance itself. But questions around the importance of U.S. bonds within investors' portfolios, I think they're a little bit overstretched in terms of are people abandoning U.S. bonds. I think it's hard to imagine portfolios without U.S. assets. I mean, U.S. bonds is the largest fixed income asset class in the world. However, I am seeing, particularly here in Europe, investors looking to diversify income, particularly with European fixed income, which is actually a really good place to be right now.
Okay, let's just break that out into its kind of component parts. We'll come to Europe in just a moment.
Yeah.
Start in the States. Strong payroll data Friday. The labour market in the States is holding up. You could see sticky inflation coming through in terms of the inflation data we're going to see midweek. Where does that tell you about when we see the first rate cuts coming through from the Fed? Is it much later this year? Is it next year?
Yeah, I think the market is now pricing in 1 to 2 cuts this year, and I think the market has come closer to the view that we've held pretty much for the entire of this year. So I think the market is now pricing in fairly, like the Fed kind of 1 to 2 cuts later this year, and I think the economy is able to wait, and the Fed is in a good spot to kind of wait and see. But what we have seen from kind of investors is really a strong appetite to re-risk into fixed income portfolios. Is not putting us in a position to wait and see in terms of what clients are doing right now.
But with that, a steeper curve. So we're anticipating some Fed cuts, and we're expecting long end bonds to stay reasonably where they are now.
Exactly. So when it comes to kind of longer term bonds, like we have been for a long time being underweight longer dated US Treasuries. Having said that, it seems that 4.5–5% is like a resistance level for US Treasuries. But having said that, back in May, when kind of the 30-year went above 5%, we've seen buyers kind of buying the dip. We've seen some of the iShares flagship US Treasury ETFs seeing record flows on that day. So I do want to give you a balanced argument. We're underweight the long end of the curve, but there are people out there that they still see value in US Treasuries.
At the right price.
At the right price, exactly. We do definitely prefer to be staying short end belly of the curve, and of course international fixed income.
In terms of what is happening with the folding the trade talks, how are you thinking about the trade talks this week? How high are your expectations for this providing a catalyst?
I mean, I don't think we're going to see a big kind of like reversal to what we already know this week. Of course, uncertainty remains. We do have like a series of events for the rest of the summer. So trade talks does remain up in the agenda. But I think somehow we have kind of like got used to kind of, navigate the uncertainty around trade talks. And that has been evident through bond ETF flows in May. That has been a record, the second largest month in history, where people have come back into the market, indicating that, some of the kind of slowdown of the headlines from what was April 2nd to now, it has created more of a kind of a calm environment that we're not heading into a significant slowdown in the world economy.
We're going to watch that space very carefully. Vasiliki Pahatoridi, Head of EMEA iShares Fixed Income Strategy at BlackRock, joining us here in the studio. I want to take you down to West London, to Olympia, because that is where we currently find the British Prime Minister. Keir Starmer is making the opening address at Tech Week. Let's take a listen to what he has to say.
Going to do so much, and every time you say over 5 years or 10 years, everybody says to me, shorten that, Keir. It's going to be more like 5 years and 3 years that we're going to bring about great change in so many aspects of our life. Whether that's in health, where I've seen for myself the incredible contribution that tech and AI can make, standing in a hospital up in the Midlands, talking to consultants who deal with strokes, and they showed me the equipment, the techniques that they are using AI to isolate for stroke victims exactly where the clot is in the brain in a microsecond of the time it would have taken otherwise, brilliantly saving people's lives in that particular occasion. And shortly after that, I had an incident where I was being shown AI and stethoscopes working together to predict any problem someone might have. So whether it's health or other sectors, it's hugely transformative what can be done here. Last Monday, in fact, I was standing in Scotland launching the Strategic Defence Review of the government. This was a review that I commissioned soon after we came into power to tell me what are the risks that we face as a country in this new era, what are the challenges, what are our capabilities, and how do we make sure that as we go forward, our capabilities match the risks and the challenges that we face as a country. And in that, tech and AI were absolutely central, because as you will perhaps have seen over the last 3 years or more, during this awful conflict in Ukraine, I've been back to Ukraine on a number of occasions in that 3-year period, to have in-depth conversations with President Zelensky to make sure that our support is in the right place. But I was really struck the trip before last that I did, this was probably about 6 or 7 weeks ago, the extent to which technology and AI was now having a direct impact in that conflict was huge. In 3 years of conflict, the way in which that war was being fought had changed profoundly. And therefore, what I wanted hardwired into our defence review was a real sense of how AI and tech would be driving our defence of the future. There are so many examples across government. I've set the challenge to all of my teams to show me how they can use AI, not just in the output of government, not just in the partnership with yourselves and others and the delivery of services, but also in the very way that we do government. How do we transform what we do? And there are so many examples of that. I spoke to a social worker in Downing Street at one of our receptions, and she explained to me with a smile on her face just how AI is slashing her paperwork and her caseload. And she showed and talked me through the way in which she's now doing her work. And what she said to me was that this was helping her transform the work that she did, because she could concentrate on the human element of it. She could use AI and tech to help her with the parts that could be done more quickly using tech and AI, and that made her more human. And from that, I've always said, AI and tech makes us more human, which sounds an odd thing to say, but it's true. And we need to say it because, look, some people out there are skeptical. They do worry about AI taking their job. And I know for an audience like this is a debate that's been had perhaps many times, and we need to push past it. But for people listening to us, they worry about, will it make their lives more complicated? And even for businesses who get it, the pace of change can feel relentless. And I know you all get that and understand that, but when it comes to harnessing the power of this technology, I believe that the way we work through this together is critical. And that means a partnership. And partnership is at the heart of everything that we do in government. Working with you, you are the entrepreneurs who will drive this country forward. Our job as partners is to create the best possible conditions for you to succeed. And that's why events like this, conversations that we have in the margins, are so important, because we can only create the right conditions for you if we're having that conversation about what we're doing. You're able to put your fingerprints on what you're doing. Because, you know, just look at the raw facts. This industry, this sector, supports over 2 million jobs. That's incredible. Or take this statistic. In 2023, our AI sector grew 30 times faster than the rest of the economy. 30 times faster. That is incredible, particularly when we're driving for economic growth. So this is about what we can achieve. It's about, to me, who we are as a nation. What signal do we want to send to the rest of the world? And the signal I want to send is this: a Britain that once again, after years of chaos, is a stable partner for investors, that believes the future should be shaped by our democratic values, and that in this volatile world is unequivocally, unashamedly, defiantly even, open for business. And I think and hope you can see that in our approach to trade, in the new deals that we've done just in the last few months, determined as we are to create new markets, whether that's in India, in the US, or Europe, all areas where we've made progress recently. You can see it, I hope, in our openness to investment as well. And on that front, I am really pleased to welcome what I see as yet another vote of confidence in Britain today, with the announcement that Liquidity will base their European headquarters right here in London. And that's a 1.5... That is a £1.5 billion investment into our economy, which means better access to finance for entrepreneurs right across the country. It's a vote of confidence in our AI Opportunities Action Plan as well. And we put that plan out at the beginning of the year. We're really proud of it. 50 recommendations, all of them accepted by the government. And at the heart of it is partnership in action. And it shows our ambition that we are determined to be the best state partner for tech entrepreneurs anywhere in the world. That's the bar, that's the ambition that I've set for my government. And so on that front, I can announce today also that we're committing an extra £1 billion worth of funding to scale up our compute power by a factor of 20. Now, you know how important that is. That's a huge increase. A huge increase in the size and power of Britain's AI engine, which means, of course, in this global race, we can be an AI maker and not an AI taker. And more importantly, that we have the digital infrastructure that we need to make sure AI improves our public services, because we do have a defining mission on that in the plan. A responsibility, if you like, to harness this unprecedented opportunity and to use it to improve the lives of working people. And this is a shared mission. We're a mission-driven government, but this is a shared mission. Because that social fear that I was talking about a little moment ago, trust me, I think that is the challenge for adoption. I think it's a far greater challenge than the regulatory barrier, although, as you know, that can be quite a challenge. But it is an area where the government can help, where we can do our bit in this partnership. So if we take planning, for example, which is a huge priority for this government, we are going to build more homes, more labs, more data centers. And we're going to do it much, much more quickly. So our planning and infrastructure bill going through Parliament at the moment is a real game changer. And each of you in this room will know just how important it is to change our rules on planning and infrastructure and the regulatory environment. And where that can then drive growth in building of homes, what a difference that will make. Again, the human that sits there with the tech and the AI, because the security of having an affordable home is hugely important. I come from a working class background, and at times we struggled as a family to make ends meet, but we owned our own home. And that gave me a sense of security, a base camp, if you like, on which I could build my life, my opportunities, and my aspiration. And I want that to be there for everyone in the country, that base camp. And AI can help on this. And this is how we explain and lead people down this transformative path of AI. And in that way, and pushing forward, we have developed a powerful new tool. And we've done this in-house. I'm really proud of this, that as a government, we've taken on the challenge and developed in-house just to prove that governments can innovate. We use that word all the time, and some people don't associate it with government. We've developed what we call Extract. And this is being trialled in councils in Exeter, Westminster, Nuneaton, and Bedworth. And what it does is it takes old handwritten planning documents and puts them into digital form in seconds. So jobs that would otherwise have taken hours and hours done in seconds. 100 planning records a day. And the usual, by the way, the average up till now is 5. So you can see it's a huge productivity boost. And so we want to roll that out across the country. And that doesn't just show that government can innovate, it also means faster planning decisions, which I think will come as relief to many people in this room and beyond, both in AI and growth, frankly, in any business that is seeking to grow. And of course, it's money saved for councils, so they can spend their money on other things, and it turns into more growth and more investment. But most of all, it speeds up the future that we need. AI innovation making a difference for working people. And the same, of course, is true across the public realm. We're looking at how can AI speed up discharges from hospitals, hugely important. We have long waiting lists in our hospitals are busy, and one of the problems is how do we get people out the back door more quickly? AI can help with that. Same with the asylum backlog. How can AI and tech help us deal with that more quickly? Or teachers, helping them personalize the lessons for their pupils. Again, using their time to good endeavor, making them more human, giving that interaction so that every child gets the best possible chance in life. And what a difference a good teacher personalizing what they do can make to so many children. So in every case, we can show AI innovation making a difference for working people. But if we're truly to succeed in this mission, then one of the biggest barriers is, of course, skills. And you will all have debated this many, many times. There isn't a conversation about AI and tech and growth and investment and business that doesn't in the end come back to this question of skills, a key concern in any business in technology, actually any business pretty well across the country. And also one of the great worries for working people. It's the same for any parent. Always your number one thought is, how will this affect my children? What does it mean for their future? So today, I am really delighted to announce what is a step change in how we train homegrown talent for the AI age. A partnership with 11 major companies to train 7.5 million workers in AI by 2030. And we also have a commitment from NVIDIA to partner on new AI talent pipeline. And Jensen is here with us. We'll be in conversation just now. And we're so grateful for that partnership. And that allows us to expand their lab in Bristol. And that will make a huge difference to opportunity and jobs in the Southwest and beyond. And in the spirit of partnership, we're also going to bring the full powers of government to bear with the new Tech First training program. That's up to 1 million young people trained in tech skills that will be so crucial for their future. That's a £185 million investment embedding AI right through our education system, starting in our secondary schools with subjects like computer science. At universities, a new scholarship program for high-flying students, supporting the best and brightest postgrads so they can focus their research on the next frontier. So from school all the way through. And on top of that, extra support for small businesses and entrepreneurs, hugely important, so they can recruit the technology skills that they need. And this, trust me, is a package I think that will make a massive difference to the aspirations of working people. And at the end of the day, that is what this must be about. I want young people in the poorer parts of my constituency And I'm thinking in particular of a place called Somerstown. This is between Euston and King's Cross. King's Cross, where there's so much of that tech, entrepreneur, AI brilliance. There are children in Somerstown, just literally a stone's throw away, who look out of their classroom windows and don't necessarily see that they can make the journey that that stone would take if they threw it at King's Cross. And I want them to look out at the technology sector and feel, yes, I can be part of that success. This could belong to me. And so this work we're doing with schools, with universities, with colleges is so important to make them feel they've got a role, they've got an aspiration, they've got a future. And you can't aspire to do something unless you can see it and feel it and understand what it is. And in this country, the technology we build needs to be built in that way. And whilst I'm on Somerstown, I do just want to give a short example of that and praise the tech sector for investing in Somerstown, because I've thrown this challenge out to them many, many times to say, how do you make the children in the poorest part of my constituency aspire to work in your sector? And Google AI have opened a campus there in Somerstown, taken up that challenge. It is tremendous. I went there for the opening. It's right next to the secondary school where I envisaged in my mind's eye those students who wouldn't necessarily see their future in AI, and now that campus is right next to their school, so they can do those lessons, they can go there, they can see it every day. A really good example, and thank you to the tech sector for stepping up to that challenge. But now we need to go further. By the end of this Parliament, we should be able to look every parent in the eye in every region.
The British Prime Minister speaking at Tech Week, Keir Starmer down in West London. We will return to that conversation in just a moment. He is going to be sitting down with the NVIDIA CEO, Jensen Huang, who is in the front of that audience. Poppy Gustafsson, the UK's investment minister and former CEO of cybersecurity firm Darktrace, is going to be joining him. If you would like to carry on listening to the Prime Minister, you can do so. He is available on Live Go on your Bloomberg terminal. But let's turn our attention now to the wider picture for the UK and the AI picture that it is looking to develop. Matt Bloxham joins us now. Matt, the Prime Minister just wrapping up, perfect timing. In terms of the challenge he faces in attracting investment into the UK, what is it?
There's lots of competing parts of the world where that investment is actually going. You know, I think we heard NVIDIA talk about this European roadshow they're doing, and I think from an NVIDIA perspective, if you're a shareholder in NVIDIA, you're looking for countries like the UK to invest their money into AI, which will ultimately flow to NVIDIA. And the other way, the UK government wants NVIDIA to put money in, and I think both are going to be a bit disappointed by what we hear today, I think. Okay, a bit disappointed. Well, let's listen in and find out whether or not we are going to be disappointed. Let's take you back to West London, back to Olympia. Poppy Gustafsson, the investment minister, is speaking, introducing Jensen Huang, and with the Prime Minister sitting next to her. Let's listen in.
In their everyday lives.
Well, I think this is a really important issue, and I know Jensen and I were discussing this earlier on today. Sometimes in these audiences, we have this conversation about what does it mean for people in their living room, in their kitchen, and we're concerned about how they see it, because your stance on AI and tech, I think, really matters. And I always ask myself, you know, which of the two types are you? Are you someone who leans in and sees these fantastic opportunities? Or are you someone who sort of leans out and says, well, this is a big risk, I'm not so sure? I think we need to lean in. I think this is brilliant, transformative across. I mean, I mentioned health because in a way that, for me, always brings it alive for working people who do want the security in relation to their health. But also the examples of the teachers and the social care workers, overburdened perhaps at the moment, who want to use the human bit of what they do to better effect, and therefore can use AI and tech to do it, or in the defence sector. But what I said just now is really important, because very many people say to me in the conversations I have about AI and tech, It's the regulatory environment here. It's your planning, your infrastructure, the regulatory bodies that are holding us back. And that is certainly true. And the more I've tried to get stuff done as government, the more I've shared your frustration, by the way. But I do think that there's this almost cultural question, which is how do we lead people on this path? This change is going to happen. It is going to transform our lives. We're going to look back and see this is a hugely important era. I genuinely believe that our job, our joint jobs, by the way, because I think governments can't do this alone, we have to do it with you, is to lead in this period and to show people the huge opportunity and how it will bring more security for their lives. And we must always step up to that, but we can only do it in partnership. I don't think a government can do it on its own. I don't think entrepreneurs can do it on their own. I think it has to be done together. And it's for everybody who wants to see AI and tech go as far as we all do, we have to bear that responsibility, I think. But Jensen, I know we were just thrashing this about half an hour or so ago.
Well, first of all, I want to say that you hosted a terrific event yesterday. Brought together the AI tech entrepreneurs, many that I work with. So many from your cabinet were there, and urging them, supporting them, encouraging them, showing them your interest, your knowledge of the space, and your commitment to helping them. And I just thought it was a fantastic day, and it was great to see Demis there and Eric Schmidt there, my friends, and Alex from Wave and Synthesia and 11 Labs and River Lane, and there's just so many companies we work with here in the UK, and it's really exciting to see your commitment to them. This is an extraordinary moment. You're absolutely right. We have to lean in. It's an extraordinary moment. There's no question that AI is incredible technology.
Yeah.
And everybody talks about how it can understand information of almost any kinds. It can generate information of almost any kinds. AI can now reason and think and solve problems and use tools. And we know for a fact that we're going to be more productive. We know for a fact that we're going to be more secure because AI is smart. And because AI is smart, it's going to be better cybersecurity agents for us. We know that we'll be safer because AI is such incredibly smart software. It'll keep cars more safe. And so we know these things. But the thing that is quite extraordinary, and it's an incredible opportunity for the UK, is that AI is both a technology, but it is also an infrastructure. It's an infrastructure because it affects so many industries simultaneously. And it affects, of course, healthcare and government and education and manufacturing and financial services. Because this technology is so broad and so transformative to every single industry, it will be considered infrastructure, just as electricity was infrastructure, just as information, connectivity that came about because of the internet is infrastructure. Now we're going to have a new infrastructure, and this new infrastructure is called artificial intelligence. And it's vital that we invest in this infrastructure here in the UK, and with your support, we can do that.
I think that, just changing the language and the way we say it is hugely important in terms of the commitment that we make and how we work together. And as I said a few moments ago, the speed at which the change is going to happen, and persuading ourselves that the timeframes we would normally expect for pretty extraordinary change just have to be truncated all of the time. And you can see it, right before your eyes in what we're able to do as a government. How we're looking across all of the functions of government in each of the departments. We've got Peter Kyle here as the Secretary of State, who's charged not with just running his department, but looking across all the departments. He's I've asked him to go into every single department in government and take up the challenge with them of how can you use AI and tech to transform what you are doing, as well as the delivery at the other end. And I think that's a sort of statement of intent as the way that we want to operate.
So, and I love hearing about how we're sort of really driving that adoption. And we talked a little bit about that sort of investment in terms of the infrastructure that we need and the opportunity that you have in the UK. But how are we thinking about the investment in this sort of skills piece? And could you talk a little bit about how we're creating the skills that will be needed?
Yeah, I said a bit about this in the words just a moment ago, because I think the skills challenge operates at a number of different levels. There's obviously the sort of basic question, which is, can the sector get the skills it needs in the time it needs them? And that's why what we've been able to announce today is so important in terms of the sheer number of people that we can work with across businesses of all different sizes. And this is often more of a struggle, I think, for smaller businesses in terms of getting the right skills in the right place. So what we've set out today in relation to the 7.5 million people who will be trained from different backgrounds and different jobs in AI, hugely important. I'm personally very excited about the initiative in relation to our schools and universities and postgrads, because I think that training young people earlier on in AI and tech means that they will obviously be better skilled as they come into work, but also they'll be much better at it than us. I've got a 16-year-old boy and a 14-year-old girl, and they already understand AI and tech in a way which is really difficult to even have conceived of a decade ago. And to get them learning at school, I think will give them that spark. I'm a really big believer, this is my Somerstown school story, that you can't, often we ask young people, what do you want to do when you grow up, or what do you want to do, for a living or a career or whatever it may be. I genuinely think it's hard for young people to answer that question if they haven't been exposed to things like AI and tech, because you can't aspire to do something if you don't really know what it is, or it's mysterious and you think it's for other people, not for me. That's one of the biggest inhibitors for me in life, by the way, is children who think that's for other children, other young people, it's not really for me. So by doing what we're doing in schools, we're opening this out, not just for businesses and the sector to have the best talent coming in the pipeline, but for young people to be the brilliant next generation. And the speed it's going, we won't get to a next generation. That'll be 5 years and they will already know far more than we do. But that is really exciting in its own right.
You're absolutely right, Prime Minister. In fact, I would say, and this is a very important concept, AI is the great equalizer. And let me explain why. For the last 50 years, 60 years, computer science became a field of science. And it was available to tens of millions of people out of billions of people. And this technology was hard to use. We have to learn programming languages, we have to architect it, we have to design these computers that are very complicated. And so tens of millions of people were able to benefit from this particular field. But now, all of a sudden, there's a new programming language. This new programming language is called human. Most people don't know C++, very few people know Python, and everybody, as you know, knows human. And the way you program a computer today, to ask the computer to do something for you, even write a program, generate images, write a poem, just ask it nicely. And the thing that's really quite amazing is the way you program an AI is like the way you program a person. You say, you are an incredible poet. You are deeply steeped in Shakespeare, and I would like you to write a poem to describe today's keynote. And without very much effort, this AI would help you generate such a wonderful poem. And when it generates it for you, could say, I feel like you could do even better. And it would go off and think about it, and it would come back and say, in fact, I can do better. And it does do a better job. Yeah. And so this way of interacting with computers, I think, is something that almost anybody can do. And I would just encourage everybody to engage it. And just as the Prime Minister said a second ago, almost every children is already doing that themselves naturally. And this is going to be transformative.
I think it's such an interesting way of looking at it in terms of that skepticism some people have, or people are very, it's human nature almost in terms of change. But as an equalizer and as a human equalizer, that means it can operate on different levels for different people. So I think it's a great way of looking at it.
Anybody can learn how to program an AI.
I find it incredible that the children of today, like when they become grandparents and they reflect back, the earliest, most antiquated piece of the technology that they could possibly imagine is the technology that we are so excited about today. And I love that sort of pace of change and the sort of skills as we think about that transition.
I think the other bit on skills, just before I forget it, is being clear that here in the United Kingdom, we want to attract the best talent in the world in here at that level. And I think it's really important that that's a message we're really clear about, particularly just at the moment. And so that's a really important part of Tech Week as well for me.
So let me draw on that piece a little bit more. So if we think about AI and we think about building all of this great infrastructure that we'll need to support the next generation of AI companies, something that Peter, Kyle, and I get very excited about is you can't just build it, you've got to then also use it. And how do we create an AI ecosystem, and how do we drive the biggest impact from the opportunity that AI presents here within the UK?
Prime Minister and I were talking yesterday, and I used this word, and if you don't mind, I'd like to use it again. UK is in a Goldilocks circumstance. In fact, UK is singular. In any other region, it's singular in this condition I'm about to describe. UK has one of the richest AI communities anywhere on the planet. The deepest thinkers, the best universities, Oxford, Cambridge, Imperial College, amazing startups, DeepMind, I mentioned Wave and Synthesia, and 11 Labs, and incredible thinkers in computer science, really, really excellent digital biology. Of course, the discovery of DNA was here. Incredible, incredible research community. The second is the third largest AI venture capital investment anywhere in the world. The third largest, of course, the largest of the two, United States and China, is fairly obvious, but the UK is the largest AI investment area anywhere else in the world. And so between these two ideas that you're rich with great computer scientists, it's a fantastic place for VCs to invest, the ecosystem is really perfect for takeoff. It's just missing one thing. It is surprising, this is the largest AI ecosystem in the world without its own infrastructure, which is the reason why we're talking about it so much.
Yeah.
Which is the reason why Prime Minister's announcement of investing in computing, 20 times more computing, is such a big deal. If you were a particle physicist, you need a linear accelerator. If you are astronomer, you need a radio telescope. And so each one of these fields of science needs its own instrument. If you're in the world of AI, you do machine learning. You can't do machine learning without a machine. Yeah. And so the ability to build these AI supercomputers here in the UK will naturally attract more startups. It will naturally enable all of the rich ecosystem of researchers here to be able to do their life's work. And I think it's just such an incredible place to invest. I'm going to invest here, as you know, many in the local The UK is such a great place to invest because of all the things that I've just said. We're going to start our AI lab that you mentioned, Prime Minister, and we're going to partner with UK to upskill the ecosystem of developers into the world of AI. We're going to invest in helping start off the AI ecosystem of infrastructure. And once we get the flywheel going, then research, startups, businesses, more consumption of infrastructure. Infrastructure enables more research, more breakthroughs, more companies. That flywheel will start taking off. It's already quite large, but we just got to get that flywheel going.
I mean, firstly, the confidence it gives when you explain it that way is huge from our point of view. We're really pleased to be seen that way, and thank you so much for that vote of confidence in the investment. But to the wider group here, I think this question of the ecosystem, us showcasing what we have, it's very un-British to sort of showcase what you have, but we need to showcase what we have, but also to have this as a two-way conversation, because that ecosystem isn't something that, in a way, the government has to understand and sit on a platform and sort of say to you. It's something that is two-way. Almost everything we had in our action plan that we produced in January of this year was as a result of conversations with people in this room and beyond this room. Nothing was plucked from the sky. It was all part of a conversation. And that, for me, is the way in which we do partnership. Partnership isn't two people or two bodies, two entities trying to do the same thing. A partnership is where two or more bodies come together, understanding how they complement each other, how they actually do different things to achieve something bigger together. And therefore, this week, in addition to the sessions that we have like this, there are the opportunities, which I want everyone in this room to take, to give us your views on the ecosystem, on the place, on the data centers, on what we're doing with capital, on the skills piece, because that way you can put your fingerprints on what we're doing. That way we can have the many conversations. And I want you to feel that this is your opportunity to talk to all of us, including me. And we had really good discussions yesterday. These discussions, first-hand discussions, are really important to me and to Peter Kyle and to the whole of the cabinet, because they are our opportunity to have a conversation at this level about what works, what doesn't work, things that we can tweak and do differently, and to hear firsthand what the attributes are in this country we should be making more of, or where there's that gap that we should be seeking to fill. And so I see London Tech Week not as a one-off staged event, but as a part of an ongoing conversation. And I want everybody to feel encouraged to talk to me. Peter is here. And if you can't get hold of us in one of these sessions, just make sure you're in touch with my office. Varun is here. I don't know where he is in the audience. His door in number 10 is literally about 10 yards from my door. That is how close we are working on AI and tech. So please take that opportunity, because we will do a better job if we work in that partnership with you. What you see in terms of policy and output from the government will be better if it's got your fingerprints on it. And so please take that opportunity. And that's why we had a really great discussion yesterday.
Well, I'm just excited about London Tech Week. I'll make this prediction. London Tech Week. This is London Tech Week. I make this prediction that because of AI, every industry in the UK will be a tech industry. And that is because of all the things that we've already said earlier. And it's such an important thing for all of the companies here to recognize the importance of AI and technology to all of their businesses. The UK has the most abundant of the most critical of resources. Your natural resource are the AI researchers, the AI entrepreneurs, and you have an abundance of it. You're the envy of the world. Let's, make sure, yeah. And it was so great to see you recognize them yesterday, and with your support, your recognition, Prime Minister, and the investment of the government behind these entrepreneurs, the sky's the limit. This is going to be a beginning of something really great.
I think we can really hear the sort of collaboration, I think, that happens between the government, the private sector, and people to make sure that we do the best investment that we can in the UK. I just want to use our last few minutes, if I may. I think we've talked about the pace of change within the technology sector, and we understand that, and the change around what's happening with skills. But let's take a moment to reflect back on the wider world. And there is so much geopolitical change, there's so much sort of technology championship, and there's technology leadership. How do you, Jensen, balance off the pace of innovation and driving your own innovation, but also making sure that you are serving this ever-changing global market?
I have the privilege of being a company that we're the only AI company in the world that works with every AI company in the world. I think we're the only AI company in the world that works in every region around the world. And so I have the benefit of engaging and partnering with many in different industries in different countries. I'll tell you, the speed of change is incredible. As we know, the greatest force of technology has actually a name. The greatest force of technology the world's ever known has a name called Moore's Law. Moore's Law is 2 times every year and a half or so. That's 10 times every 5 years, 100 times every 10 years. In the last 10 years, AI has advanced 1 million times.
Yeah,
it's extraordinary. Moore's Law is 100. AI is moving at 1 million times. Well, that's the reason why we're all here talking about AI. And we realize how incredible this technology is, how important it is, how transformative it's going to be, and why it's so essential for us to engage. When something is moving at 1 million times every 10 years, there's only one way that you can survive it. You've got to get on that spaceship. Once you get on that spaceship, as it turns out, you're traveling at the same speed. And so to me, AI is moving at just about the right speed, the speed that I'm making it go. And so when you're on the rocket ship, all of a sudden everything else slows down. And I would highly encourage that everybody simply engage AI, from school kids to teachers to doctors to accountants and lawyers. Of course, the entrepreneurs are all engaging it, researchers. Every single field of science has already engaged AI. As you know, digital biology, quants and financial services and risk assessment, it's all deeply all focused on AI now. And so I think the important thing is to engage it deeply and quickly.
Prime Minister, final minutes then, can I just leave it with you in terms of how we, within the UK, making sure we forge that path to make sure that we are attracting companies like NVIDIA to come invest in the UK, but also really committing to that sort of UK AI infrastructure and ecosystem?
Well, I think this is all, in a sense, about posture. What do people think the government believes in? And if there's one thing I want to get across today, it is that we are leaning into this. We are excited about the potential that this could have, will have, in my view, on the lives of millions of people and making their lives better. I came into politics quite late in my career, having done other things, and I came in to try and improve the lives of working people across the country. And I can see here the huge potential to do that at scale and speed, which I didn't think would necessarily be possible. I came into politics just 10 years ago. Even then, I didn't think that we'd be sitting here looking at the potential of AI. So the posture of the government, the leaning in, a government that truly partners in the sense that we understand, we have a conversation where we actually listen to what you're saying as well. They're the conversations that matter most. Having meetings where the next meeting doesn't go over what the last meeting did and everybody repeat the same things they said last time. We've done loads of meetings like that. They're not very interesting for you or for us. So I've got
Okay, we're going to leave the British Prime Minister there, Keir Starmer, speaking at the tech conference that is taking place at Olympia in West London today, in conversation, of course, with the CEO of NVIDIA, Jensen Huang. Bobby Gustafson's there as well, the UK Investment Minister, former Darktrace CEO, of course. If you want to carry on following what is happening down at Olympia, you can, of course, do so on your Bloomberg terminal. The function is fairly straightforward. Live Go is where you will find it. We're going to start looking to what else is happening in London today, though, now, because we need to talk about what is happening with the trade story. The Chinese and the US delegations are here. They are going to be meeting later today. This comes, of course, as we see data coming out of the Chinese economy indicating that shipments to the United States have fallen the most since 2020. They did so for the data coming out of last month. Let's talk about all of this and what we can expect from the talks and what we can expect from the next set of data. Paris Jain, HSBC's Global Head of Transport and Logistics Research, joining me around the table. So we've got two big events happening in London today, one of which is what we've just been watching, and that's the tech story. But the other one is, of course, this meeting between the US and the Chinese delegation. What are you expecting? I watch the market's kind of on tenterhooks, waiting for some sort of outcome here. What kind of outcome should we be looking for?
I mean, where we stand today, it's uncertainty likely to linger for probably next several months. But here we are talking about finding a solution to a $1 trillion trade or a couple of $100 billion of trade. So what we have seen thus far is probably that we will continue to see uncertainties with respect to what will be the final outcome. And which means that retailers will be on their toe in terms of, shall they continue with the front loading? Shall we take a pause and look around how the consumer's health will be? So a lot of uncertainty, and which more often than not works well for shipping and logistics.
Is that what we're seeing in this latest set of data? Is that just uncertainty manifesting itself now as people turn more cautious and aren't willing to place the orders that normally would be placed at this time of the year, looking 6 to 9 months down the road?
I mean, if you look at the data, I mean, there is not much excess capacity available outside China for the retailers to import. I mean, whether it's Vietnam, whether it's Thailand, they're running at pretty much max capacity. So what we saw in data is a continuation of theme like low-end manufacturing continue to move away from China. China's trade with the rest of the world continue to grow. And what we have seen with respect to the US is pretty much an impact of the first 2 weeks of May when the tariff was at about 145%. So coming towards the end of May, we have seen the ships are loading full out of China, and probably June we'll see some bit of recovery in terms of.
But you expect these numbers to be volatile, therefore, going forward? Is that what?
Oh, yes, absolutely. I mean, where we stand today, there are several deadlines, right? There's an early July deadline for the rest of the world. There is an early August deadline with respect to trade with China, and nobody knows, I mean.
In terms of what does inventory look like?
Yeah.
How much cushion is there within the system?
So inventory, I mean, if you look at, we have seen a slight uptick when the Red Sea, when the diversion happened from the Red Sea at the start of last year, and since then inventory is cruising around at that level. And what it tells you is that the consumer spending continues to remain robust. And when we talk to some of the retailers, and their view is that they will assume that the trade will continue. And there is not much latent capacity to build those inventories. You may see certain SKUs where the retailers are adding capacity, but by and large, I think consumption is following the import pattern.
So has anything fundamentally changed in the underlying premise on which trade is operating? Because there is this idea that the US wants to close its trade deficit. Is there any evidence that the US is closing its trade deficit at the moment? What are you seeing in terms of the numbers on that front?
I mean, I'm not an economist, but what we see for now is that trade deficit continues to sustain, because particularly with respect to China, while export growth has slowed down, but so is the import into China. So the trade deficit so far continues to remain. I think what I fear the most, talking to our companies, is what will happen come the peak summer, and if we see an increase in the finished products. Will that dent the consumer sentiment, and will that lead retailers to go towards destocking? And that would be a bigger risk than ongoing consumption and inventory.
The concern here in Europe is that we're going to see Chinese inventory moving away from the United States and towards Europe. Any evidence there from the conversations you're seeing?
I mean, there are a lot of talks, but if you see the trade data, the export to the Europe is continuing at double digit, export to LATAM, export to ASEAN. So outside China, the global trade continues, and there could be an element of cargo being diverted. But if you look at import into the Europe, it hasn't deviated significantly from, let's say, early start of the year.
What happens with freight rates in this kind of environment? What are you seeing thus far, and is the volatility there going to continue too?
I mean, for right or wrong reason, that's where the industry thrives. I mean, if you look at what we have seen in terms of the spot freight rate over the last several weeks, I mean, the freight rate from China to US East Coast and West Coast has more than doubled. I mean, at an index level, the freight rates have gone up through 67%. And that tells you that all of these uncertainties means the use of capacity become inefficient, and that's when the shipping industry makes money.
Okay, so the shipping industry is making money right now?
Yes, for now.
For now, but that's the important point here, isn't it? How quickly could this be turned off again? So you come through these key dates, was it the 9th of next month, and then we come through into August with the Chinese date. If there's any issue around tariffs being reapplied, how quickly does that reverse?
Oh, pretty quickly, and we have seen that in 2023. We saw that at the start of the year. This won't change because structurally we have entered into a permanent excess supply demand scenario when it comes to the ocean shipping, with the shipping order book at around 30-odd%. At some point of time, probably the Red Sea trade will unwind, and that will add additional pressure on the shipping capacity. And so far as global trade is concerned, your bullish and bearishness still hovers around 0 to probably 3-4%.
Paris, nice to see you. Thanks for stopping by to see us. Thank you for your patience working our way through what we heard from the Prime Minister and Jason Huang a little bit earlier on. Paris Jain, HSBC's Global Head of Transport and Logistics Research, joining us ahead of the trade talks that are taking place between China and the United States here in London today. We'll continue to keep you updated on those talks as we work our way through the morning. Looks like that's going to be probably the major catalyst right now. At the moment, equity markets are fairly quiet, as you can see in terms of the numbers that you can watch on the screen right now. We're not looking looking we're going to get some sort of a big pop in terms of US futures either. That is signaling maybe a quiet session. We're looking for the catalyst. Does it come from the trade talks? Does it come from the data that we're going to get this week as well? Or does it come from these big auctions that we've got in terms of the US Treasury market? All of that is on the agenda. The brief is up next. That wraps up the pulse. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
For Trump to win, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEMs and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging.
Yes, exactly.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. All eyes on London. U.S. and Chinese delegations are set to hold talks in the UK. Stock futures hold steady near all-time highs. Escalating tensions. Anti-deportation protesters clash with law enforcement in L.A. after President Trump sends thousands of troops. And it is Tech Deals Monday. Meta said to invest billions in startup Scale AI, while Qualcomm expands its AI offerings in a new deal. So tech center stage yet again, and the rally continues. More benign economic data, payrolls not too weak on Friday. You also have those trade talks in London today. That's igniting some optimism. So here we are. It's the start of a new week and the start of a new bull market. We are back up 20% from the lows. Some outperformance in your S&P, up 0.1%. NASDAQ basically flat this morning. Now, the bond market did some work to price out Fed cuts on Friday after that jobs number. We haven't even priced 2 full cuts in. Some of the losses on Friday turned into gains this morning, however, down by about 2.5 basis points for both your 2- and 10-year yield this morning. We are standing at just below 4.48%. Those are your overall markets. Let's head over to London, where we can get some stocks to watch with Joe Easton. Good morning, Joe.
Hey, Danny. So Tesla shares significantly lower in the pre-market today. We're down close to 3%, 2.6% at the moment. We've got a downgrade for the stock from Baird today, which is talking about expectations being too high for the company's robo-taxi business. Now, Elon Musk said there would potentially be hundreds of thousands of these robo-taxis on the roads within around a year or so, but Baird's saying they reckon there'll only be around 6,000, so way below what Musk has been talking about. And also, Baird says that the rift between Musk and Trump is also adding to the potential brand damage for the company, and we have seen that stock rallying recently, so trimming that and actually heading very slightly lower. Keep an eye on Tesla, set to be weak today. Then in the drone space, we are looking at big gains for these stocks. Once again, it's the air mobility sector. Take a look at Joby, Archer Aviation and Vertical Aerospace. Those stocks up more than 10%. Trump on Friday signed an order that's potentially going to make regulation of the drone space in the US actually a little bit lighter, potentially meaning people can fly drones without actually being able to see how far they've gone, that kind of thing, just making it a lot more easy to get your drones in the sky and have fun, and also do some deliveries in things like Amazon, potentially medical deliveries, that kind of thing. So big gains in that sector. A Trump indicator on that one as well. So keep an eye on the drone stocks today. Then finally, disappointment for Robinhood investors and also shareholders of AppLovin, because these stocks have not been added to the S&P 500. Analysts had speculated that they would join the index on Friday when we had the latest rebalancing of the S&P 500. Robinhood itself has rallied around 100% on a year-to-date basis, so it's doubled in value, and people thought that would mean it would go into the S&P, meaning tracker funds would buy more of the shares, boosting it further, but that hasn't happened at all. So Robinhood is lower today. Keep an eye on that one in New York this morning, Danny.
Joe, fantastic roundup, and we'll catch up with you later in the hour. Also, this hour, in just moments, we'll be speaking with Elsa Leños of RBC, who will join the show to discuss bearishness around the U.S. dollar. And Aaron Kennan of Clear Harbor will give us his view on today's U.S. trade talks. Now, it is a busy week. We do have those trade talks. Those will be taking place in London today. On Wednesday, we'll get U.S. CPI, and then an auction of 10-year yields. On Thursday, we'll have another auction, 30-year treasuries, a market that has been weak. Are we going to have an issue with enough foreign suppliers or buyers coming to the market and funding this deficit? Joining us now is Elsa Leños, Global Head of FX Strategy at RBC, to set up the week. Elsa, what is the biggest risk for the market this week? A lot going on.
There is a lot going on, that's true. And as you mentioned, we've got US CPI, pretty critical because we're expecting to start to see some of the impact of tariffs feeding through into that higher, stickier inflation. But at the same time, the US bond auction. And we've moved away from that environment where US yields were positive for the US dollar. And certainly if we see any signs of fear in that auction, then it will reinforce people's sense that the dollar is on a longer-term structural decline.
Elsa, you also mentioned in your notes to us that you're watching the big, beautiful bill make its way through Congress, perhaps another risk to this market. Now, you write in the past that that sort of stimulus would be seen as dollar positive. What's changed this time that it's no longer unequivocally a good thing for the dollar to get that sort of stimulus coming from Congress?
I think there's a few different things. And, you know, the fact is that the experience around April, where for that brief period, the dollar was actually trading weaker as yields were moving higher. And we've seen kind of shades of that since. That's really changed the thought process and dynamic around the dollar. I mean, the reality is that a deficit of 6.5%, you know, perhaps even north of 7% through this administration. At the same time, that growth has been reasonably strong. You know, we're not in a recessionary environment, so there's no cyclical excuse for such a large deficit, and seeming unwillingness to address the deficit. The other thing I think that people mention and focus on is the fact that you're not expected to see as much of a boost to growth from tax cuts that will disproportionately benefit people with a lower marginal propensity to consume. So you put it all together and it's no longer as clear cut that any of that is as positive for the dollar anymore. Now, I don't want to rush to say, you know, it's all doom and gloom for the dollar. This is a very consensus trade and the market is positioned that way. And so that does bring the risk that you will see pullbacks if you see, you know, better US data or weaker rest of world data. All that kind of thing, I think, gives the market an opportunity to retrace a little bit and then reposition for that longer term trade.
Does that mean in the long term, Elsa, you can be bearish the dollar, but you don't want to be positioned as starkly as such in the short to medium term?
And I think you have to be careful how you position. You know, I've seen a lot of people talking about, okay, let's buy euro-dollar calls, or let's buy euro-yen puts. And the reality is that the skew in the vol market is extreme for a reason. Everybody wants the same kind of trades on, you know, so there are different ways of looking at it. I mean, actually, for a lot of trades, we think spot makes quite a bit of sense. Yes, you have some negative carry if you're looking at dollar-yen, but if you're short dollar-yen and you get in at kind of decent levels, you're layering into those trades, that to me makes sense. And then we look at kind of parallel proxy trades. You know, short CAD MEX is one we like, where, again, not anything negative per se on the Canadian dollar, but it's a trade that has carry, and in an environment where the US dollar doesn't do so well, CAD tends to underperform on the crosses.
I just wonder with all of this, Elsa, when we get employment data like we did on Friday, that's not necessarily weak. Yes, there was a downward revision, but it really was not bad. Does that save the dollar from a significant fall?
Exactly. I mean, I think this is the key, and linked to that is the challenge faced by the Fed. I mean, the reality is we saw a few banks change their call, had been expecting cuts starting in July, pushing that back to later in the year. Our own US rates team were already looking at September as a start date with the risk that it comes later. And the fact is that the longer it takes for the Fed to start cutting rates, the longer it takes for the cost of hedging US dollar assets to come down materially, the longer it's going to put off, I think, the big move lower in the US dollar. And I do think that by the end of 2026, it's a year and a half from today, we will be looking at the dollar at significantly weaker levels against certainly the yen. We've got a target of 120. We've got a target of 124 in euro dollar. But it's all about patience. And, you know, if you think about the pullbacks that we've seen, you know, we got up to 115 in euro dollar and then pulled all the way back down towards 111. Like, that kind of thing is going to keep happening because of the positioning that's already out there.
Also, it might seem obvious, but I think it's worth just putting some color on the cause for that weakening trend. Now, you mentioned maybe the big, beautiful bill isn't as stimulative as we thought, but just in general, is what we're seeing flows driven, i.e. overexposure to U.S. assets, or is it a structural shift?
I think it's a bit of both, and I wouldn't say overexposure to U.S. assets is not a structural issue, because it's something that's been in place for close to a decade, right? It's certainly accelerated post-COVID, but I think there's two elements to it. The first is that you've just got the underlying exposure to U.S. assets, and you will see that diminish over time. But I want, again, be careful there. We did see that big wave of flows into European ETFs in the first quarter of the year. That already appears to have somewhat dried up. So, you know, it's a long-term trend. It's not happening overnight. The second element, which I think is almost just as important, if not more important, is that cost of hedging on the underlying assets. We saw that happen in 2020-21. If you recall, it's the last time euro-dollar traded above 120. And it was really on the back of the Fed cutting rates from 2.5 down to 0, meeting the ECB at their own levels. And you saw that wave of hedges being put on, but by European investors, by Japanese investors. We do find that hedging follows the cost fairly closely. So as the Fed cuts rates, and it may not be as soon as some people had expected, but as those cuts materialize, you should see that dollar selling coming through.
Elsa, wonderful as always. We're going to have to leave it there. Thank you so much for joining us on this Monday morning. Elsa Linos of RBC. Let's now get you some other top stories that are trending on the terminal this morning. Meta is said to be in talks to make a multi-billion-dollar investment into Scale AI, a data labeling service provider. Bloomberg sources say the financing could exceed $10 billion. That would make it one of the largest private company funding deals ever. Neither Meta nor Scale AI responded to a request for comment. And another tech deal, Qualcomm has agreed to buy Alphawave IP for about $2.4 billion. The offer for the London-listed semiconductor firm represents a 96 premium to the company's share price. The deal is expected to close in the first quarter of next year. And British Prime Minister Keir Starmer called on NVIDIA CEO Jensen Huang to help the UK train more people in AI. Starmer and Huang were in conversation at the London Tech Week earlier this morning.
UK is in a Goldilocks circumstance. UK has one of the richest AI communities anywhere on the planet. The deepest thinkers, the best universities, Oxford, Cambridge, Imperial College, amazing startups, incredible thinkers in computer science, really, really excellent digital biology. Of course, the discovery of DNA was here. Incredible, incredible research community.
Coming up, the U.S. and China gear up for trade talks.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up.
That meeting comes up today. We'll have more on it next. You're watching Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Those exports of critical minerals have been getting released at a rate that is, higher than it was, but not as high as we believe we agreed to in Geneva. And President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up, and then we'll clear up what you don't like that we've agreed to release on our side.
The U.S. and China are set to resume trade negotiations in London today to further diffuse tensions over rare earth minerals and advanced technology after the call between President Trump and President Xi last week. Joining us now is Bloomberg's Kasia Klimashinska in Washington and Alan Wong in Hong Kong. Kasia, let me start with you. What is going to be the focus for these talks today?
Good morning. Yes, I think this is what the markets are focused on. Cabinet-level meeting in London between the U.S. and China. And as we heard from Kevin Hassett just a moment ago, the focus will be primarily on rare earths, so the key ingredients for such industries like high-tech, phones, cell phones, but also the auto industry.
Alan, to that point, what is China hoping to get out of these negotiations?
Funny enough, China also wants advanced technology out of those negotiations. But for China, it's not rare earths. Rather, it's advanced technology in semiconductor and design software for chips.
So it wants that from the U.S. What are tensions like right now, Alan? We got some economic data out of China, which also might color these discussions as well. What is the likelihood that they can get to that sort of agreement?
Yeah, that's a good reminder that this trade war began not primarily over rare earths, even though the talks beginning today will be focused on that. The trade war began ostensibly because of the trade imbalance between the United States and China. And today, China has released official data showing that exports to the United States last month plummeted by more than 30%, which is the worst drop since early 2020. At the same time, China's exports to the rest of the world rose 11%. So this is a story about how tariffs are discouraging people from importing Chinese goods into the United States, and at the same time, how Chinese companies are shipping their materials, their goods, through other countries and into the United States. And all those things are sources of friction between the U.S. and China. And even if the trade talks this week doesn't touch on that, if they want a lasting solution on trade and reduce their trade frictions for good, those are the things that China and the U.S. will have to address.
Well, maybe one of the ironies for this, Kasia, is the economic data in the U.S. has held up. Markets have held up and rocketed even higher. What does that mean for the pressure of this Trump administration to get a deal done today, here, and now with China?
Yes, I agree. I don't think that President Trump is under any pressure at the moment. As you notice, S&P 500 ended last week very well. Today, I guess the futures are waiting to see what will come out of those talks. But I think the White House has kind of pressed both sides to keep the focus of this round of talks pretty narrow. President Trump has said that the agreement on tariffs, on this temporary suspension, has been reached during the previous round of talk in Switzerland, and this time the U.S. anyway only wants to focus on rare earths and maybe also international students, specifically the Chinese students who are looking to come here to the U.S. to study.
Kasia, we did have before all of this a call finally between Trump and Xi. This had been something we were looking for, the first formal contact since the leaders since Trump took office in January. Does that represent a thawing of what seemed like some ice that had been building over between the two nations?
Yeah, so that's a good question. I think each time the two sides talk, that's progress, right? That's a good sign. But the Chinese side, for example, emphasized that this call happened at the request of President Trump, and the U.S. has really been seeking to talk after first imposing those sky-high tariffs and then providing a temporary relief. Remember, for President Trump is a part of broader strategy. On April 2nd, President Trump announced what he calls the reciprocal tariffs. So tariffs pretty much on all trading partners of the U.S. to not only lower the imports from China, but as Alan mentioned, also to reduce those flows that are coming from other countries and to instead boost manufacturing here at home. And that's perhaps also why this round of talks focuses on rare earths that the U.S. automakers, the U.S. high-tech companies need to maybe ultimately manufacture the goods here in the U.S.
Alan, just looking at who's going to be attending, because China for a long time has called for a point person, for a reliable point person in the negotiations. Scott Bessent, Howard Lutnick, and Jameson Greer meeting with Healy Fang. What do we make of that delegation?
The only change this time around is the addition of the Commerce Secretary, Lutnick. And this is important because his department oversees export controls and then the American sales of technology abroad. And one of the things that China has complained about is the Commerce Secretary's asking U.S. chip design software companies not to sell to China. And it also has warned against the use of certain Chinese semiconductors, such as Huawei's latest AI chips. So his presence there means that talking about the export control of the Trump administration is at least on the table. Whether or not they could strike a deal and at what cost is something that to be discovered.
Really excellent coverage. We'll see what these conversations bring today. Bloomberg's Kasia Klimashinska and Alan Wong, thank you so much for joining. Coming up, immigration protests see residents and the National Guard troops clash in L.A. President Trump and California Governor Gavin Newsom spar over the handling of the protests in the city. We'll have more and your front pages for you next. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
You are watching Bloomberg Brief, and I'm Danny Berger in New York. Let's get you some front page news and look what's making headlines on the world's major publication. The top story across, let's be honest, most front pages here in the U.S. this morning is the escalation of violence in Los Angeles sparked by U.S. immigration raids. President Trump deployed National Guard troops on Sunday, despite California Governor Gavin Newsom's objections. Newsom called the deployment of federal troops unlawful and said he would sue the administration over the move. LA's police chief said many of the earlier protests over the weekend had been peaceful, but conditions deteriorated as people committed acts of violence and vandalism. Now, some breaking news to bring you this morning. This coming from the Globe. Let me just read you the headline. Mark Carney to announce Canada's defense spending will hit 2% of GDP NATO target this fiscal year. Again, that's according to sources. So this is announcing a large increase in defense spending this year. That is, of course, the NATO target. Just shows you how much of the global order is being reordered after President Trump's call for that indeed to happen. Now, elsewhere, let's get a check on your overall markets this morning, because we keep trying to press higher in equity markets after a new bull market unfolding. We're up just 0.1%. We did get an upgrade from Citi's Scott Kroner this morning, up to 6,300 on the S&P 500, saying that it is time to refocus on fundamentals. Meanwhile, your 10-year yield down 2 basis points. Let's expand on the dollar, because it is weaker this morning despite optimism over trade talks. We're talking to El Salinos, talking about the structural changes which make you more bearish on the dollar, but on the short term, you could get spikes higher given that positioning is very bearish. Your euro stronger this morning. And in Japan, some weaker data, but still the yen strengthens versus the dollar. We are at 144. That is down about 0.6%. Coming up, investors wait to see any easing of U.S.-China trade tensions. We'll get more on the market implications. We'll speak with Aaron Keenan of Clear Harbor. That's up next.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. All eyes on London. U.S. and Chinese delegations are set to hold trade talks in the U.K. Stock futures hold steady near all-time highs. Escalating tensions, anti-deportation protesters clash with law enforcement in L.A. after President Trump sends thousands of troops. And tech deals Monday. Meta is said to invest billions in startup-scale AI, while Qualcomm expands its AI offering in a new deal. Will we continue, at least try to continue, a rally from on Friday? NASDAQ, that's unchanged this morning for the S&P 500, up 0.1%, driven by trade discussions scheduled by China and the U.S. today, and decent payrolls. We are now technically back into a bull market. Scott Kroner of Citi has raised his price target to 6,300, says he has a more constructive fundamental view. When it comes to this bond market, we did price out the likelihood of a Fed cut, now less than 2 full cuts, fully priced in for the year, despite the president's demand that we get a full percentage cut. We have a lot of bond auctions, one on Wednesday, a 30-year auction on Wednesday, and then the day before that we will get a 10-year, that 10 years on Wednesday, 30 is on Thursday. We are at 4.47 on your 10-year yields. Let's now get you some stocks moving underneath the surface. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So Tesla significantly lower this morning. The stock coming down almost 3% at the moment. This as Ben Callow over at Baird downgrades his rating on the stock, having been a buyer for the past 5 years. He reckons the robo-taxi earnings are going to disappoint. Remember, Musk did promise around 100,000 robo-taxis on the streets within the next few years, but Baird reckons we're only going to see around 6,000, so they come down. Also noting that the spat between Trump and Musk continues to weigh on the Tesla brand, so that is significantly weaker on the Mag 7 today. Then, in terms of your drone stocks or air mobility, Trump on Friday signing an order that's going to push up expansion of this industry, potentially meaning more goods delivered by drone, including retail, medicine, and also surveillance as well. So Joby up 10%, Vertical Aerospace as well up another 10%. Then finally, just to finish on the Robinhood stock, down around 5%. Disappointment that the company is not joining the S&P 500, despite it rallying around 100% over the past year. AppLovin down for the same reason. Keep an eye on both of those. Disappointment around them not joining the S&P 500 heading into the open in New York, Danny.
Got to get those passive flows. Joe, thank you so much for your excellent work this morning. Now, elsewhere, trade negotiations are set to continue between the U.S. and China in London today. National Economic Director Kevin Hassett spoke to CBS on the main focal points.
Those exports of critical minerals have been getting released at a rate that is, higher than it was, but not as high as we believe we agreed to in Geneva. And President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up, and then we'll clear up what you don't like that we've agreed to release on our side.
Joining us now is Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, you're there in the heart of it in London. What is the expectation for what we might get today?
Well, we expect the talks to get underway here in just another hour or two on neutral ground here in the UK. Both sides have a mandate from their leaders to make some progress, to sit down at the negotiating table. The first item on the agenda is going to be addressing these export controls that each one complains the other is withholding. China is controlling those rare earth minerals that the U.S. needs, and the U.S. is controlling the technology to power AI that China wants access to. So we expect the two sides to hammer those out throughout the afternoon, potentially into the evening, and maybe even into Tuesday. There's a lot to discuss, and the tone here is just as important as the substance they're talking about. Can these two sides sit across from the table from each other and hammer out these difficult, complicated, long-lasting issues that then essentially they have about 2 months to do so before the 90-day deadline expires in mid-August.
Well, it's worth pointing out we still are on that pause, Brendan, where we saw tariffs fall from 145% to 30%. How surprising has it been then to look at the trade flows? We got China export data today. Still trade between the U.S. and China is icy despite this pause.
Yeah, exactly. There's still a lot of uncertainty, a lot of reluctance among American importers to buy goods from China. There's a lag as well. It takes a month or 3 weeks to a month for goods to make it across the Pacific. So there's a lot of distortions in the trade numbers right now. It's all very noisy, and it's hard to see a clear economic signal. But the tariffs are still high. The U.S. has that 30% tariff on U.S. goods, and China has 10% in retaliation. So there's still a lot of barriers between the two countries to do trade. Tariffs are unlikely to be any sort of big topic on the agenda at this early stage, this first round of talks since Geneva a month ago. But longer down the road, as we get into further rounds, there may be some discussion of tariffs. But at the moment, the key issue are these export controls that are bogging down these industries that each country has an interest in seeing the productivity or production rise again.
Brendan, really looking forward to continuing to catch up with you and the outcome of those London talks. Brendan Murray there, our global trade head. Now, Clear Harbor's Aaron Kennan weighing in on those scheduled talks, writing, quote, "What remains uncertain is whether the Trump administration intends to pivot from the near-embargo posture it maintained before the May 12th truce to a more balanced and reciprocal trade arrangement." I'm pleased to say that Aaron joins us now, CEO and co-founder of Clear Harbor Asset Management. Aaron, great to have you on what might be a really important day and an important week after the market is already up some 20%, that is the equity market, from its lows. What is the bar for an outcome today that can continue the positivity around risk assets?
Well, I think the investor community, Danny, is probably somewhat cautious on what the outcome of today's conversation between China and the U.S. will be in London. We did have the truce that came out of the Geneva meeting. I think this is probably a series of many meetings, but we have to, if you take a step back, look at really what President Trump's longer-term vision is for tariffs, and he's sort of outlined that over the last many decades. And I think higher tariffs, not just for longer, but more permanent, at least during his administration tenure, assuming the courts allow it, is something that we need to be thinking about and how that sort of plays out. But I think more broadly, you mentioned the equity market, and it's, I think the market's trying to look through this a bit and thinking about some of the growth underpinnings in the U.S. economy, but also the global economy. I mean, you just had Jensen Huang on. He's in London for Tech Week. It's really exciting, talking about sort of AI and what it means for technology companies, but also companies outside of tech. Like, as he sort of said, to paraphrase him, every company is going to really become an AI driven company. Therefore, it's going to be very much a technology company. And we think there's a lot of opportunity there to increase productivity and potentially increase growth from a GDP perspective, both home and abroad.
So that's perhaps what the market is concentrating on, Aaron. I want to get to more in AI in just a moment, but you said it there in the start of your answer that what Trump wants is a longer-term structural shift, is higher tariffs, more permanent, at least while he's president. Can you put that to the side and focus on those fundamentals? Can you chase rallies driven by AI when you do have this other threat looming in the background?
I mean, certainly the tariff negotiations are a major issue for investors. But what's interesting too is that like equity volatility has trended lower over the last several weeks. Bond market volatility has trended lower over the last several weeks. So even though rates are sort of elevated in the US, elevated in Germany, G7 abroad, in places like Japan, there's sort of from a risk perspective, because of lower volatility, the risk-taking exercise has picked back up again. And I think we have to keep our eye on vol for that purpose.
Well, I know, Aaron, for some time you've been calling for greater non-U.S. exposure, which has really worked out this year. Is there any reason for that to change? Is it time to start coming back home in terms of exposures?
Well, we've always had a bit of a U.S. focus here at Clear Harbor Asset Management as it relates to equities, at least. But very much coming into this year, we were of the view that, you know, not just because of valuations, but because of our view on the dollar, in the view of, you know, if Trump actually receives what he's trying to extract, which is higher tariffs, more revenue for the U.S. Treasury, that probably means that there's just less incremental trading with the United States in many regards. So there's less incentive to own treasuries if you're a central bank and you need to have reserves. And, you know, at the end of the day, you know, we sort of think about that as it pertains not just to treasury yields, but also the broader sort of equity market opportunity set. So we do think, you know, AI is not just a U.S. story, it's obviously a global story. The growth of our defense spending is not just a U.S. story, it's very much a European story. And now, it's, as of this morning, it's a Canada story. And that not only augurs well for defense companies, but also companies that are really involved in that endeavor. In Europe, that's very much the banking sector. And it's also the industrial sector. We need more electricity for AI generation. And so that's not just the U.S. story with AI generation here, but also abroad. And then, you know, the large language models, the next sort of longer term trend for growth in the economy as it pertains to AI will not just be the infrastructure level, it'll be the application level and how companies leverage that. And we view that as all very positive for investment opportunities going forward, both home and abroad. And not just in Europe, but also Japan, where you have a lot of reshoring of capital, Danny, in Japan. So yes, rates have trended up in Japan, much more so than the United States. And but at the same time, you have a lot of reshoring of capital. We think that's going to continue to accrue reasonably positively to the Japanese equity market.
Aaron, so many moving parts. Thank you so much for covering them for us. We always love having you on. Aaron Kennan of Clear Harbor Asset Management. By the way, just wanted to mention, because Aaron did bring it up, breaking news from the Globe that Canada would be increasing their defense spending. According to sources there, Mark Carney said to announce that at some point today, aiming to hit the 2% of GDP target as aimed by the NATO alliance. Coming up, tensions flare in Los Angeles. Protesters and law enforcement clash on the third day of anti-deportation protests. We'll discuss that next. This is Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
You're watching Bloomberg. In Los Angeles, tensions flaring on the third day of anti-deportation protests as demonstrators clash with law enforcement. Here's LA Mayor Karen Bass speaking at a press conference yesterday.
What we're seeing in LA is chaos caused by the administration. People should exercise their right to protest. That's their First Amendment right. But people should also exercise that right peacefully. We do not want to play into the administration's hands.
Bloomberg's Kasia Klimashinska joins us now from Washington. Kasia, what is the latest on these protests?
Hello, thank you for having me. Yes, this is a situation that here in D.C. we started paying attention to over the weekend, and it does appear as the situation got gradually worse. We have those anti-deportation demonstrations that seem to be mostly peaceful during the day, but toward the evening, the peaceful demonstrators get replaced by people committing violence and vandalism. And so you have this rising tension between President Trump and the local Democratic administration, especially California Governor Gavin Newsom.
Now, elsewhere, I know that this has been close intrigue of where you are, and let's be honest, the entirety of the U.S. too, Kasia. On Friday, President Trump spoke to NBC on his relationship with Musk, saying that the Tesla CEO would face, quote, very serious consequence if he funds Democratic candidates, saying, quote, I have no intention of speaking to him. Kasia, there seemed to be a willingness, at least from the Musk side, maybe, to kind of cool tensions. Where do we even stand on these two, on the deterioration and the breakdown of the bromance?
Yes, this was definitely the top story last week, the breakup of this key relationship between the world's most powerful person, President Donald Trump, and the richest person on the planet, Elon Musk. I think not much has happened over the weekend. As you mentioned, President Trump is not interested in talking to Elon Musk. He did float this threat earlier on about taking away contracts from Elon Musk companies, which has caused a lot of headaches here in D.C. for the Defense Department and for NASA. But for now, also in this NBC interview, I believe that you cited, President Trump has said that he hasn't done anything specific about it.
Kasia, thank you so much for that. That is Bloomberg's Kasia Klimashinska. By the way, Tesla falling in the pre-market, down 3.3%, as much as that at one point. We also got a downgrade from Baird on the robo-taxi, but also talking about the Trump Musk spat, hurting the shares as well. We have seen them fall after that. All right, let's turn to tech. UK Prime Minister Keir Starmer called on NVIDIA CEO Jensen Huang to help the UK train more people in artificial intelligence. Starmer and Huang were in conversation at the London Tech Week earlier this morning.
UK is in a Goldilocks circumstance. UK has one of the richest AI communities anywhere on the planet. The deepest thinkers, the best universities, Oxford, Cambridge, Imperial College, amazing startups, incredible thinkers in computer science, really, really excellent digital biology. Of course, the discovery of DNA was here. Incredible, incredible research community.
Bloomberg's Tom McKenzie joins us now from the London Tech Week. And Tom, we should say just right off the bat, you are soon launching a Bloomberg Tech Europe show, the perfect time to be doing this in London. What is the sort of investment that Jensen Huang is making in London, in the UK, or is this just Huang the diplomat?
Well, it's Huang the diplomat and it's Huang the salesperson as well, Danny, someone, of course, we've become familiar with. But this was and remains a real vote of confidence, I think, from the CEO of NVIDIA, who was, as you see, of course, sitting alongside the Prime Minister Keir Starmer earlier to kick off this event, attended by about 30,000 people. The reason it was a vote of confidence was because he underscored the role that he thinks the UK can play in this AI revolution, as he characterises it, because of those ingredients that the UK has around the depth of the research talent and the venture capital community. The one ingredient he says that the UK is still missing is the infrastructure. He said AI is going to be like electricity. You need the infrastructure. There's the sales pitch then from Jensen Huang. And the Prime Minister responded by saying they will be, the UK government, investing an additional £1 billion in that compute. So, of course, that would mean more GPUs, more AI accelerators from NVIDIA. What we didn't mention was that the cost of energy here in the UK is 2 to 3 times that of the US. But this is a Prime Minister as well who was leaning into this AI story unapologetically. He talked about people's concerns about AI taking jobs. He says we need to look through that. He says that he wants the UK to be an AI maker, not just an AI taker. So this was a vote of confidence, and of course it was at a bit pitch as well from Jensen Huang. They're investing, by the way, NVIDIA in their R&D centre just outside of the city of Bristol, and they've committed to investing as well to train up many in the workforce here to have the AI skills they think will be needed in the years ahead.
What a coup by Keir Starmer, not just to have Jensen Huang there in London, but also to have trade talks take place there today between the US and China. Tom, elsewhere, it is the hyperscalers that keep spending insane amounts of money, a $10 billion investment from Meta into Scale AI. What is Scale AI? What are they hoping to get from this?
Yeah, Danny, I think there's a few things that we can take away from this. Number one, Meta is not in any way walking back from those investment commitments. A little over $60 billion this year, and now it seems a portion of that will go towards Scale AI. Number two, it wants to make sure that it has a grip on the data that is so important to train these models and, of course, to inference, to ask the questions, to have the responses. It also wants to push further into defense technology. Those are my key takeaways from this potential deal. That's because Scale AI, number one, categorizes that data, so make sure that these large language models have the quality data they need to train and do the inferencing. And number two, Scale AI has already developed partnerships with the Pentagon around defense. Meta separately is pushing further into that. Now it seems with this deal they'll go even further on things like AI visualization for helmets for, of course, members of the military as well. So it's a partnership around defense, and it's a partnership that allows Meta to get its hands on that quality data that it needs. And it's a reminder that, at least for hyperscalers like Meta, that push around investment, they're not walking back on that.
Well, we have to go back to the UK, Tom, because it's not just a deal between them. It is also a deal from Qualcomm this morning, buying the UK chip firm Alphawave. What is Qualcomm hoping to get with this deal?
So Qualcomm is concerned that they're overexposed to the smartphone market, which, as you know, Danny, has been essentially plateauing. So they're looking to diversify beyond that. They're making, it seems, this bid, $2.4 billion for the listed company Alphawave, which works on solutions around networking in data centers. They've got a couple of major customers. They've been exposed a little bit to the US-China trade relations, and it seems that this is going to be a good fit. At least that's what the Qualcomm executives hope. in terms of their attempts to diversify and get more exposure to that data center story that continues, of course, to fire on all cylinders, according to the evidence we see. So that's one story. The other part of this, it's a reminder that a lot of these tech names are listed here in the UK and they cannot get the valuations they may get elsewhere. Listed AlphaWave back in 2021, it's never been able to get to that pre-IPO or post-IPO pricing on the day of the IPO. There's a premium being offered by Qualcomm about a little over 100% by the end of March 31st, but still not anywhere near that IPO pricing. So it's also a reminder of the evaluation question for tech companies listing in the UK.
Yeah, the fact you can get a deal for 96% premium and it's still not where it IPO definitely says something. Tom, thank you so much. That is Bloomberg's Tom McKenzie. And as I mentioned, if you want to get more on the latest deals and innovation in tech, don't miss Tom's new monthly show, Bloomberg Tech Europe, something you don't want to miss. It will premiere this Friday at 1:30 a.m. in New York, 6:30 a.m. in London, something absolutely worth waking up for or staying awake for if you're in New York. Now, coming up, we're going to get you set up for your trading week filled with data and auctions. That's coming up next on your Bloomberg Brief.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
This is your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for a very busy trading week. We're going to have U.S. CPI data that comes out on Wednesday, followed by PPI and jobless claims on Thursday. We're also going to have a 10-year Treasury note going on auction on Wednesday. 30-year, that goes on auction on Thursday. And, of course, don't remember that we have those trade talks today between the U.S. and China in London. Now, some individual movers. Tesla getting a downgrade from Baird. They're citing the Musk-Trump spat. Those shares lower. Intuitive Surgical, Deutsche Bank also cutting to a sell, and Robinhood, that being cut to a sell by Redburn after announcing no changes to the S&P. This is Bloomberg.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Near-term market risks are a little bit elevated. As investors, we have to trade this market.
The equity market is basically back to a high.
The market is going to need good news to continue moving higher.
In terms of the U.S. equity outlook, that's going to be about the earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, looking to take down the temperature.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points.
As the president has said himself, he has always had a very respectful relationship with President Xi of China, whom he spoke to directly last week.
So I'm very comfortable that this deal is about to be closed. It's going to be closed not with a bunch of staffers and bureaucratic language, but with handshakes.
The US and China convening in London for trade talks, both sides looking to dial back the rhetoric as equities sit just 2.3% shy of all-time highs. The economy resilient in the face of policy volatility. Heading into the latest read on inflation, the Federal Reserve entering the blackout period with the president doubling down on his push for lower interest rates.
Yeah, remember, just on Friday, and welcome back, John. It's great to have you back. Just on Friday, we got a Truth Social post from Donald Trump saying, go for a full point, rocket fuel, telling Jay Powell to really cut significantly. We do get CPI on Wednesday at a time that Friday, good economic data meant bad news for rates markets, particularly in the close-term markets, the near-term debt markets. It raises a question. How much momentum actually is in the economy at a time when you do have equities near all-time highs?
You've circled the right dates on the calendar, Wednesday, Thursday, CPI, PPI, but it's not about the data, it's about your debt supply. A 10-year bond issue, a 30-year bond issue. If you ask people this week what they'd like to see, I think the outcome of that, they'd like to see that ahead of time to get a real feel for how this week is going to go.
Let's just put this into perspective. Everyone has made fun of me for many years for focusing on the bond auctions. Everyone's joined me. They've come this way. We have made bond auctions great again. We have $39 billion of 10-year notes being sold on Wednesday. And then we have $22 billion of 30-year notes on Thursday. 2 key risk events to gauge just how much demand there is for assets that a lot of people say are very difficult to really get your hands around. It really raises a question about how much CPI data really goes into this versus some other dynamic or even some of the trade negotiations that we see going on in London right now.
So let's talk about the trade talks. Anne-Marie's over in London this morning. We'll catch up with her in just a moment. Personnel's interesting. Commerce Secretary Howard Lutnick is in the mix. It's good cop, bad cop with him and Secretary Bessent maybe. Objectives. What are the objectives for these talks this week? in London?
That's the key question. Ultimately, are you getting some sort of parameter for what the strategic decoupling is going to look like, what the contours of this relationship are going to be? Do you get a sense of just a reaffirmation of what they got in Switzerland, particularly when it comes to rare earth minerals? It really spotlights the dependence the U.S. has on China, not only for the rare earth minerals, but for the distillation of these, which is actually very difficult. That is at 90% coming from China, and it raises this question of how does the U.S. have a lot of cars at a time where they are so dependent on China for elements that really go into cars, into military equipment, into our phones.
Equity markets very close to all-time highs as these trade talks kick off in London. Equity futures this morning positive by not even 0.1%. Coming up this hour, the lineup looks like this. We'll catch up with Keith Lerner of Truist after upgrading U.S. equities, Elizabeth Economy of the Hoover Institution as the U.S. and China come to the table, and Andrew Honhorst of Citi pushing back his call for the first interest rate cut. We begin this hour with our top story. The U.S. and China set to resume trade talks today in London. Joining us on the ground is Anne-Marie. AMH, good to catch up with you. Let's talk about objectives. We know the stage is set for the US and China. What is the ultimate goal this week?
Well, Jonathan, it depends. For Washington, the objective is really to make sure that they can get access to those rare earths, those magnets that are in things like mobile phones, the high-tech and defense industries. And this is something we heard Kevin Hassett, the NEC director, talk about over the weekend. He wants to see a more advanced pace of those rare earths and magnets coming into the United States. And he said on the phone call that President Trump had with Xi Jinping, which set up the second round of talks. Remember, the first round was in Geneva just about a month ago. He said that President Trump said, let's meet somewhere, let's meet in London, and let's have a handshake when it comes to this. For Beijing, what is critical here, and you really insinuated at the top of the program there, talking about the personnel changes. There's another individual that is now going to be joining Secretary Bessent and Ambassador Jameson Greer, and that's the Commerce Secretary, Howard Lutnick. And Signum put out a note talking about the fact that now that we have Howard Lutnick at the table, this could potentially signal that President Trump is willing to ease export controls on the semiconductor industry, or potentially it's at least the White House putting that on the table. Both of these issues, for the United States rare earths and for China semiconductors, are the red lines, Jonathan, and the choke points.
Anne-Marie, just build on not just these talks, but the talks happening elsewhere and the deadline that is quickly coming up on the horizon, only several weeks away from the start of July. And once we get into July, that 90-day window, that 90-day pause, that 90-day window closes.
Absolutely. So I would say there's two tracks for different countries. The first track is for a number of countries with Reuters reported that USTR sent memos to them saying, send us your best and final deal because we want to set new tariffs rate by July 9th. They want to get these deals done. And you cannot negotiate with the dozens and dozens of countries that they have at the table. The second track are for those that are already in talks with the United States. Think of Japan, South Korea, the European Union, and Switzerland. I was actually in Switzerland last week and caught up with their top trade negotiator, who's been going back and forth between Bern, Geneva, Washington, D.C. And what she said to me is that they are on an advanced track, and what she has been given assurances by Secretary Bessent and Ambassador Greer that if they do not have a deal by July 9th, that there would be an extension. So all of this could potentially bleed into the summer for a little bit longer.
Anne-Marie, with the latest in London. Anne-Marie, thank you. The attention of financial markets worldwide on the British capital this morning as the US and China get together. Here's the view on Wall Street. Keith Lerner of Truist writing the following: markets have proven more resilient than anticipated. We are upgrading equities from less attractive to neutral. Keith joins us now for more. Keith, welcome to the program, sir. You're not alone. I've seen upgrades from Citi, from Barclays to price targets on the S&P 500. Keith, there is a belief from the likes of JP Morgan that the path of least resistance is still higher. Do you share that view?
Yeah, well, good morning. Great to be with you. Yeah, I think ultimately we will break to new highs eventually. I mean, Jonathan, as you remember, back in February, we had downgraded equities because we thought there was some complacency. You know, at the lows, the market was pricing in recession risk. We got more positive. And then on the rebound, you know, our work at the time suggested the risk reward was less favorable as recession risk was still relatively high. As our house view has changed to more of a muddle through, you know, that's why we've upgraded equities to really more of a neutral posture. But we do think there's some upside because it does show the economy has been relatively resilient once again, right? We've seen that time and time again over the last 5 years. And really, Jonathan, a couple of things changed in our work. One is the forward earning estimates for this market have started to inflect higher after moving down really since March. A lot of that is tech and communications related. So it's almost as if, Jonathan, that we were focusing on just one T, which is tariffs. Now technology is back into the forefront. I think the market is just dealing with the uncertainty around tariffs. It matters, but it's not the only thing that matters today.
Keith, you really highlighted it, this question of, is this economic resilience in the broad sense in the United States, or is this technological resilience when it comes to profit margins and the ability of big tech to keep getting some pretty incredible returns? Which is it? Which is the more dominant feature here going forward?
I think if you ask me over the next year, I think technology is still key. Listen, recession risk does matter, right? I mean, if you think about the market, when it kind of bottomed, the recession risk in the poly market was around 60%. Now that's down to 30%. So it's almost moving tick with that. So maybe the better answer is it matters both. We have to stay out of recession, and then the technology stocks need to continue to have those profit margins and move the overall earning estimates higher. Because when you look below market cap and you go beyond the large cap, you aren't seeing that same inflection in earnings in small caps, in mid caps, or even international markets. It's really driven by tech once again.
There's a question about whether the resilience of the U.S. economy pits the Fed not only against Donald Trump, but also against markets, where you have signs that, yes, the labor market is resilient, but it is certainly softening with a number of downward revisions that have a lot of people's concern. And there's a question of whether the Fed's going to remain on hold for not too long, but be de facto late to the game when it comes to how much the economy is decelerating. How much does that keep you up at night, kind of raise a headwind to some of the more bullish calls right now?
Yeah, that doesn't keep me up at night as much. I have a new puppy at home that's keeping me up at night a little bit more than the market as far as interest rates. No, see, listen, the interesting thing about the Fed is, I mean, again, they matter, but the market has been, pretty resilient, or the economy has been resilient, both when the Fed was raising rates very aggressively. So it's almost as if it does matter that they need to kind of eventually start to cut rates, but whether they do it in September or later in the year, I don't know that's the main driver. I think the main driver still is more of, can we continue to push forward on some negotiations on the tariffs? Do the earning trends still stay somewhat resilient? Do the inflation trends continue to moderate? We still think, later this year they're likely to cut rates 1 or 2 times, but we're running out of runway short term as we move, into June, and now, as you mentioned earlier, these key deadlines in July, they're likely still going to be in a holding pattern. But I don't know that's the key driver in markets today.
Keith, you alluded to this just moments ago. Do you think we can sustain a forward multiple of 21 times?
I do. I mean, obviously, at that point, though, you are embedding some good risk. So part of the reasons why we're not on offense is that if you do have some disruptions, maybe some of these trade talks don't go as well as expected, something from left field in the summer months when there's less liquidity. I mean, there is a risk. But I think basically what the market is telling you that is that this AI revolution is actually going to keep profit margins higher for longer. We still haven't seen it as much move to the 493 stocks. The other interesting point is when you look at this market, when you have pullbacks, like over the last decade, you keep bottoming at higher levels. Like we bottomed at a S&P forward PE of 19. That used to be the old peak. And then if we think about during COVID, we bottomed around 15 times. So it's interesting that each time the market pulls back, it's at a higher level. So I do think we can sustain this as long as the muddle through outlook that we have continues, and as long as that technology profits move forward, which is our baseline view. But at the same time, it's hard to say we're going to have an explosive move higher given our starting points, which are relatively rich today.
Well, we've certainly had that already, a 20% move plus from the April 8th low. It's been vicious, and for a lot of people, it's been painful who have been caught on the wrong side of all of this, Keith. JP Morgan, I mentioned some of their views to you at the start of the conversation. They believe we could see a dual equity pain trade here. Not just an equity market that keeps grinding higher, but leadership that might continue to narrow. Keith, do you think that could be the second pillar of the pain trade that could still emerge in the months to come, that broadening that people are looking for maybe just doesn't happen?
Yeah, well, we're still overweight, tech and communications, and I would say when I look at the overall technical position of the market, is only about 50% of stocks are above the 200-day moving average. So the S&P 500 is well above the 200-day moving average, but there's only about half the stocks in there. So I think that narrowing, likely makes sense. It is that growth trade. The interesting point, if we kind of zoom out a bit, yes, the market has moved up 20% off the lows. We all know, though, since after the election, the day after the election, the market is up 1%. And for technology as a whole, if you go back to July of last year, we're basically flat. So as much as we've had a lot of wide swings in the market back and forth, we really haven't gone much anywhere. And if you do break out of this trading range, that pain trade will likely continue. And I do expect that technology will continue to lead this. Technology and communications are two of our favorites as far as overweights right now.
Hey, Keith, enjoyed this. It was good to catch up, to kick off the trading week with you. Keith Lerner there of Truist on the latest and some of the bullishness out there. Hang Seng back in a bull market. Lisa, the S&P more than 20% from the April low.
Yeah, and you honed in on it. The idea of technology leading once again in that period of time. Yes, you've got the S&P up more than 20%, the bull market. You have technology, though, as a subsection up 33%. So it's definitely been led by big tech. People forgot, oh yeah, the AI revolution is underway. They were revived of those ideas, given the fact that profit margins expanded. Question is, your question about multiples and how much that changes on the backs of, guess what, bond yields and what we get with potentially the auctions as well as just generally the view on inflation going forward.
Mike Wilson of Morgan Stanley this morning. In 3 words, don't fight it. The equity market rally of the last few weeks. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the latest out of Los Angeles. California Governor Gavin Newsom is threatening to sue the Trump administration over the deployment of the National Guard to his state. Newsom describing it as an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in protests against immigration sweeps. Meanwhile, the U.S. and China are set to resume trade talks in London today following a phone call between leaders President Donald Trump and China's Xi Jinping. After reaching an understanding with Xi on resuming flows of critical minerals, Trump said he expected the London meeting to go very well. And we end with the latest on President Donald Trump's tax and spending bill. Senate Republicans appear to be shrugging off Elon Musk's criticism that the bill will add to the deficit. The Senate Finance Committee is expected to strip out some Medicaid and Medicare cuts from the House version that would have added to its cost savings. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. We'll have more on Tesla and Elon Musk a little bit later in the program. Up next, closing a deal with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed.
Up next on the program, we'll catch up with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
together a second week of gains on the S&P 500 through Friday's close this morning, this Monday morning. Good morning to you. Positive by 0.1% and just a few percentage points shy of all-time highs. Under surveillance this morning, closing a deal with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed, and it's going to be closed not with a bunch of staffers and bureaucratic language, but with handshakes. So that's the way President Trump operates.
Here's the latest this morning. The US and China resuming trade negotiations in London today. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer leading talks for the US. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, welcome back to the program. Let's talk about how this fits into the broader policy puzzle.
Yeah, hey, John, welcome back. Well, there's a lot of different objectives here at play when it comes to the administration's broader policy stance around tariffs. And you had Kevin Hassett even saying that at the moment, all of their focus is on China. He amounted it to a laser beam, and perhaps that's taken away some of the focus from the other trade negotiations that are going on. But our analysts here at Bloomberg Economics do caution that there are a few different reasons to sort of temper the expectations ahead of today. And that's because there's a lot more complex policy issues that are really at the forefront of this conversation compared to the first round of talks in Geneva, where lowering tariffs to such a significant reduction was considered to be a pretty big win. Now, we did get some positive signs over the weekend. China's Commerce Ministry did say it approved a number of export licenses for rare earth-related products. As you've been talking about, the U.S. has been accusing Beijing of essentially slow-walking these critical and rare earth minerals that are so essential to U.S. supply chains. So we're going to have to see how this ultimately shakes out, because we do know that the administration would like to see some sort of forward progress here, since at the moment it's been pretty stalled. But at the end of the day, John, we're not expecting too big of announcements to come out of it, but it's really going to show us whether or not a de-escalation could hold.
Tyler, we talked a lot about the division, internationally speaking. It's certainly the main event for financial markets this morning are the talks developing in London as they take place between the US and China. The main story in this country right now are developments on the West Coast in LA. What's the latest from the White House this morning?
Yeah, hey, so John, the White House is really trying to double down on its position that it sent in these National Guards to Los Angeles. And you even have Governor Gavin Newsom now saying that he's going to sue over the decision. It's really heightening an already fraught relationship between the administration and California's leadership. But you had President Trump this morning posting on Truth Social, doubling down, saying send in the troops. The LA police chief did say earlier that protests had started out peaceful, but conditions have really just worsened since then, becoming increasingly more violent. And also, we've seen some really stark instances of vandalism. At this point, these protests really do focus on the policy agenda when it comes to an increase in ICE immigration raids. That's really what ultimately spurred them. And John, we are getting some new statistics from the agency. They say they've ramped up their deportation raids to 2,000 arrests per day. That is lower than the White House's daily goal of 3,000 per day. That's what they're trying to ramp up to.
Tyler, thank you. Appreciate the update. Tyler Kendall there, the nation's capital, down in Washington, D.C. To build on some of that conversation, Terry Haynes of Pangea Policy. Terry, welcome back to the program, sir. Let's build on the first point on trade. Developments in London and what we can expect over the next 2 days. Terry, what is the ultimate goal for these talks?
Good morning, John, and welcome back. The ultimate goals really are to have a couple of small wins. I mean, really what you had is you had the Geneva deal, which came down to a truce. Markets immediately jumped way over their skis and decided that was that meant Trump was standing back or chickening out or whatever. When they found out that that wasn't actually the case, there was a lot of chain pulling on both sides as the United States wants access to rare earths, China to chips and a bunch of other things, jet engines maybe, and all the rest. The goal here is to have some small wins, show forward progress, markets react positively. But that does not mean that there's going to be a bigger, more comprehensive trade deal either in London or anytime soon. It also doesn't mean the geopolitical backdrop changes any way or appreciably.
Terry, as John was mentioning, we're kind of on a split screen this morning. We have the talks in London very much driving market sentiment, potentially if there is some sort of truce that can ease the way to ongoing exports. There also is a focus in LA. Could you put into perspective how unusual this whole situation is and what you're expecting in terms of how it really will ultimately come down to the court system, yet again with Gavin Newsom threatening a lawsuit as soon as this morning?
Yeah, well, it's I'm sad to say it's really not that unusual. You know, we've been through years, decades before in the 60s and the 90s, particularly, where there's been domestic unrest and combined with geopolitical tensions and trade tensions that the United States is heavily involved in and trying to deal with. So, you know, here we are at another one of these points, and at a difficult moment. Secondly, on the court stuff, I suspect Governor Newsom knows he's not likely to get serious rectification from the courts. I doubt he's looking at that, frankly. The courts are not about to interpose themselves and make themselves kind of Bigfoot the executive and make themselves the experts on what constitutes an emergency of any kind that justifies bringing in the National Guard. So, you know, I don't think that's going to happen. And the president will be, I think, in the end, can do as he wishes here.
We've been talking about U.S.-China relationships and this question of where's the off-ramp. When it comes to the situation of one of the largest states in the country and the president and this question of the face-off there, where is the de-escalation, not just from some of the protests and the violence that we saw overnight, but also when it comes to the political tensions between the governor and between the president?
Well, I don't think you're going to get a de-escalation anytime soon. I don't think, you know, I think the administration probably calibrates its responses to in future incidents based on what they're up to here. But they are and have been resolute about wanting to get their arms around illegal immigration. And you've got places like California that have held themselves out as sanctuary cities for years, which is essentially a challenge to existing United States law as it stands. So, you know, there's a tension here, and that's going to get resolved by significant federal action. I think there's probably no doubt of that. And beyond that, I think you've got a situation where those, you know, particularly in blue states and sanctuary cities and the like, places where other unrest might well happen, you're going to have a situation where there's going to be some federal presence as well, and that probably doesn't exclude even the nation's capital.
Terry, it's good to get your thoughts, as always. Terry Haynes there of Pangea Policy with the latest down in Washington, D.C. We were heading towards something like this, weren't we? We always were, between California and the White House.
It was a war of words, and we knew that it was going to escalate. There was just a question of exactly how. Now you have a situation where Gavin Newsom is saying that this is unnecessarily exacerbating some of the violence, and then there are people looking at Waymo cars on fire and saying, what did the Waymo cars do? And this just sort of emboldens the federal presence, and you have this tit for tat at a time when ultimately it's going to come back to the court system, like so many different of these clashes have done.
If you are just tuning in, just joining us, welcome to the program. Equity futures doing okay, just about unchanged. The main event in London, trade talks between the US and China. Up next on the program, we'll catch up with Elizabeth Economy of the Hoover Institution ahead of another round of trade talks. From New York City this morning, good morning to you all. You're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Some bullishness on the south side after a 20% rally off the April low. We talked about JP Morgan saying the path of least resistance is still higher. Citi with a new price target, 6,300. Mike Wilson of Morgan Stanley saying don't fight it. Equity futures this morning just about positive on the S&P 500, mostly unchanged across the board here. On the Nasdaq, we're going absolutely nowhere. 3 hours away from the cash open. Let's get you some morning movers. Let's cross over to Danny Berger with more. Hey, Danny.
Hey, John. This might be one of the things weighing on the Nasdaq this morning. It is Tesla shares falling 2.5% after already falling some 15% last week. This time, the ignition for the fall is Baird. Strategists over there downgrading the stock to neutral from overweight, saying, one, the fundamentals aren't reflected in the price. So they're too far reflected. There's too much optimism in things like robo-taxi in the stock price, but also just saying that the Musk and Trump fallout, that spat injects uncertainty into the shares, which is, of course, why they fell last week. So lower this morning. Meanwhile, also to the downside, AppLovin and Robinhood. Now, these are two stocks that the expectation had been that they would be added to the S&P 500. That brings a lot of passive flows with it, so investors like to front run them. Well, bad news for them. After the market closed on Friday, we learned that S&P Dow Jones would be making no changes to the S&P 500. It is, of course, their discretion what gets added and what gets subtracted, so those shares both falling more than 5%. Finally, some also action late Friday. Trump signing an executive order to try to ignite the production of U.S. drones. There's also some safety measures also put in there trying to combat things like our adversaries flying drones in America. So with that incentive, you got a lot of the air mobility companies really rallying this morning. Archer Aviation, Joby Aviation, Vertical Aerospace, all of those gaining at least 8% this morning, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, our top story, the US and China looking to dial down the rhetoric. Representatives convening in London for trade talks with the focus on rare earth minerals and chip export curbs.
I think Terry Haynes nailed it. It's unclear exactly what the motivation is on either side to come to some sort of comprehensive trade deal, certainly not during these talks in London. What is clear is that both countries are completely reliant on each other for specific things. China reliant on the United States for certain chips that are related to AI and all sorts of different technological expertise, and the U.S. to rare earth minerals. There are absolutely everything technological that we use, so it raises a question: how do you have strategic decoupling at a time where these two economies are intricately intertwined and dependent on one another for key resources? And that's the reason why people are looking for some sort of truce. What that leads to, still very unclear.
The trade data was really interesting overnight. Exports out of China to the US falling the most since 2020. Total exports still rising almost 5% from a year ago, slower than the 6% growth economists had expected. But the broader story, let's get into the broader story here. Look at exports to Vietnam from China, up 22%. When Secretary Bessent sits down with the Chinese, Secretary Bessent is making the argument that economists have made about China for years, if not the last decade or so, which is you need to rebalance away from foreign demand to internal demand, do something about domestic consumption. And based on the numbers we've seen out of China and that economy over the last several months, we've seen no sign of that rebalancing taking place.
Not only have you seen exports increase dramatically to certain countries, albeit declining pretty significantly to the United States, you've seen deflation, outright deflation in the country, which suggests actually the opposite, that personal consumption is not picking up in any kind of material way. And ultimately, China is leaning into the one engine that they've been able to rely on, which is production and manufacturing, and it has to go somewhere. You're right. And this has been a question, especially if China's going to be exporting to countries that are going to export to the United States, which has been what's been going on. How do you get some sort of coalition of countries to demand some kind of different practice where you don't just have different countries that act as intermediaries for China to then export to the U.S., to elsewhere? That's, I think, what's lacking. What is the overarching strategic plan to get some sort of coalition of countries together to really create a new structure that is feasible for all?
I remember when Larry Kudlow, the former National Economic Council director, used to talk about precisely the same thing. Europe has been reluctant to jump on board and get in line with the US for a long time, and I see little sign of that taking place as things stand this morning.
Yeah, there are even questions about the idea of a Chinese embassy so close to intelligence in London, because that would raise some questions about intelligence sharing with the U.S. Part of this is because Europe doesn't speak with one voice. They say they speak with one voice, but as we've had conversations with a number of the trade ministers, that's been a real issue, and I think will be ongoing.
Speak to Spain, you get a very different view on things. Speak to Italy, a very different view as well. I want to turn back to a big story here in the United States, a fourth day of anti-deportation protests in Los Angeles. President Trump deploying the National Guard, sparking a feud with the governor. Newsom calling it an unlawful deployment.
And he did talk about potentially filing suit as soon as this morning, taking this back to even as high as the Supreme Court, ongoing questions around state rights versus federal rights. If you take a step back, it's important to realize that there are 1.8 million undocumented migrants in California. It's the biggest state harboring a lot of people who are not necessarily carrying legal status, and it raises a question about how far this government will be willing to go on the federal side and how far states are willing to go on the opposite side at a time where there's an increasing battle between Gavin Newsom and Donald Trump, as they are seen somewhat as political adversaries.
Is it about policies or personalities?
Great question. I don't know.
That's always the issue, isn't it? We'll keep tracking the headlines for you and bring you any updates when we have them. Let's turn back to our top story for Wall Street. President Trump saying he expects talks between the US and China to go very well after his phone call with China's Xi just last week. Elizabeth Economy of the Hoover Institution joins us now for more. Elizabeth, welcome back to this program. It's always good to hear your thoughts on a very sensitive issue. There's a phrase that you've used, strategic decoupling. Can we begin with that phrase? What does that phrase mean to you? And ultimately, with that in mind, what's the purpose of these talks in London?
So I think strategic decoupling basically refers to the fact that both countries have identified the other as their most significant long-term strategic challenge, and each sees it as in its interest to begin to reduce its dependency on the other in terms of trade and investment. I think this is a process that's been underway certainly from the Chinese perspective for a number of years. We've seen with their Made in China 2025 program, right, the effort to reduce dependency across 10 critical cutting-edge areas of technology to ensure that Chinese companies dominate not only domestically but also become global champions. And I think beginning with the Biden administration in the post-COVID period, a sense that the United States is too reliant on China for a number of products, of goods that we need for our human security. That was the personal protective equipment, but also, as we see today, things like rare earth elements. And so I think that's the broader sort of strategic context for what we see taking place. In terms of what that means today, in terms of these discussions, I think the reason that we see the two sides coming together at this moment in the sort of middle or early stages of the 90-day pause on the tariffs is that we've seen from the Chinese perspective, the United States put export controls on the Huawei Ascend chips, on computer design software, and of course this big move on the visa revocations for Chinese students. So they view the United States as having not upheld the spirit of the sort of initial trade discussions that were held last month. From the U.S. perspective, of course, what we're concerned about in the moment is the sort of toughening export licenses on rare earth elements. The Chinese, it was our understanding that the Chinese would lift these licensing restrictions after the first set of negotiations, that didn't happen. And so that's why both sides are now at the table.
This certainly feels a lot more complicated than it did in the president's first term. In the president's first term, a lot of these issues could just be addressed with purchase agreements. We've heard them talk about those purchase agreements, but I just wonder this time in your mind whether you believe these can be addressed, can be pushed to one side with just a simple purchase agreement and a narrowing of the trade balance, or at least a commitment to do that.
Well, I think, we saw in terms of the president's first deal with the UK, that, in large part, that's what it amounted to. I think for China, of course, there are other issues tied to economic and national security that will continue to be irritants in the relationship. But I believe that for President Trump, that significant new purchases by the Chinese would at least go some way to addressing his concerns around the bilateral trade deficit, which is, of course, at least initially what impelled impelled this global sort of set of tariffs. So I think that they could make some progress if they were to announce, big new purchases. But I think you're right that it wouldn't solve what's really at the heart of the challenge here.
And Elizabeth, there's been this discussion around how much incentive China really has to make some sort of agreement, to come to some sort of resolution or have some sort of purchase arrangement with the United States, given the fact that President Xi Jinping seems to be doubling down in a pretty significant way and willing for the economy to slow as long as there are certain strategic goals that are achieved over not necessarily the next year or two, but 10 years. How much do you feel like the leverage has shifted, that the desires have shifted here?
Yeah, I think it's a really important point. I think the United States miscalculated at the outset when it believed that we had so much more economic leverage over China because, as Secretary Bessent said, we import 5 times as much from China as China imports from the United States. But that ignored, I think, 2 things. Number one, that China has spent the past 8 years reducing its trade dependence on the United States. Since pre-COVID levels, the share of exports, global exports from China to the United States has reduced from 19% to 14%. And so I think that's one important element of it. The second is, as you suggested, in your discussion earlier, China has been routing exports to the United States through third countries, right? So it's still seeing, an ability, a path through to maintain its exports to the United States. And it ignored the fact that we have a greater sole source dependency on goods from China than China does from us. What that means is that for roughly 30% of the goods that we import from China, we have a 70% dependency or more on China. China doesn't face that same sole source dependency on a wide array of U.S. goods. So I think we miscalculated at the outset. China has been thinking strategically about how to reduce its dependence on the U.S. market, for 5 to 8 years, really since the first Trump administration. And so I think that the leverage has shifted over the past 5 to 7 years.
So that said, Elizabeth, overnight we saw data that showed deflation for a 4th straight month in China. You have a price war with BYD that has gotten the attention of authorities in China, worried about cannibalization from their own market, and this idea that there's going to be a race to the bottom when it comes to electric vehicles, and really sort of undermining the perceived quality internationally. How much structurally, though, do they have a challenge that forces them to the table to ultimately come to some sort of even stopgap measure that could last a couple of years with the U.S.?
I think, look, China has been facing these challenges, the ones that you just suggested, for a couple of years now. This deflation issue is not actually new. The sort of incredible competition in many industries just within China, again, is not new. It's part of the process that they undergo every time they have this, overinvestment in certain industries. We saw it in solar panels and wind turbines. Now we're seeing it in EVs. We could see it in batteries moving forward. I think that's why we see the exports, right? And what China's doing now with the EVs is looking not just to the United States or to Europe, but they're looking to Africa, to Southeast Asia, to Latin America. They can export, very cheap cars there. They're looking to build manufacturing capacity in those countries. So China's looking globally, not simply at the wealthiest markets for their goods. And I think this is part of a long-term strategic plan. And I think they're trying to bet that, they can endure this short-term pain for a kind of longer period of strategic and economic gain. That being said, they have tried to do and take a number of actions over the past year to boost consumer confidence. They've had these massive goods trade-in programs. They've done things in the real estate market to encourage people to start buying property again. But overall, they're not willing to take the steps that are actually necessary, which is to move investment away from investment in technology, investment in military, into education and health, and into the pension system, so that people and consumers feel confident that they can spend because their other basic needs are being taken care of.
Elizabeth, you're one of the best, and it's good to get some time with you this morning. We appreciate it. Elizabeth Economy there of the Hoover Institution. Just that last part I think is so important. You followed this in Latin America as well. China for a long, long time has spent a lot of resources building up diplomatic relationships, not just in Latin America, but across Africa too.
Yeah, it was just shocking in Peru when I was down there in Lima, this idea that Xi Jinping came there to welcome the opening of a new port. And the streets were closed off and the Chinese flags were all over, and they were really making themselves known. And every corporate executive there said, money talks, and that's the reason why we have relationships with China. Where is the U.S.? And the U.S. was nowhere to be seen.
Trade talks kicking off between the U.S. and China in London, in the British capital. Anne-Marie will catch up with her again in about 15 minutes' time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Israeli forces intercepted a ship trying to reach Gaza that was carrying activists, including climate advocate Greta Thunberg. The group said in a statement that its vessel carrying aid was forcibly intercepted in international waters and that its crew was abducted and the cargo was confiscated. Meanwhile, Meta is in talks to make a multi-billion-dollar investment in artificial intelligence startup Scale AI. Sources telling us here at Bloomberg the investment could exceed $10 billion, which would make it Meta's largest external investment in AI yet. Scale AI provides data labeling services to help companies train machine learning models. And as Lisa just mentioned, a price war in China's electric vehicle industry is sending share prices tumbling and sparking intervention from the Chinese government. The industry is facing widespread demand weakness and extreme overcapacity. Authorities are trying to minimize the fallout, but prior attempts to intervene have had little success. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. Up next on the program, rate cut bets looking challenged.
The direction of travel here will be in an environment where the Fed and the market are going to start to price in zero cuts for this year. Maybe towards the back half of 2026, they can cut one or two more times. The uncertainty is likely to fade to some extent.
Andrew Honhorst of Citi making a move. We'll get you an update on that in just a second. From New York City, this is Bloomberg.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting this. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. With all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs
are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The economic data in focus this week. Important couple of days coming up in the middle of the week. Wednesday, Thursday. Wednesday, CPI. Thursday, PPI. Into all of that, equity futures just about unchanged to kick off the trading week. Equity futures on the S&P go nowhere. Likewise on the Nasdaq 100. Under surveillance this morning, rate cut bets are looking challenged.
The direction of travel here will be in an environment where the Fed and the market are going to start to price in zero cuts for this year. Maybe towards the back half of 2026, they can cut one or two more times. I'm surprised that the market is still looking for two cuts at this point. There's still the chance that the economy tips into recession as a result. The uncertainty is likely to fade to some extent. Our medium-term outlook is the economy should be fine.
So here's the latest this morning. Investors pushing back on rate cut bets. Andrew Hornhorst of Citi pushing his Fed rate cut forecast to September from July, writing, "We continue to expect the Fed to cut policy rates more aggressively than what the market is pricing." Andrew joined us now for more. Andrew, good morning.
Morning.
Let's start with the timing. So you pushed back from June to July, and now from July to September. What's not going your way?
The labor market data is what just hasn't given the Fed that clear signal that they need to be cutting. And I think that's what's difficult here is that we see the signs in various data that they will be cutting eventually, but when that time is that they're actually going to make that first cut, they're going to have to see the unemployment rate move higher. It rounded to 4.2%. That's going to be enough to keep them on hold.
So you've lost confidence on the timing, but maintained confidence on the degree to which we will get a response from them, which will be much more aggressive than the market is priced for. Why are you maintaining that confidence?
I think it's not that hard to get there if you look at things like the Fed Beige Book. Now, I know that the Fed is looking at the hard data. They're going to wait until they see that in the hard data. If you read the Fed Beige Book, it said the economy is contracting and employment was unchanged over the intermediate time period. So we're not hiring people. We have an economy that maybe contracting according to the Beige Book, at least slowing down significantly. Housing sector that's in contraction. So I think there's a lot of signs out there that we will see weaker data. You have to actually see that in the data, though, before the Fed's going to move.
It feels like a Rorschach test. It is so difficult to get your head around. Yesterday, the data came out, or on Friday, yes, it feels like yesterday. The data came out, and it was better than expected. Yay, people are looking at this. Not a bad number in this. People take more time to look at it. Lots of bad numbers in this, in particular, the 2-month revision downward of 95,000, and the idea that the household survey lost over 600,000 jobs. There is this feeling that the economy, that the labor market is contracting, as you said. At what point do you think that it's going to be evident enough in the data? Do you feel like that's coming soon, or do you feel like that's been what's been delayed?
I think that is what's been delayed. I think it is coming in the next few months. We know that this has been a very uncomfortable labor market where we've had a low hiring rate. We're starting to see in the weekly data, and that's what I would be watching here, continuing jobless claims. Those continuing jobless claims are starting to rise. So we don't have a big increase in initial jobless claims. People aren't being laid off from their jobs. But when people are out of work, they're finding it hard to get back into work. That's why the continuing claims are rising. that should mean the unemployment rate rises. We saw something very similar last summer, and if you remember September, we got that 50 basis point cut. So I think we're kind of in a similar dynamic to what we saw last year, probably a couple months before you get the Fed move.
It also raises a question of which rate is more important to watch. We're talking about the Fed funds rate, the one rate that the Fed has control over, at the same time that there are real question marks over 10-year, over 30-year treasuries, the auctions that are coming up in the remainder of the week on Wednesday and Thursday. How much do you think that weaker growth infers lower rates substantially on the longer end, which is sort of key to stimulating the economy in any kind of real way in a downturn?
Yeah, so that's a new challenge for the Fed, that sometimes when we're getting weaker data now, we're seeing the equity market sell off, and usually you would think that would mean the Treasury market would rally and yields would move lower, but we've had this phenomenon where sometimes the Treasury market sells off and we actually get higher yields, and that's an issue for the Fed because we can have lower growth now and higher yields in the long end. I mentioned the housing market, mortgage rates that have stayed higher. You really need to see those mortgage rates come down, I think, to get the housing market expanding again. It is contracting now, and what can do that now is the Fed cutting rates. So it's just another reason that the Fed, I think, is going to have to cut. They're not going to look at that 10-year yield and say we're reacting directly to the 10-year yield, but indirectly they're going to see it in the data, and that's going to lead them to react.
Just a bit on Lisa's questioning, though. They did cut 100 basis points, and the long end sold off. So basically, they cut interest rates and mortgage rates went up. And it's a belief that when they did cut, they weren't committed to anchoring inflation expectations. So no surprise this time around. What are they all saying? The core of the Federal Reserve, every single speech, the chairman, over and over again, committed to anchoring inflation expectations, which raises the question about your ultimate call. Can they move fast and decisively to respond to a downturn in the economy, and at the same time cover themselves about anchoring inflation expectations?
Yeah, it is a big challenge here, and it really depends on the measure of inflation expectations that you look at, how worried you are about those de-anchoring. If you look at University of Michigan survey, for instance, we've had a big move higher in the inflation expectations. Other surveys, not so much. I think what they need to do is really focus on the fundamentals here. And this focus on inflation, I think, is fighting the battle of 2 or 3 years ago. That was a time when the Fed thought that inflation was going to be transitory. It turned out to be persistent. What we have now is house prices that are moving down. This is not an economy that is just too full of demand with supply constraints and you get really high inflation. That's what happened a couple of years ago. I think this is an economy where we actually have demand that's cooling. That means we're not going to get a lot of inflationary pressure. That means they can look through if we have a one-time price level increase.
Governor Waller's making a similar argument. It's a convincing one. How lonely is Governor Waller on the FOMC?
I think pretty lonely right now. I'd like to give him some company. I agree with the point that he's making, but again, I think that's why you have to see this so clearly in the activity data, which kind of means that the Fed is going to wait longer than they usually would before they cut, because they want this really clear signal from the labor market because they're worried about inflation.
They've talked about September. John Williams of the New York Fed has talked about September. I wonder if September is still too soon.
Well, it depends on the data and whether you get some sort of reflection there. I mean, Peter Scheer of Academy Securities was making the argument that if they really wanted to cut, they could have even looked at the non-farm payrolls report that we got on Friday and made an argument to cut. Right now, to Andrew's point, there is a fear that the runaway inflation that they failed to stave off immediately is going to be something that's repeated, and they don't want to do that, so they're going to have to lean into inflation, and Wednesday's CPI print is going to be really important on that front.
Things are super finely balanced. If NFP was bad on Friday, because the rest of the week's data wasn't great at all,
right.
NFP was bad on Friday, we'd be having a very different conversation this Monday morning.
Yeah, and probably President Trump would have more company with his 1 percentage point rate cut, rocket fuel to an otherwise pretty solid economy.
Andrew, it's good to see you. Thanks for the update. Andrew Hoddenhorst there of Citi. Up next, Abby Yoder of JP Morgan, former senior Trump trade advisor Kellyanne Shaw, Francisco Blanche of Bank of America, and Wei Li of BlackRock. From New York, the second hour of Bloomberg Surveillance. Next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The economy is going to be largely okay.
The economy slows, but doesn't tip over into recession.
What we're seeing is kind of just a natural maturation of the cycle.
The Fed's in a good spot here to wait and see.
The Fed, corporate America, everybody is kind of in this wait and see mode.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your price action, your scores are shaping up as follows. On the S&P 500, just about unchanged, following a 20% rally off the April low. We're just 2.3% shy of all-time highs. Unchanged on the NASDAQ 100. We may not be unchanged later in the week. Your week ahead shaping up as follows. Look at this. CPI Wednesday, PPI Thursday. I'll throw two more things out there. 10-year debt auction Wednesday, 30-year supply on Thursday. It's going to be in focus big time for this market.
Yeah, especially because of the conversation we were just having with Andrew Hollenhorst. Is this time different than when we saw the Federal Reserve cut rates by a percentage point and the long end of the yield curve actually sold off? You saw yields rise. And this question of how much control does the Fed have and how much are they getting ahead of inflation expectations at a time where there still is a real debate. How inflationary will some of these tariffs be? Ultimately, we are going to get a read on whether there has been some sort of pass-through, and the expectation we'll see a little bit of it in CPI. But so many question marks remain about how this market is going to digest that amid a host of other trends that are happening in the underlying economy.
To give you a read on the south side at the moment, bullishness, seeing tons of that over the last few days. I talked about JP Morgan, the path of least resistance is higher. Mike Wilson of Morgan Stanley this morning, don't fight it. He calls out I think a few words that you've been thinking about too. Near-term risk, tied to guess what? Interest rates.
And that's the reason why people are watching the economic data. A lot of people, including Citigroup, upgrading their forecast for the S&P, and this is largely because of artificial intelligence and this memory that suddenly, oh yes, this was the revolution that was powering everything, and guess what? They just delivered really great earnings, and we've got positive earnings revisions. This is a good thing. On the bond market side, a real question of how much there could be a rally there too. That said, over the weekend, Morgan Stanley's Matthew Hornback came out and said that he actually expects within the next year 10-year yields to fall underneath 3.5%. There are a number of different strategists coming out and saying this time is different. RBC saying they would be cautiously adding after an NFP payrolls print on Friday that wasn't that great when you peek under the hood.
There's a man in the Treasury Department that hopes that Matt Hornback is right. I could tell you the man in the Treasury Department, Secretary Besant, is in London this morning. We'll catch up with Anne-Marie in just a moment. In London for trade talks with the Chinese. What is the ultimate goal of this round of trade talks with the Chinese delegation?
It seems when you take a step back, for the U.S. to get rare earth minerals, mainly magnets for certain high-tech elements, and for China to get access to chips. Right now, it's to just soften the ties to keep the two economies running. It doesn't seem like the goals are that much higher than that. It's almost going back to what they agreed to in Switzerland and saying, can we get back to that? A real question, though, of how this fits into some sort of larger negotiation at a time where the U.S. has come out and said they want strategic decoupling in these key areas that they cannot decouple because they still are so intricately intertwined.
It makes it difficult to make a deal in London this time around. We'll focus on those talks in just a moment. Equity futures positive by close to 1/10%. Coming up this hour, we'll catch up with Abby Yoder of JP Morgan with stocks back near all-time highs. We'll speak to the former senior Trump trade advisor Kellyanne Shaw on trade talks in London, and Waitlist of BlackRock on the potential impact of trade uncertainty on global growth. We begin this hour with our top story. US-China trade talks in London with both sides looking to take down the temperature. Joining us now from London is Anne-Marie. AMH, can they take down the temperature? How easy will it be this time around?
Well, they're certainly going to try, Jonathan, and welcome back. It's nice to see you. Basically, this does look to seem to be an easier discussion given the fact that we did have that call between President Trump and Xi Jinping, which really broke the ice. What we want to see from these two, what they want to see in these discussions, is to go back to what they agreed upon just a month ago in Geneva. As Lisa just mentioned, for the United States, it's being able to get their hands on the critical minerals, the rare earths, the magnets used in things like mobile phones, high-tech industry, the defense industry, and they feel like those exports, those licenses have really been slow-rolled. We heard from Kevin Hassett over the weekend. He says they want to see a quicker pace about getting those goods and materials into the United States. When it comes to Beijing, this is going to be about potentially easing of restrictions when it comes to export controls on semiconductors, which of course is interesting because at these talks, who we didn't have in Geneva is Secretary Howard Lutnick, the individual at the Commerce Department who will decide whether or not and in charge of those export controls. So potentially this is a signal that for President Trump, that is on the table. So for both these economies, these are the two red lines and these are the choke points. Critical minerals for the United States, Jonathan, and chips for China.
Anne-Marie, how much is this just going back to the table saying, can we shake hands again and rewind the time frame to back in May versus offering some sweeteners, particularly on the U.S. side to China to get particularly those rare earth minerals flowing back into the United States?
Well, it's a great question because it does feel like what they're trying to do is at least get to the Geneva Agreement in principle, in actuality, in reality on the ground to make sure they can get those export controls lifted for China and for the United States to make sure they can get those rare earths. I also think, given the fact that we did have this phone call between President Trump and Xi Jinping, potentially there could be another announcement on the call. We do know that President Xi Jinping invited Trump to come to China. Potentially, we can get discussions or read the tea leaves of maybe a meeting between these two leaders, and this discussion here in London can open that up. But overall, what is key to watch out for in this discussion is exactly what we watched out for a month ago, which makes it so difficult because it is red lines for both of these economies, especially for the United States. They want to make sure that China doesn't have access to the semiconductors and the chips. And that is China's big leverage when it comes to whether or not they're going to increase the pace of giving the United States those rare earths and magnets.
Anne-Marie, appreciate the update. Anne-Marie tracking the story for us out of the British capital in London this morning. Here's the view on Wall Street here in New York. Abby Yoder of JP Morgan Global Wealth Management writing this. The longer tariff implementation gets pushed out, the more likely we'll have to raise S&P 25 EPS growth. The longer implementation gets pushed out, the greater likelihood corporate America can mitigate the tariff's impact. Abby joins us now for more. Abby, good morning.
Good morning.
How much of that have we already priced, given we've had a 20% move off the April low?
Well, so I think there are a couple of things, and when you were talking to Anne-Marie, I was thinking about this. Like, because you were saying, oh, is there this move to de-escalation, right? Like there isn't this thought process that they're going to go into these conversations and we're going to come out with like a higher effective tariff rate, right? So I think that's important, right? Like the tail risk that was there when we had, Liberation Day and it was north of 25% implementation or effective tariff rate, like that's kind of off the table, right? And this is becoming, as you mentioned, like, and in your conversation with Anne-Marie, like a much more sector-specific conversation, right? And as the market starts to realize that, I think that becomes where you see more of a bull case. And I also think, look, there was a lot of de-risking heading into Liberation Day. I don't think, positioning is back where, like near all-time highs. I think there's still a lot of length that can be added there.
So things are better than April, but they're worse than January. And if they're worse than January, what's changed since the start of the year?
I think what has changed is, one, DeepSeek doesn't seem to be as big of a deal for the AI complex in the United States as it was originally thought, like heading into earnings season, right? Like you mentioned earlier, we've seen really strong results this Q1, and guidance was really good, right? And I think the other thing is yes, the economic backdrop has changed, but also what we've heard from, like, let's say outside of the AI complex in terms of earnings is that companies are really thinking about how to mitigate and how to work through what is actually a much more complicated backdrop, but we have to give them credit, right? Like the last 5 years were really, really difficult. 5 or 7 years, whatever it may be, has been really difficult, and there are levers that they can pull, and it seems like they're really doing that. And then you add on top of that the fact that corporations are starting to really implement AI, which is from like a revenue standpoint, like an expense standpoint, is all positive from a margin story as well.
I just keep hearing in my head, the stock market is not the economy. The stock market is not the economy. And it feels like the divergence between the two is getting wider, especially as artificial intelligence is powering a lot of the optimism that we see with respect to the S&P 500 and certainly NASDAQ. How much is that ultimately your base case that you end up, to John's point earlier, with much narrower leadership going forward, an economy that's not doing great, but a U.S. stock market that can keep outperforming based on the performance of just a small handful of companies?
Yeah, I mean, I think that's the risk, right? Like if we think back a year ago, the concern from a lot of investors was this concentration risk. Like I could totally see that coming back into play, right? Because you do have this leadership. But I think, again, when we're thinking about like a year from now, what really drives like a more bullish scenario is, again, not just like the AI and tech companies that are implementing AI, but that it gets implemented across what would be the other sectors of the economy or the market, and therefore like, leading to revenue upside and expense savings across the board, which is a more bullish scenario.
If you end up with a pushing back of some of these tariffs at the same time that a U.S. economy is still strong enough to absorb some of these price increases, how much does that increase the inflation risk, actually? That a slow grind of tariffs that are implemented with companies that can adapt and adjust and consumers that can absorb it because they're getting paid lead to something that is more protracted and leads to a higher rate environment for a longer period of time?
Well, so I do think interest rates are the biggest risk, right? Like I think if you do see a material move from where it seems like the market can handle that 4.5%, but like if we see a meaningful and quick move higher, I think that would be, burdensome for the equity market from a valuation perspective. But I think like there isn't one option, right? There's not like companies are like, we have to pass on price, right? Depending on the size of the company and the supply chain logistics, like they can go to their suppliers, negotiate there, they can take some price and hit the margin a little bit, but if you're implementing AI, that kind of offsets that, right? So that's what we're talking about when we're thinking about all these different levers, and the longer that these companies have to think about those levers and implement them, the better outcome, I think, in terms from an earnings perspective.
On the equity side, I hear a lot of people worried about the prospect of higher interest rates.
Yes.
I don't hear enough of the following, which is that the 30-year rate is still close to 5, and the data hasn't been great.
Yeah.
The data arguably doesn't justify 30-year yields near 5%. It looks like trend growth has dropped down from 2. It looks like the call for growth, at least for 25, has come down from 2.5, down to like 1, and maybe threatening to be even lower than that. Do you not look at that situation and equally say that's concerning, that we're hanging out at 5 on 30s and the data doesn't really justify it?
Absolutely, and I think especially also if you look at interest rate differentials, it doesn't suggest that it should be where it is. But I think that tells you there's a lot of term premium in interest rates and what we're looking at, and it isn't necessarily in control of the Fed on the longer end, right? That's why why we're a little bit more positive in the belly and the shorter end of the curve, just because you can see that's going to be more influenced by the Fed. But I think what you're looking at the longer end is concerns around what's happening with the fiscal deficit, right? And I don't think that's really necessarily going away anytime soon. But the way that you longer term see that come down is, again, you see that productivity enhancement that therefore offsets that inflationary dynamic, and then you can probably start to see those rates come down.
How much is this, though, a challenge to sustaining a multiple of 21 times forward earnings?
I think, well, so I think interest rates are a big risk, and, you know, so the longer that they're high, right, the more restrictive it is. Like, remember when back in 2022, 2023, when we were talking about, oh, you know, Fed policy works with a lag? Like, that is definitely the case right now, and we're in a very different labor market as well. So I think that is the main risk, right, that you see them, like, hang out where they are now. But our view, you know, we don't see them coming down materially, but we see the 10-year, you know, at 4.3 at the end of the year. So that's some reprieve there.
Close to 450 right now. Abby, good to see you.
Good to see you.
Thanks for catching up with us. Abby Yoder there of JP Morgan Global Wealth Management. Yields this morning down about a basis point or two. The focus will be on the long end of the yield curve later on this week, Wednesday, Thursday, 10s and 30s.
And it's quite a split screen when you get CPI and PPI, and then you get a 10-year and a 30-year Treasury auction. How related will they be to this idea that inflation is ticking up at a time when a lot of economists say it's very hard to understand how sticky that inflation really is going to be?
Equities ticking up this morning, close to a move of 0.1%. Thrilling stuff this Monday morning. Let's get you an update on stories elsewhere this morning, including an update on some big news from Warner Brothers in just a moment. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. We start with California Governor Gavin Newsom threatening to sue the Trump administration over the deployment of the National Guard, describing it as an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in protests against immigration sweeps. Meanwhile, the talks between the U.S. and China come as the latest data shows Chinese exports had their worst drop in more than 5 years. Shipments to America fell by 34%, despite the agreement reached in May that gave temporary tariff relief to imports from China. Overall, China's export growth slowed to 44.8% from a year ago, missing estimates. And on that news you just mentioned, John, Warner Brothers Discovery is splitting itself into two publicly traded companies. It will separate its HBO Max streaming service, movie studio, and TV production business from its cable networks. The move effectively undoes the Warner Media and Discovery Communications 2022 merger. Shares were halted earlier due to volatility, but will resume trading around 7:30. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. We'll be tracking that story for you throughout this morning. Up next on the program, diffusing tensions with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, you know, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed.
Up next on the program, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw. Live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Kickstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Live from New York City this morning. Good morning and welcome to the program. Equity futures just turning a little bit higher, up by 0.1% on the S&P. On the Nasdaq 100 this morning, just about unchanged. Under surveillance this morning, diffusing tensions with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. We want the rare earths, the magnets that are crucial for cell phones and everything else to flow just as they did before the beginning of April. So I'm very comfortable that this deal is about to be closed, and it's going to be closed not with a bunch of staffers and bureaucratic language, but with handshake.
Here's the latest this morning. The US and China holding trade talks in London. China's vice chair meeting with Treasury Secretary Scott Bessent, the Commerce Secretary Howard Lutnick, and Trade Representative Jameson Greer. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, last time around these talks took place in Geneva, and there was a clear objective. Tariffs were just ridiculously high. They were close to 150%, and the president wanted to see them come down, China too, so they could have talks. What's the objective in London?
Yeah, hey, John. So there's a few different ones, but as Bloomberg Economics cautions, we should probably temper our expectations because, like you're saying, there's not that same sort of low-hanging fruit, such as lowering tariffs significantly, that would be considered to be a victory. We know both sides are going to be focused on export controls as these countries have put restrictions on products that are so essential to each other's supply chains, with China raising concerns about new AI chip curbs, for example, and the U.S., of course, wanting to see a speeding up of those export licenses when it comes to critical and rare earth minerals. So really the objective is going to be to try to keep the tensions down. We also can't forget in these conversations that fentanyl is also part of them. About 20% of the tariffs that are currently levied are tied to the U.S.'s concerns when it comes to that. The thing is that the White House really does have perhaps a bigger motivating factor here to try to get some sort of progress moved along, because the White House is hoping for a confluence of their economic policies to materialize over the summer. But the thing is that they put some pretty ambitious timelines on all of that, passing the reconciliation package by July 4th, the so-called reciprocal tariff negotiations with other trading partners by July 9th, and then China ultimately by the end, or by perhaps the beginning of August. And John, as you well know, the last time that they negotiated under the first Trump administration, it took 18 months to ultimately get to a deal. But this time negotiators have only given themselves a 3-month reprieve.
Tyler, just quickly, do we expect some sort of announcement from this meeting that could be when President Trump plans to visit China?
Well, that's definitely something that we're going to be closely watching. It's something that this White House would like to see some sort of forward progress on this. As you well know, President Trump has said that he has accepted this invitation to go to China, and it's something that actually our reporting had indicated that they wanted to see happen in June, of course, now. Now, of course, that's likely not to happen as these tensions have really escalated and the trade tracks have gone a little bit off course than what was originally anticipated by this White House.
Tyler, with the latest in Washington. Tyler, thank you. To build on the conversation, the former senior Trump trade advisor, Kellyanne Shaw, joins us now for more. Kellyanne, welcome back to the program. What went wrong after Geneva?
Yeah, good morning. Thanks so much for having me. I do agree that the focus of today's meetings in London is going to be about clarifying what was agreed in Geneva and figuring out a way to have the United States and China both feel like the other side is complying. Now, in terms of what may have happened, where the breakdown in communication was, there are two schools of thought. thoughts. One school of thought is that when you're negotiating these things, sometimes there's a bit of constructive ambiguity. There's not quite that meeting of the minds that you might think there is. But we do have a document that was issued by the Chinese and U.S. government that says China will remove its countermeasures, which were imposed in retaliation for those April 2nd reciprocal tariffs and counter tariffs. And so the U.S. interpreted that as clearly not just the companies that were put on the UEL, but also the licensing for some of these rare earth magnets and critical minerals. And China's saying it didn't agree to that. So that's what today is about. It's about clarifying that, and I think that we'll have a final answer in just a few hours.
The personnel is slightly different. Last time around leading these talks from the US delegation side was Besson and Greer. This time it's Besson, Greer and Lutnick. How much would you read into the presence of the Commerce Secretary at this round of talks?
Yeah, well, clearly export controls are on the mind of not just the U.S. government, but also the Chinese government, who has been arguing that subsequent export controls issued by the United States about Huawei's Ascend chips, about energy products, EDA software, that those all also violate the Geneva Agreement. And so what I'm going to be watching for is to see whether or not the United States lifts some of those export controls in exchange for China complying with export licensing for critical minerals and rare earth magnets, or whether they don't. Because what is not sustainable is a commitment by the United States to never impose an export control involving a Chinese company or technology again. That is not going to be consistent with the direction that the president is going in terms of some of these more strategic and technical sectors. And so they're going to have to figure out a way forward, like what is going to derail future discussions versus what is not. And the Commerce Secretary's presence, I do think, indicates that there may be some flexibility on the U.S. side, at least about some of these informed letters that were issued for energy and EDA.
You think that you have this sort of range of potential conflicts, and then it gets widened at every single step, it feels like. How much do student visa restrictions fit into this? How much do other kind of measures that the U.S. has taken since that Geneva Agreement also potentially weigh into these discussions?
Yeah, and there's nothing simple about the U.S.-China relationship, right? These are the two largest economies on Earth that have a number of challenges with one another that go far beyond economics and trade and involve national security and some of these other issues. Now, where I think the economic advisors on Trump's team are going to be is that we're here to talk about these economic and trade issues. I don't expect to see an announcement on the student visas, for example, but that said, for every action, there's an equal and opposite reaction. And if the U.S. or China begins to take steps that would seem to destabilize the détente, that is going to upset the trade talks. They're not immune from it. But I do think that the economic team will be focused on the economic issues.
As you know, these are nuanced issues. They're important but nuanced issues. The broader, bigger issue, I think, is an argument that Secretary Besson has made repeatedly now. Kellyanne, and you've lived a lot of this. They want the Chinese economy to rebalance. And I've heard economists over the last decade repeat that repeatedly. They would like to see the Chinese economy rebalance towards domestic consumption. In your experience, why has that been so difficult to get the Chinese policymaker to do just that?
Yeah, well, the trade between our two countries is significant. China is one of the top trading partners for the United States. And I think part of what you're seeing the administration argue is the reason for this imbalance has a lot to do with Chinese industrial policy, unfair trading practices, excess capacity, and some of these practices that just don't comport with fair market principles. And so to get this relationship rebalanced, they're also looking for China to make concessions on some of these issues that are a key part of its own economic model, which is very different than the U.S. economic model. And so these are challenges they're going to have to wade through. And I've said before, and I'll say again, nothing's going to get resolved in weeks. This is going to be years and years and years of negotiation. And I think those comments are about directionally where are we going, as opposed to an objective goal that's going to happen next month.
Kellyanne, appreciate the update, the reaction from you. Kellyanne Shaw there, the former senior Trump trade advisor. That overcapacity built in China, exported to the rest of the world, you pointed it out earlier on this morning, might be a problem for China too.
Well, they actually are pushing back against this with BYD cutting prices dramatically, trying to increase some of the demand at a time where demand's falling off a cliff, prices are going down, and China's getting the perception that they sell cheap goods that tend to be of lower quality, and that's what the Chinese government doesn't want to have happen.
Not in a good place, hasn't been in a good place, that story. for quite a while. Up next on the program, we'll catch up with Francisco Blanch of Bank of America as the oil market awaits US-China trade news.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
7:30 stateside on the East Coast here in New York City. Equity futures positive by about 0.1% on the S&P 500. On the Nasdaq 100 this morning, totally unchanged. It's been that way over the last few hours or so. With 2 hours until the cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Some breaking news in the last hour. Warner Brothers will be splitting into two separate companies. Both of them are set to be publicly listed. It's going to do this by the middle of next year. On one side of the company, on one of the new companies, you're going to have its streaming and movie service. On the other side, you'll have its cable services, so things like CNN, for example. So shares moving 5%. Now, it's very volatile. They just opened after a trading halt, so around 5% higher. We'll watch this as it moves around. Now, to the downside, some other breaking news. This coming from reporting from the Wall Street Journal that Ken Moelis will be stepping down as CEO of Moelis. Only a little bit weaker on that news, down about 0.6%. of 1%. It is likely that he will become the chairman after that on October 1st. They'll have some restructuring after that with personnel. One of the co-presidents is set to become the CEO of Mola. So those are the moves there. Meanwhile, Tesla also continues to trade lower in the pre-market session. Had a really tough week last week, down 15%, down another 2 1/3 this morning. This time, the kicker coming from Baird, downgrading the stock. It did have an overweight. That now goes to neutral, saying that for one, too much optimism around things like robo-taxi is priced in. And on the other side of things, that spat between Musk and Trump, that just injects uncertainty into the stock, and therefore you can't be overweight on it. John.
Danny, thank you. That name's down 2%. We'll get back to that spat in just a second. On our radar this morning, US-China trade talks in London, with both sides focusing on cooling tensions. The Treasury Secretary, Scott Bessent, Commerce Secretary, Howard Lutnick, and the Trade Representative, Jameson Greer, all meeting with their Chinese counterparts.
The key question about the urgency here and how long they have before you start to see some of the ramifications of this tit-for-tat in some of the products that people buy. There were reports that a manufacturing line shut down as a result of a lack of products like the rare earth minerals that do come from China over the past few weeks. A real interest in whether we could see some of the shelves go bare ahead of the back-to-school shopping season, a question of whether we've avoided that or not. And I think that that's actually really key to keep parsing through in terms of the ramifications for the real economy as these talks do continue.
Personnel, key. I think we all noticed it. What is Lutnick doing there, the Commerce Secretary? We asked Kellyanne Shaw. Instantly responded and said export controls. Focus on that.
Yeah, and the idea that maybe it will require the U.S. backtracking from some of the export controls that have been put on, particularly with respect to semiconductors, in order to get China to export some of those rare earth minerals back to the U.S. so they can create some of those things like chips and phones and the like.
Anne-Marie on the ground, tracking some of those talks for us. We'll catch up with Anne-Marie in the next hour. I promise you an update on this. The Trump-Musk spat continuing. The president saying his former first buddy will face, quote, serious consequences if he funds Democrats who are running against Republicans who support his tax bill.
So this continues the tit-for-tat. You missed it, John. It was the explosion that stopped corporate America.
I was tracking it from a distance.
Yeah, you know, it's so funny. I heard all these reports about people who are trying to have serious corporate meetings, and somebody said, you know, did you see this X or did you see this truth? And all of a sudden, you know, that meeting ended. But it seems like there is this sort of tit for tat. Who has more leverage? It seems like President Trump had more leverage in this question of whether he could not expedite some of the regulatory frameworks for, say, autonomous driving. Right now, it's clear that the world's richest man also holds some leverage and that President Trump is a little concerned about what he could do with that stockpile of more than $300 billion of cash.
Can I just throw this out there? There was an element of this that felt somewhat manufactured last week. Did you not feel that way?
Some people speculated that this was Elon Musk trying to revive his image as politically independent and revive the image of Tesla. That was something that has been floated out there. But what did Dan Ives say? You don't burn the house down to meet the firefighter. So there was this element of how much is that valid? But you are correct. There is a speculation that maybe there is an element of perception.
Certainly elements of it felt that way in the last week or so. We'll return to this story, more on Tesla, in about 40 minutes' time. Want to get you an update on Apple. The Worldwide Developers Conference begins at 1 p.m. Eastern Time. The tech giant expected to unveil sweeping software changes and give updates about its struggling Apple Intelligence strategy.
I'm actually really interested in this, and not just because I bought a phone for a family member last night and saw what you could do with snapping for a long period of time and then identifying any particular item that you see out there, whether it be natural or whether it be a shoe.
You saw material improvement in the upgrade.
Yeah, if you can snap a picture and hold it down, and let's say someone loves your suit, they want to emulate Jonathan Farrow.
Can find out where to get it from.
They can figure out
Isn't
what
Pinterest
it is.
doing that already?
Well, okay, but it's more real time. If you want to figure out where this table was made or what product it is, you can snap that. You can do it with pretty much anything. There will be potentially other upgrades, and obviously you're not motivated to go out and buy a phone, so there is this question of what they can do at the WWDC that could potentially get you to want to buy a phone. It is important at a time where they have lagged behind the rest of the tech names. They're only up some 18, 19% since that April 8th nadir, so can they get some sort of sense that they are getting a competitive edge at a time where Samsung and others are already coming out with some new models?
The stock is down more than 18% so far in 2025. Typically, this is not the stock moving conference. not the stock moving event. Usually that's September and the unveil of the new iPhone, but this is the one, I think. It's about the software. It hasn't been about the hardware for quite a while, and the software updates just haven't been material enough to get people's attention.
The hardware, it's a phone. How much more can you do? It's going to zoom out and start going around your head? No, it's a phone. At this point, they have to give you some sort of application, aside from just writing your emails for you. They also can do that, which is actually kind of nice. So
you sound excited about recent developments then.
Well, I actually am curious to explore some of what it can do. I want to understand how much I can outsource my life to another object so that I can have more time. I actually deeply welcome that trend.
You and me both. We're up 0.6% in the pre-market. Let's turn to commodities. Oil steadying after last week's 4% rally. Francisco Blanch of Bank of America writing the following: the oil market is poised to remain oversupplied, and we believe Brent crude may average 62 a barrel for the balance of the year. Macro tensions also mean that oil prices could temporarily sink to $50 a barrel. Francisco joins us now for more. Francisco, good morning. Good to see you.
Good morning. Thanks for having me.
Start with OPEC Plus, because I think that's been the main event for the crude market over the last several months. What's policy now, and what's the strategy behind it?
So you could make a case that OPEC is trying three things at once, right? It's trying to increase market share. I think it's more of a Saudi thing. You could argue there's a discipline element to what Saudi's doing, because it's really driven by Saudi Arabia. And the third bit of it is well, why now? Clearly, lower oil prices can help offset some of the upside pressure of inflation on U.S. tariffs. So let's say it's Trump administration pressure to get those barrels in. So I think maybe the three of them are objectives. But what's important about the strategy is that we believe this is not a price war that is going to be short and steep. Rather, it's going to be a price war that is going to be long and shallow. And it's going to be long and shallow for a couple different reasons. First, because in 2024, Saudi became a net borrower for the first time, whereas the shale patch is actually in pretty rude health from a debt perspective. They don't really issue that much debt anymore, and they can flex their muscle up and down depending on where prices are. But the shale patch themselves have their own issues, right? Because the higher tariffs are also bringing up costs. Remember, oil is steel on the ground, and steel is 50% more expensive than it was at the beginning of the year. So margins are coming in. Lower oil prices, higher steel costs. We are seeing a big drop in the rig count, and that's exactly what Saudi is trying to do. They have the lowest market share they've had in a very long time, not just against non-OPEC, but also even within OPEC, Saudi has lost market share. They've done this price support already by themselves pretty much for 3+ years, right? Having this huge shale response. They're done with that. They need to get, it hasn't really worked. $85, $90 oil, 6 million barrels a day of exports, not working. I mean, you want to get maybe lower prices with just more barrels.
Can we sit on that price war just a little bit longer? Yeah. They tried this about 10 years ago. I forget whether it was November 14 or November 15. You remember the dates?
14.
14, yeah. Okay.
Very
November
vividly.
2014. It's there in the memory somewhere. What's different about what they did then compared to what they're doing now?
Well, back then, what they were doing, it was a much deeper price war, but it ended up lasting longer than they hoped. And part of it is that back then, again, the shale patch was very levered, so they had a lot of cash in the bank when they started the price war. And it was just at the beginning of shale, right? So we still have grown dramatically in the last 10 years. I mean, the U.S. has pretty much added 50% plus of the incremental oil and gas in the world for the last 15 years, right? So I think we are getting towards the end of the shale cycle, and tier 1 acreage is becoming more exhausted, and companies are pushing to tier 2 acreage, which is more expensive, and now you have these additional costs. So I think it's a different moment in time. And I, to be honest, I mean, I think, like I said, Saudis supported prices for a long time, and they've realized that just keeping them so high only means losing market share in the long run. So that's what's different. But also their own position is different. They want to build out the kingdom, and that's very important.
You talk about the war of attrition, and this idea that it's a long, drawn-out period of time where potentially you could see it at $60 a barrel. At $60 a barrel, could you see the shale patch become a lot more productive, where you see rigs that are permanently taken offline, and it really becomes that much less profitable because ultimately it is much more expensive to drill there than, say, over in Saudi Arabia?
I think that's exactly what's going on, right? I mean, I think we're going to see slowing production here for oil. And in some ways, it's already happening. If you look at the rig count, if you look at marginal cost of production, many companies are facing oil in the 50s, in maybe as high as $60 a barrel. And therefore, this price range doesn't make things particularly appealing. Now, having said all that, these companies are cash cows. They're paying out huge dividends to shareholders in a world where interest rates are also high, which is the other big difference. Back then, we had 0 rates. Today, we have 5% rates. And shale's not a cheap operation when money is not free.
Yeah, and I'm looking right now, and in 2023, the U.S. oil and gas industry contributed about 8% to the U.S. GDP. So this isn't exactly a small part of the overall economy in the United States. I am wondering on a broader scale, we haven't even talked about supply on the demand side and whether demand is going to materially drop off to sort of add to some of these price declines. Based on what we've seen in the price of oil, how much is tied to the idea that demand is just declining, especially as trade really falls off?
So demand held up pretty well in the first quarter. We had relatively cold weather. And also remember, the first quarter, there was a lot of pent-up consumption because people were trying to rush in the imports, right? So we had actually a pickup in global trade in the first quarter. We've had a slowdown, of course, in the last couple of months. We'll see what the negotiations between the U.S. and China and other countries end up looking like. But I do think that, you raised a great point. $60 oil is also going to help demand in the medium term, right? I mean, it just makes EVs less attractive. It makes a lot of energy sources less attractive. Remember, oil is the best energy source we got for a lot of reasons, right? In terms of its energy density, its flexibility, how easy it is to transport it, store it. And oil's cheap, $60 a barrel. I mean, it's $10 an MMBTU. It just, frankly, think about it, all the inflation we've had for the last 10 years, right? So I think that also will encourage consumption. And ultimately, what I think Saudi's trying to do is saying, well, we don't want to run around with so much spare capacity because it's expensive to maintain. And we're also changing the way we consume energy domestically, which means our demand locally will go down because now we're going to use a lot more renewables domestically. So all of that, you put it together and you say, well, we have to get going and get this spare capacity into the market. And that's, I think that's really the plan. So you get more consumption, release your spare capacity, and maybe oil just doesn't do a lot in the next year.
Let's finish on something that's got more expensive. Gold. Yeah. 33.20, up by more than 26% now for the year. What's the call from you and the team?
So we think there's been a bit of a double top in the first half of the year. So we think maybe second half, we need to see a real shock for prices to break away from where we are. And we have a $4,000 target, which we think may be a 2026 story. But if you look at the action in the precious metals, it's really coming from other areas. It's coming from platinum, which is really where things are starting to move in a big way. We've seen 1,200 hit this morning, and potentially we're going to go higher in platinum. We think platinum will trade well ahead of palladium, which is also being dragged along. And even silver. Silver is now 36 and change, and heading up to 40, we believe, right? So gold's had a good run. Now we're getting the rest of the precious metals. And then based on whether geopolitics and maybe the U.S. budget deficit situation worsens, then we'll have another leg up. But I think second half of the year might not be as great as the first has been for gold.
Francisco, appreciate the update. Thank you, sir. Francisco Blanch there of Bank of America. The depreciation of the U.S. dollar tracked not against other currencies, but against precious metals. That's where you've seen these vicious moves. Outside of gold, as Francisco suggests, to places like platinum, etc.
Yeah, this is the bet that maybe there is some alternative to the dollar looking to diversify, and it turns out it doesn't seem like the currency space is really providing that. I want to also just note this, following on what Francisco Blanch just said. Last week, the Baker Hughes crude oil rig count fell by another 9 rigs. It has fallen by 41 rigs in the past 6 weeks to the lowest level going back to October of 2021. Is this the goal, or is this just the side effect?
Honestly, reminds me of 10 years ago, we used to track the rig count on Fridays.
I remember that.
Yeah, good times. We come back to that, aren't we?
I don't know. I mean,
rig
I don't think it's
guesses.
quite.
Do you remember rig count guesses on Twitter at the time?
It was a big deal. And it was like the junk bond market imploding and all the oil rigs.
Very different times. All right.
Times.
Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. A U.S. trade team has extended its stay in India, signaling progress ahead of a July deadline for a tariff agreement. Sources say the team will now remain until Tuesday, tomorrow, to continue discussions originally scheduled for just 2 days last week. Negotiators are working on a phased trade deal, and we're told most of the issues may be finalized within a week. Meanwhile, Qualcomm is buying London-based semiconductor company Alphawave IP Group for about $2.4 billion cash. Alphawave makes high-speed semiconductor and connectivity technology that can be used for data centers and AI applications, two growth areas in the chip industry, of course, that are being driven by demand for products like OpenAI's ChatGPT. And the men's singles final at the French Open was one for the ages. After dropping the first two sets to world number one Jannik Sinner, defending champion Carlos Alcaraz survived 3 match points in the third set. Alcaraz stormed back to take the next 3 sets and win the tournament for the second straight year. The 5-hour and 29-minute match was the longest final ever in French Open history. And my eyes were glued to the screen. Dr. Bloomberg Brief. John?
Yahara, thank you. I don't know how you keep up that kind of intensity for more than 5 hours. I have to say, as a diehard Rafa fan, I never thought we'd get close to the kind of finals we saw between Rafa, Federer, Djokovic. These two, it's absolutely phenomenal. It's phenomenal.
What did they eat? I mean, seriously, how did they sort of regenerate during that period of time? 5 hours? That's like 2 meals and a walk and, you know, going shopping. I mean, just think about it.
I'm tired after 3 hours of this. Like 5 hours of that.
It's the same thing, you know.
Goodness. Oh, yeah, it's so similar. Up next on the program, heading back to record highs.
The equity market is basically back to a high. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now, we continuously use the word surprisingly. It's not surprising.
Up next, Wei Li of BlackRock from New York. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Equity futures just about positive on the S&P 500, up by close to 0.2%. The main event in London this morning, trade talks between the US and Chinese delegation. Kevin Hassett, the National Economic Council Director, speaking to a US broadcaster earlier on this morning, saying the meeting might be short but could bear results, expecting the Chinese to release minerals that the US needs, and the US to release export controls if China talks go well. So that's how the stage is set this morning.
Trying to take away some of the pressure at a time where both countries still very much intricately intertwined.
The Chinese officials just arriving at those talks. US officials will follow, I imagine, in the next few minutes or so. Under surveillance this morning, heading back towards all-time highs.
The equity market is basically back to a high. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now, and we continuously use the word surprisingly. It's not surprising. The economy's doing fine. The consumer's doing fine.
Here's the latest this morning. Equity strategists raising expectations for US stocks with the S&P 500 just 2.3% shy of all-time highs. Waitlist of BlackRock writing, we flipped back to being pro-risk in April once it became clear that hard economic rules limit how far US policy can move from the status quo. Waitlist joins us now for more. Wait, let's just get to those rules. What are those rules and what do they mean to you?
There are two immutable rules that we have identified that helped us govern risk-taking, even though there was a lot of uncertainty. Number one is if we're going to close trade deficit, then we cannot rely as much on foreign funding. So U.S. debt arithmetic is number one economic rule. The second economic rule is actually what you just talked about, this ongoing discussion around export control, around rare earths. It's really very much recognizing that if we're talking about rewiring global supply chains that took decades to build, we cannot do it from one day to the next. The grave consequences of trying to do that is not just higher inflation, but rather not having access to critical goods, not having stuff on the shelf. And these two immutable laws, economic rules, are the reason why we were able to put on more risk budget, even though back in the depths of April market lows, there was a huge amount of uncertainty in terms of policies.
Wait, it seems like people are getting more bullish on stocks and still uncertain about bonds, feeling like maybe the mutable economic law of supply chains and the desire to see companies continuing to be able to function with shelves that are full will trump just this idea of potentially some of the questions about inflation, as well as on the other side, that interconnectedness with the international investor. Does that remain the case, that as you've gotten more risk on, you've gotten more risk off with respect to bonds?
We have had this view for a while that we prefer U.S. equities, thinking the corporates a bit more exceptional versus U.S. long-duration government bonds. We have long argued that term premium needs to reprice to reflect the reality there is more persistent inflationary pressure because of structural forces, but also rising government debt that is expected to continue. So that being the case, we have seen some of that term premium repricing so far this year. But what's really abnormal is how low they were before, not the fact that they are starting to reprice, reflecting the fundamentals now. So currently, 10-year term premium is around 70 basis points. It went up as high as 90 basis points recently. We think that it could go to somewhere between 100 basis points, 125 basis points. So we definitely think that there is more to go. I would say, though, government bond and term premium repricing has been elevated to the level of Treasury losing safe haven status. That is too sensational in our view. The same applies for the dollar as well. You know, dollar repriced to fundamentals. It has been viewed as rich versus fundamentals for a while, but that repricing has been elevated to the level of dollar losing reserve currency status. I think that's too sensational. We have seen repricing to this type of magnitude in the past without their status being challenged. And in our view, right now, we're witnessing a fundamental repricing.
Well, as we get that repricing, just to finish, Lisa's question is an important one. Why don't you believe that your Treasury underweight compromises your pro-risk stance?
because in addition to R, which is a very important factor in terms of valuing risk assets, we also have to care about G, which is growth, because at the end of the day, risk assets is about discounting future cash flow. So R matters, but G matters just as much. And here the big picture is that growth is holding up just fine. You look at a very crude measure of Atlanta Fed nowcast GDP is somewhere between 3.7, 3.8%. You look at earnings, it's really holding up very well. At the beginning of this reporting season, consensus was looking at 8-9% year-on-year growth. We got 14%, right? Like corporate America, the micro story is very strong, which is why we believe risk assets can survive in an environment of high for longer in terms of rates.
And maybe even thrive. Maybe. We appreciate it. Wait leader of BlackRock, thank you. Up next on the program, Venu Krishna of Barclays, George Janarikis of Canaccord Genuity, Claudia Sam of New Century Advisors, and Michael Kushma of Morgan Stanley as we track the latest trade talks between the US and China out of London.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
short-term market risks are a little bit elevated.
As investors, we have to trade this market.
The equity market is basically back to a high.
The market is going to need good news to continue moving higher.
In terms of the U.S. equity outlook, that's going to be about the earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with the attention of financial markets worldwide on this scene right here in London. The Chinese trade delegation arriving just moments ago, looking for someone to step out of that car from the US side in just a couple of seconds' time, with the National Economic Council Director Kevin Hassett setting the stage really in the last 30 minutes or so, speaking to a US broadcaster, saying the meeting today could be short but will bear results.
Yeah, basically a handshake that has the Chinese and the U.S. sides coming together and saying, can we go back to that Switzerland moment where suddenly we're actually exporting rare earth minerals to the United States, and maybe some of the chip restrictions will get lifted from the U.S. side, and that's the reason maybe why Howard Lutnick is there. A real question about how quick this will be, how easy this will be, and whether this sets the stage to a bigger talk.
So in Geneva, it was setting the stage for talks. In London, we're setting the stage for talks? Or is this a material policy change? What is this? What's the ultimate goal?
A lot of people feel like this is removing the immediate pressure of key supply chain necessities that both sides needs ahead of additional talks, with President Trump promising to go over to Beijing to meet with Xi Jinping. A real question about the incentive on both sides to come to some sort of larger goal at a time where both sides have talked about strategic decoupling. Hard to understand what the framework actually could be, aside from let's not torpedo each other right now with our economies.
When this meeting was announced, it helped stocks. When the last meeting was announced, it helped stocks. Stocks have been helped to a rally of more than 20% off the April lows. Do you need more than just a meeting being announced to help stocks?
You know, Abby Yoder nailed it of JP Morgan when she came on earlier, and she said the longer this goes on, the more companies can adapt. The more companies can figure out how to ameliorate some of their supply chain kinks in order to get ahead of whatever may be announced. Time is important. Even if it gets delayed, that itself is important for people who are looking at what Wei Li was talking about, the economic immutable rule, which is no country wants to absolutely destroy their industry by torpedoing their supply chains by a quick trying to unravel a complete system that has been put in place over decades.
Anne-Marie, tracking these talks in London, she joins us now. AMH, how different are these talks in Britain's capital compared to what we saw take place in Geneva only a few weeks back?
Well, they're pretty much the same, right? We're basically going back to square one in those talks with Geneva and really solidifying what the group agreed upon, both delegations, even though there seems to be some miscommunication when it comes to rare earths and obviously China's frustration with the export controls the U.S. has put on. Kevin Hassett recently speaking to the American media, Jonathan, the NEC director, talking about the fact that after there is this handshake deal, he does expect the licensing for the rare earth and magnets that are really critical for things like mobile phones, the defense sector, the high-tech sector will be flowing back into the United States at an advanced pace. And then he had something else to say. Any export controls from the United States will be eased. This is where I have a lot of questions. What kind of export controls is Kevin Hassett talking about? Is it the more recent ones that we've seen since the Geneva talks, or ones that were put in place prior to Geneva, like the H20 NVIDIA chips? These are the questions and the details we are going to really want to make sure we understand coming out of these talks. Kevin Hassett saying it's going to be a handshake, but really the devil's going to be in the details.
And then what? And that's the important question, Anne-Marie. And then what? Where do they go from there once they've agreed to that? Which, let's face it, based on the comments from Kevin Hassett earlier on this morning, it looks like that's already been agreed to.
Right. This looks like it's been agreed to. And you kind of got a sense of that when the president put out his statement after Xi Jinping spoke with him on the phone. And we just saw Ambassador Greer there arriving at the talks, followed by Commerce Secretary Howard Lutnick. We should note he is a new addition to this, which is why everyone is focused on the export controls. It does look like the president is really putting that on the table with the addition of Howard Lutnick, part of the personnel in the delegation. Where do we go from here? Obviously, everyone everyone is speculating on a potential meeting in person between Xi Jinping and President Trump. President Trump said that this was discussed on the call. Maybe he would go to Beijing. There was also an offer for Xi Jinping to come to the United States. And then, of course, there's the question of whether or not there's going to be this grand bargain, a massive deal between China and the United States. When I caught up with the Treasury Secretary a few months ago and we talked about this high tariff rate on China and what the direction of travel was, and you can see Secretary Bessent there arriving now in central London for these talks. He's really the driving force behind this delegation. When I spoke to him, he said, we don't necessarily need to decouple. And he said, there's a grand deal to be had, but potentially, how long is that going to take?
Anne-Marie, stay close. The scene is set, and the individuals are in the right place at the right time to have those conversations. Anne-Marie, thank you. Just saw pictures there, live pictures from the City of London. In London, a conversation between the US and China. The Chinese delegation arriving about 20 minutes ago. The US delegation arriving just moments ago. The Trade Representative, Jameson Greer, alongside the Commerce Secretary, Howard Lutnick. And then at the very end there, the Treasury Secretary, Scott Bessent. And we're told going into these talks, they will be short, but they will bear results.
And this ultimately will probably have to do with the red lines on both sides. Anne-Marie nailed it, though, and she said the more interesting thing is which chip restrictions could potentially be lifted in the United States, given that this has been a bipartisan effort and long-lasting effort to try to not export the most advanced chips to China.
Equities rallied into the weekend on the announcement of the talks this morning, up by 1/10 or 0.2%. Let's keep it on Wall Street. Here's the view on Wall Street this morning. Stocks steady as traders await the latest round of trade talks. Venu Krishna of Barclays writing, we recently increased our year-end price target on the S&P to 60.50 from 5,900, expecting some valuation upside from clearing peak trade policy uncertainty while remaining wary around the tariff drag. Venu joins us now for more. Venu, good morning.
Good morning.
That peak uncertainty, it's behind us. That feels really stale to me now, and I've read that in so many different reports over the last week or so. How stale is that call now?
I think what it boils down to what you mean by peak uncertainty, and I think what we have got used to is when we were ratcheting up tariffs 100%, 150%, and more, that's really shook up the whole world, saying where is the end to this? Now, I think there's a general understanding that this is broadly a negotiating approach and that we will eventually settle at a level which is different than this, where it is unclear. So that's what I mean. So I think the market has got also, to some extent, I would say, desensitized to the daily gyrations in the numbers. But I think in our view, the reality is that tariffs are here to stay. The only thing we're debating is what's the magnitude and in what form is it actually unleashed onto markets.
Do we have a sense, though, of what the economic ramifications will be? Because right now we're seeing economic data that has been largely surprising to the upside. We saw non-farm payrolls demonstrate that the labor market is holding in. If it doesn't cause more damage in the economy, why aren't you even at a higher level when it comes to your S&P forward projection?
The reason is quite simple. In the beginning of the year, we were estimating the impact, but we were not actually including it in our estimates. Now, the reality is that it hasn't happened yet. It doesn't mean it won't. So companies are struggling. If you saw even after a very strong Q1 earnings, there's a lot of talk about raising prices, taking hit on margins, trying to put costs onto their supply chains, trying to continue to diversify away from China. And most importantly, you saw a massive pickup in inventories, which led to a Q1 negative growth rate in the US. So the point is, you're just not seen it yet. It's going to happen. In fact, it's an interesting question you asked. One of the things we did along with our upgrade recently is to provide investors a detailed grid by country, by base level of tariffs, and then trying to estimate the dollar impact on any combination you want to pick, right? And so right now, my estimate hasn't changed. We cut it down by almost $10 from the beginning of the year. All that is because of tariffs. And now it's the same, and we are assuming 30% incremental on China and 10% the rest of the world. It may not pan out that way, but that combination leads you to a hit. It's going to come.
What's fascinating to me is when we talk to people who come around this table, they acknowledge all of these things. They say the tariffs are here and you're going to see some sort of hit. You might also see a bit of an inflationary feel that will keep rates elevated. At the same time, it's not even about the real economy. It's about artificial intelligence. It's about the big tech players that have been driving all of this. Yeah. The narrow leadership's going to continue, and it almost doesn't matter. It's sort of the classic, the economy is not the stock market. How much can you get behind that?
I think we are behind that, absolutely. So one of the things I feel very comfortable, I think we talked about it in the past, is the strength of big tech, right? 6 stocks, ultimately, and we talked about it, the fulcrum of the market, they are continuing to power on. If you looked at this rate at which they beat their earnings, it was the highest in more than 3 years, which is what happened in Q1. And that was a sector which saw the biggest derating in the market. So I think the base of the market, which is almost tech is 40% of the market, is very solid. And the rest of the market is trying to grapple with tariffs with various levels of uncertainty, and you're going to feel that. So when you put everything together, I think growth is moderating, inflation is somewhat sticky, consumption also has been not the most robust, but relatively strong. But when you bring it all together, I think earnings are okay.
Do you think tech can behave defensively in an economic deceleration? Do you think tech stocks can behave defensively?
Depends the scale of deceleration. I think if you have a shallow recession, then tech will be fine. But if you have a deep recession, tech will not be immune.
All bets are
right?
off.
Yeah, I think the biggest thing with tech is not to do even earnings. I'm quite comfortable with their earnings, how they're going to deliver. It's a multiple you pay. It is the highest multiple universe within S&P. It's trading at around 27 times roughly. The rest of S&P is trading at a shade under 20. So it's a massive difference, partly explained by the strength and quality of their earnings growth. But to the extent that there's a catalyst for a derating, like we saw just in the last 2 months. I mean, tech derated by more than 30%. And nothing changed in terms of the earnings practically compared to the rest of the market. So, I'm more comfortable on their earnings, but I'm always wary about the multiple you pay for that.
Let's finish on the multiple. This has been a theme for us this morning. So the index is trading at 21 forward earnings on the S&P 500. How much confidence do you have that we can sustain an elevated multiple like that one?
I think you can sustain to the extent that earnings are relatively resilient, right? And the numbers we have, if we deliver, I think the market will bear that. More importantly, I think to your point earlier about it being stale, about tariff peak uncertainty, I think, and that's what we are doing, I'm looking past this year. I'm saying by the end of this year, on the tariff front, we will settle somewhere, right? Let's say 30-10. It is what it is, and companies are trying to deal with it. What will a normalized world look like in 2026, in which growth is reasonable but moderating, inflation somewhat sticky, consumption is okay but not as strong as before COVID, right? And that leads you to an earnings number, which by our estimate will be 9% up compared to this year. Consensus, of course, much higher than that, but that's relatively strong.
We might have a very distorted view of what normal is by the time we get to 2026. Do you know what normal is anymore?
Stop asking me difficult questions.
Baseline tariff at 10% now is normal.
No, nothing is normal. I don't understand how we can wrap our head around anything. We're having the X versus truth battle royale. It's the most expensive pay-per-view battle we've ever seen, and we have question marks about who friends are. I mean, normal, come on. Why ask these questions on a Monday morning?
2026 just feels like a lifetime away, although 2025 is rapidly passing us by. Yeah. It was good to see you. Thanks for the update.
Thank you.
Appreciate it, sir, as always. Venu Krishna there of Barclays. Equities on the S&P 500 positive here by 1/10%. The talks have started in London. The 2 delegations have arrived, both on the US and the Chinese side, and we'll be tracking those talks as they commence. And whenever we get updates, Anne-Marie's going to be on the ground for us, and we'll catch up with her again in about 30 minutes' time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara Anand. Hey, Yahara.
Hi, John. California Governor Gavin Newsom is ratcheting up his fight with President Trump. Newsom is now threatening to sue the administration over the deployment of the National Guard, calling it an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in the protests against immigration sweeps. Meanwhile, the world's largest retailer, Walmart, is making a renewed push into financial services. Sources telling us here at Bloomberg that Walmart's backed fintech firm OnePay picked Synchrony Financial to issue a co-branded card that can be used outside Walmart, as well as another available for purchases just at the retailer. They'll be available in the U.S. later this year. And a check on Warner Brothers Discovery. Shares are rising nearly 9% after it announced it's splitting itself into two publicly traded companies. It will turn its cable networks, including CNN, into one company. Meanwhile, its streaming and studio business into another. The move effectively undoes the Warner Media and Discovery Communications merger back in 2022. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Morning Calls, plus George Gianarikas of Canaccord Genuity on what's next for Tesla and the feud between Elon Musk and the president, Donald Trump. From New York City, this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Trade talks in London underway and in focus between the US and China. They've just commenced just moments ago, both delegations arriving. Going into the opening bell, equities looking like this. Futures positive by 1/10%, coming off 2 weeks of gains on the S&P 500, a 20% plus rally off the April low, and now just 2.3% shy of all-time highs. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Lulu to equal weight, expecting tariffs to weigh on margins through the first half of next year. Your second call from Citi, raising its price target on Broadcom to 285, citing the company's growth outlook for its AI business. That stock is up by about 1/10%. And your third and final call from Baird, downgrading Tesla to neutral, saying the feud between Elon Musk and President Trump adds, quote, considerable uncertainty. The name is down another 1.8% this morning. Let's stick with Tesla, the feud between the two leaders continuing. The president saying he has no intention of speaking to Musk after Thursday's public spat, which cost Tesla $153 billion in market value. Joining us now is George Gianarikas of Canaccord, who has a buy rating on the shares and a 303 price target. George, welcome back to the program, sir. Let's start with the feud. Ultimately, it got out of control last week. What does it mean for this company operationally and how this stock trades?
Well, look, Q1 was a little bit of a tricky quarter to discern how much Mr. Musk's political contributions have had an impact on company fundamentals. Q2, just based on the publicly available data, is not trending very well, but we try to look forward, right? And so there are three very, very important things for the company this year. Number one, it's promised a couple new vehicles. We'll see by the end of the year what they launch. Number two, they have a very, very, very important launch this week in Austin, Texas with Robotaxi. And number three, longer term, there's Optimus, the robots. And we'll have to wait a couple of years as to what the impact on the P&L is. But we try to focus on the fundamentals of the company. And, we're looking forward to understanding how these three catalysts can impact the stock.
Well, let's pick out one element, one dimension of that story then, the robo-taxi business. So I mentioned the downgrade that came from Ben Callow of Baird just moments ago, and it was more on the robo-taxi business. He said the Musk comments regarding the robo-taxi ramp rate are a bit too optimistic, and we believe this excitement has been priced into shares. So that's one opinion. I'd love to hear yours, George. What's your view on that side of the business?
Well, Ben is a good friend of mine and really smart. The way we look at autonomy is that it's, number one, incredibly important for the world and for our country. And if you look at what Tesla's trying to do, they have a singular approach to the market. They're using only cameras and they're using end-to-end AI. It's a different approach. And so this catalyst in June, this week, is incredibly important. But if you look 1 to 2 years out, there are only a few companies that will be successful in bringing robo-taxis to market or autonomy to market, in our opinion. That likely includes Tesla, likely includes Waymo, likely includes Aurora, a company that we cover that's focused on trucks, and it likely includes Mobileye. So these are incredibly important markets, not just for the world, but for our country. To the extent we need to compete against China, we need to make sure we have a flourishing autonomous market. And if you want to bet on a company in that space, well, Tesla's a very good bet, in our opinion.
George, one of the bull cases was that Musk's close relationship with Donald Trump would allow the regulatory framework to get this going faster, that you would end up with a quicker autonomous vehicle rollout than otherwise would happen. Now there's this question of whether that kind of rollout will be hampered by this ongoing feud. Why do you shrug that off as a possibility at a time where potentially that was something that's been floated by people close to the administration?
Yeah, I'd like to think that our country is beyond crony capitalism. And to the extent you think this is a very important market and a very important technology, which we certainly do, we have to look past that. And we need a set of federal rules that will make the glide path easier for companies trying to compete in the space. And that's what the administration has promised. I think it'll happen. And to the extent Tesla has a successful launch this week, which we think it will, it'll lead forward to multiple companies competing in the space that I just mentioned, whether it's Waymo, whether it's Mobileye empowering OEMs. And like I said, we need this technology for a more sustainable world, for the multiple benefits it will bring to our country.
You mentioned China and competing there, and that's an element of Tesla's story also that's been called into question, especially over the past couple of months, as there's been this race to the bottom when it comes to pricing of BYD and cars in China, electric vehicles in particular. How do you factor that into the outlook for a company that is sort of playing this fraught relationship in a very delicate dance?
Well, to be clear, like you said, China is incredibly important to Tesla. It's about a quarter of its sales, and they've been very successful there. This quarter, just the publicly available data suggests that the momentum might be stalling a little bit, but they have additional vehicles that they'll launch there. And like a very important point for our country and for Western markets is that if you look at it strategically, China is well ahead. And there are only a couple of companies that are successful in the West in making compelling EVs. That includes Tesla, that includes Rivian. And we need these markets to flourish in the West. So to the extent we need Tesla to be successful, we think they will be. They have an incredible tech advantage, regardless of what the Chinese have done, in our opinion. So we need this company to flourish, and we think it will. We're looking forward, right? They have a very compelling Model Y. They have other vehicles that they've promised. They have a potential scale advantage in autonomy because they'll be able to enable many of their vehicles with just a software upgrade. Just a software upgrade. And it's a singular company to that extent because the others need additional equipment. So if they're successful in that approach, they can enable millions of vehicles at the same time to become robo-taxis. It's pretty phenomenal.
George, appreciate the view and the opinion, the update from you this morning. Thank you, sir. George Enriquez there of Canaccord Genuity on Tesla and remaining constructive when others are downgrading the name.
Yeah, talking about the autonomous vehicle and the rollout of a robotaxi this week, it is going to be really important. And hopefully we can get to a place where you can call up a car for your kid or for your elder parent and not have to worry about them possibly driving because it might petrify.
Feels personal.
It just feels so deeply personal, the idea of being scared for your child or your elder parent and what are they going to do, and I don't want to have to drive them, and being able to sort of call up something that might be cheaper, reliable, get them somewhere is kind of an exciting idea.
Seen the Liberals are burning Waymos too now, not just Teslas.
Look, I think that a lot of people are looking at what's going on in Los Angeles.
You didn't have to respond to that. I was just throwing a grenade in there. I was just throwing a grenade in there.
Trying to like see what happens.
And then you took the bait.
Well, I mean, come on. Like, what do you expect from me? That's what this is. It's a talk show, you know? It's sort of you trying to get
back and forth.
Look, what am I supposed to say? Waymo's gone very. I just sit here quietly.
It's just a joke, all right? If you are tuning in for real news, all right? And that is real news, by the way. China and the US sitting down for talks. Those talks are underway in London. The delegations arrived about 30 minutes ago. And I have to say, based on the comments we've had from the administration, the White House already this morning, they've set the bar really low for these talks. Expectations are now like, this is going to happen. We're going to get some kind of agreement and move on from here.
And they're setting it low because what else can they accomplish? It's unclear exactly whether they want to get some sort of larger framework together. They just want to get their rare earth minerals. They just want to get their magnets. And on the other side, they just want to get their chips. And it sounds so easy, but these are the red lines. And so this really raises a question about how easy this will really be to cross this particular Rubicon.
These are the hard red lines, and this is just the beginning. We've had the Geneva round of talks. We've had the London round of talks. You'll have to pick another capital in a few months' time to continue this, that's for sure. Next on the programme, we'll catch up with Claudia Saab of New Century Advisors, looking ahead to a busy week of data, including CPI on Wednesday, PPI on Thursday. From New York, you're watching Bloomberg TV.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It is June 9th, April 8th. 2 months ago, they were the lows. 20% rally off the low since then on the S&P 500, 20% plus. And we had some more weight to it this morning, up another 0.2% on the S&P 500. With an hour, 60 minutes to go until the cash open. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Moving to the upside this morning, Warner Brothers Discovery announcing that they would be splitting into 2 different companies. One, its streaming service. The other one, its cable TV service. Those shares up 8.5%. The hope is unlock some of the value, some of the premium of their streaming offering, considering it's been hard to really post profitability numbers as more people migrate away from pay-for TV. So that's Warner Brothers Discovery. Also on the move this morning, Merck publishing the results of its cholesterol drug study, having positive results in 2 dual trials of its late-stage trial. Those shares up 2.3%. The hope is offer this drug that helps lower cholesterol to the same efficacy as an injection form of this drug. So some hope there. Finally, rounding things off this morning, some Bloomberg News exclusive reporting that Walmart has chosen Synchrony Financial to be a partner to issue its credit card. Now, it had used Capital One. Before that, it did use Synchrony. It's come back around to it for the first time since 2018. So those shares up 3%, but also just represents a doubling down of Walmart on their financial services offering, something that the traditional firms have been closely watching, John.
Danny, thanks for the update. Appreciate the hard work. 3 names plus 1 to look ahead to before the opening bell. Hitting the ground running this week off the back of the payrolls data on Friday. We're looking ahead to CPI and PPI data later this week. Mike McKee has more for you. Good morning, Mike.
Good morning, John. Well, we've got troops in L.A., we've got big talks going on in London, and everybody is asking the question on social media, when are the markets going to even notice? You were talking about how they keep going up. Perhaps Wednesday. CPI is going to be a big day for the markets. The first time when we're expected to see a real tariff impact. CPI expected to rise the first time in many months. And that is going to be something to watch closely, because then it's followed by PPI, also expected to rise. Is inflation actually on its way? We start today with the New York Fed's inflation expectation numbers. Going to be interesting because they have been much lower than the University of Michigan numbers, and the Fed's been pointing to that and saying, well, even if people are saying inflation is going to go up, we're still under control. Well, we get the Michigan numbers on Friday. And then looking ahead, we're going to set you up for the summer here. Coming up in 2 weeks, a little less than 2 weeks now, we've got the Fed meeting. They're not expected to do anything, but we get the new SEP and the new dot plot. Are they going to have any validity? June 24th, Jay Powell goes up to the Hill. Humphrey Hawkins' testimony. That will get a lot of attention. And then July 8th, the 90-day tariff pause ends. Another Fed meeting on July 30th. And August 10th, the China pause ends. So a lot of things that could affect the markets are still out there, even if so far everyone's sanguine.
It's quite a calendar, Mike, and thank you for bringing that to the program. It's a calendar that this Federal Reserve is at the mercy of. And I wonder, as we sit here in the blackout period, the quiet period ahead of that Fed decision on Wednesday, Mike, I wonder if we have a decent understanding of how they'd respond to upside surprises on CPI if we do get them in the coming months.
Well, it depends on how far and how fast it happens, John. If the CPI goes up, as it's expected to do by 0.1% this last month, then the Fed is going to say, okay, we expected that, and that's not a reason to do anything about interest rates, because we feel we're tight right now, and just where we are at the moment is enough to put pressure on inflation. But if it goes up 2-3 tenths or whatever by September, then they could be worried, and they could start hinting about rate increases.
Mike McKee with the latest. Mike, thank you. Let's focus on this story. Claudia Sam of New Century Advisors writing the following. As early signs emerge that tariffs will drive up prices, the Fed faces a crucial question. Will tariff-induced inflation be short-lived, or will it persist? Claudia joins us now for more. Claudia, welcome back. As always, we could spend some time with you talking about the U.S. economy right now. Let's get to that first line, that first piece of that sentence. As early signs emerge that tariffs will drive up prices, what are you focused on right now? Where do you see that at the moment?
Right. Well, the first place we're going to be looking for it, and we ought to see more of it this week, is in the goods prices. And that is both on consumer-facing prices, and we're also looking in the producer prices. I mean, we are tariffing intermediate goods as well, and that will eventually have some impact on consumer prices. So it's looking at the data, and again, as was said before, these magnitudes will matter, and how long we see this uptick in prices.
So, Claudia, that gets to the next question. Short-lived, or will it persist? How instructive is the labour market with that in mind? When we start to think about that, how much of a guide can we take from where the labour market is currently?
Right. Well, the labor market is important. It is holding up. We saw modest signs of cooling, but not a dramatic, weakening. When you talk to businesses, one of their first priorities when they think about pricing is consumer demand. I mean, it is the case the labor market holds up. It may be an opportunity for businesses to pass more of these tariff costs on to consumers in terms of prices. I mean, right now we have a cost shock for businesses, and it is an empirical question as to where it's going to end up. Is it going to end up with consumers paying higher prices? Is it going to be fewer workers with paychecks? Is it going to be less profits? And we are at the front edge of seeing how businesses are dealing with that really difficult question.
And Claudia, there's this lack of clarity around exactly whether this is a transitory, I hate to use that word, or short-lived inflationary move, or whether it has longer legs. There's also a lack of clarity around the labor market. On Friday, we got the jobs report that the headline numbers seem to suggest was still really robust and better than expected, an upside surprise. If you look under the hood, though, there are a number of analysts who are raising questions, especially with the downward revisions and some of the other modeling that points to maybe a weaker outlook. Where do you land on that, on this dual side of the mandate, when you take a look at the labor side of the equation?
We have an economy that's still largely at full employment. So a 4.2% unemployment rate. We have payroll gains, while not stellar, are still solid. It's, the question is, there are real signs of slowing, and we are seeing some modest slowing. It's not happening rapidly, and that's important. But the labor market, especially in terms of the Fed's thinking, they're close to their mandate. I mean, there is a reason why they're giving such focus to thinking through what's going to happen with inflation over the coming months, because largely they're in a good place on the labor market side. So yes, and I think it is important to understand that while the labor market has been resilient and things are looking like modest slowing, we don't have the same strength that we did, say, 2 years ago. We have much narrower job gains, like we're down to a few large sectors that are really pulling above their weight in terms of job gains. We have an unusually low hiring rate. Like, we're not set up to really be hit hard in terms of the labor market, but for right now, things are looking really pretty good.
Claudia, it sounds like you disagree with Andrew Hollenhorst, who came on and said that the Fed is fighting the wrong battle and that inflation is in a very different spot than it was last year or even 3 years ago when there was a lot more heat in the economy. He thinks that there isn't as much of a risk on the inflation side and that there is a more significant risk on the employment side. I'm just wondering if, let's say, this Federal Reserve took Donald Trump at his word, cut by a percentage point, would that lead to significant unmooring of inflation expectations and the potential for long-term yields to rise really considerably?
Well, the Fed listening to the president and doing what he says probably won't do good things for yields in general, but just thinking about that, like, could the Fed be cutting right now? So there is an argument to make, but remember, the context is so important. Inflation has been above the Fed's 2% target for 4 years. Right, and even a modest increase in inflation at this point is going to move us further from that. So I think there are good reasons, and we really did get burned by the persistence of the shocks. Even if this time we have smaller shocks to inflation, and I think that is likely the right call here, the persistence of it does risk embedding that we just aren't a 2% inflation economy, and the Fed does not want that to happen. So I think at this point, they can balance these risks and waiting and seeing the surge in inflation comes back down, which I think is, the textbook case. I think that's the most likely case, but the Fed is going to want to see it in the data, and I think that is appropriate at this point.
We get another read on Wednesday, again on Thursday. Claudia, appreciate your view as always. Claudia Sam there of New Century Advisors. Short-lived or short-lived? What are we going with?
Okay,
Chairman Powell goes with short-lived. It's short-lived, right?
In human talk
Short-lived.
in the United States, it's short-lived.
Why do they go with short-lived?
If you say short-lived, you sound either like you were educated in Britain or, you know.
We don't say that, do we?
What do you say?
I say short-lived.
You do?
Yeah, what's the short-lived about?
I don't know.
Do they say that? That's maybe. I don't know.
You don't know. You just came from there. You grew up there.
Lived here a decade.
Well, all I know is that didn't another Fed chair say short-lived? Didn't Bernanke say short-lived? And so it's sort of, you know, if you're a Fed chair, suddenly you start speaking weird.
There's a lot of takes out there at the moment. Here's one from Drew Madison MetLife. Worst case scenario for the Fed is a cycle where the Fed cuts and rates move higher, as that could lead to a QE restart, which could cause a further rise in yields. They need to wait this one out. So I've heard that a few times.
As far as QE, I'm going to put that aside for just a second, because that's a pretty big extrapolation. That is a fear. And that's what happened last year. And some people could say it was due to the belief of what a new Trump administration would do to inflation and growth. On the flip side, if they did cut rates and you did see long end yields go up, but that would be terrible on two sides. Number one, that would be restrictive, particularly to the mortgage market, the housing market that already is coming under some pressure. And two, it raises fundamental questions about their ability to control yields and how well they can actually bring inflation into control and whether they actually have the levers that they think they do. And those are two things they don't really want to happen.
Which I think is why Chairman Powell has made it very clear. In every single speech, every piece of communication we've had from the Federal Reserve Chair over the last several months, it's about pledging to anchor inflation expectations, which I think has offered a little bit of daylight between him and a certain governor, Chris Waller. Governor Waller, I think I've got a lot of sympathy, others too, with his view on things, that the labour market isn't tight enough to generate the kind of wage price spiral that would lead to the second round effects and much stickier inflation if we do indeed get the pass-through from the tariffs. So he can sit there and say, because of that, I'm going to look through the price pressure from tariffs, and if we do get the weakness in the labour market, I'm going to respond to it and cut interest rates.
And it's unfortunate that this is being portrayed as Chris Waller auditioning for the Fed chair and Jay Powell trying to thumb his nose at the president, because this is a real economic debate, and there are economists on Wall Street that fundamentally disagree on both sides with legitimate arguments. The problem is when you are in a dark room with a blindfold, with fog and lots of people around, and you're trying not to stub your toe, it is a very difficult equation, and that is basically what we're facing off with here.
People throwing grenades into the room.
Well, I hope not. Smoke bombs.
Bond yields right now, just about unchanged on 30s, on 10s at the moment, 450. The bond market just about unchanged. Yields were a little bit lower earlier on this morning, but no drama in fixed income at the moment. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Tropical storm Barbara is gaining strength off Mexico's Pacific coast and could become the first hurricane of the season. According to forecasters, the storm is expected to remain at sea for now, but heavy rainfall could trigger flooding and mudslides on Mexico's western coast. Meanwhile, President Donald Trump says Elon Musk will face, quote, very serious consequences if he funds Democratic candidates who challenge his big, beautiful tax bill. In a phone interview with NBC News, the president went on to say he has no interest in repairing his relationship with the Tesla CEO after their very public feud last week. And turning to sports, the NBA Finals are tied at 1-1 after the Oklahoma City Thunder beat the Indiana Pacers in Game 2. League MVP Shai Gilgeous-Alexander led all scorers with 34 points, while the Pacers couldn't overcome first-half offensive issues. The series now heads to Indianapolis for Game 3 on Wednesday evening. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. I love sports. I have absolutely no interest in this whatsoever.
Really?
I was kind of interested when the Knicks were in the running. Now, none at all.
Everyone hates the Pacers. That's the truth. I'm sorry. But it is cheaper to go there and get tickets.
Why do you hate the Pacers?
I don't hate the Pacers, but it seems like a lot of people really hate the Pacers.
Indiana or just the Pacers?
Just the Pacers. That's just my sense.
I just couldn't
Completely ignorant, though, so just throwing grenades, like you said.
Okay. All right. I mean, you know, I'm ignorant and...
and angry.
and angry at the basketball, apparently. All right. Up next on the programme, setting you up for the day ahead, plus Michael Kushner of Morgan Stanley on the latest Fed rate cut expectations. We'll catch up with Michael in just a moment. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Only on Bloomberg.
The opening bounce about 44 minutes away. Equities at the moment near session highs, which is positive about 0.2% on the S&P 500. As we count you down to the cash open, just a sneak peek of the week ahead. Today, the US and China resuming trade negotiations at 1 p.m. Eastern Time. Apple's Worldwide Developers Conference begins at 2 p.m. President Trump participating in an Invest America roundtable. On Wednesday, the data starts, CPI, Thursday, PPI, and another round of jobless claims, plus Tesla's robo-taxi launch in Texas. As we look ahead to that inflation data and a sprinkle of debt supply, Michael Kushner at Morgan Stanley joins us now for more. Michael, good morning to you.
Good morning.
Wednesday, Thursday, it's not just CPI, PPI, it's 10-year debt, 30-year supply. Are you nervous about that supply coming into the long end?
It's relentless. The size of the financing needs of the government just never stops. So it's not this week, it's the following week, following month. It just never stops. And the yield curve is steepening. There's lots of uncertainty about the future. It's not clear what the Fed can even do about it. I'm not sure if cutting rates would help the long end of the yield curve, given the current situation, given all the uncertainty which exists.
That said, there's been so much hand-wringing. I have to wonder whether positioning has gotten ahead of what is actually happening on the ground. And I thought it was instructive what happened on Friday. You got a sell-off on the heels of better-than-expected payrolls figures. And the biggest sell-off was at the front end, not the long end. Right. And what that indicated to me was that positioning was so short on the long end at this point that you try to get in on that now, good luck. How much is that sort of the story right now?
It's I think it's a big part of it. It's certainly a strong consensus view that the curve should steepen more, even though it's already very, very steep. If you look at the long-term history of 30-year Treasury yields, 5% is all the way back. You go to the 1990s before you see a yield much higher than 5% as a buy in that sense. Only for going back to the 1990s, I think that kind of world where the whole world has changed. There's inflation going on. There is uncertainty about fiscal policy. Real rates continue to rise, and fiscal policy in particular is a bit out of control in the sense that there's no expectation that it'll be reined in. The 30-year will stay cheap. It's a very good question. How cheap is it already, and how much bad news do you need to drive it even further?
Yeah, so we were discussing whether it was a short-lived inflationary or whether it was short-lived inflation. And Chris Nagy wrote in, and actually, I feel chastened. I was making fun of it, but I'm wrong, actually.
What is it?
It's short-lived, that as an adjectival, it's life. Long-lived assets, so that it's actually the proper way to say it.
Short-lived. Just doesn't sound right,
It sounds horrendous.
It might be grammatically correct, but honestly, I just, no.
That's basically what I'm saying, is absolutely not. I reject this. But if inflation is short-lived. If it's short-lived, do you get the sense that 30-year yields will rally, or is this actually something that you could see sustained, even if you have inflation that isn't as big of a concern?
Well, I think that's an important point, that we've seen the Fed sort of stuck between a rock and a hard place with regard to growth, employment, and inflation. We're waiting to see if they have a bias one way or the other. So if we see data still being sticky on inflation, I'm not a big bear on inflation, but it does seem very sticky, especially considering tariffs. So if it gets stuck, call it 3%, core CPI, and the unemployment starts ticking up, what does the Fed do? Does the Fed say, oh, I should cut rates? That's probably bad for the long end. On the other hand, if they don't cut rates, that's probably good for the long end. If they resist that temptation to protect the economy versus inflation, I think there's a very healthy debate at the Fed as to how you should respond to that.
It's important to understand what you've just said. You're saying that if they cut rates, mortgage rates might go up.
Correct. I'm not sure cutting rates in the current environment, the current information we have, is helpful. And sitting in our hands is probably a better strategy than doing something.
That's exactly what we heard from Drew Mattis of MetLife just moments ago. Same thing.
Yeah, a real question about whether we see a repeat, maybe for different reasons, of what happened last year. But then Drew took it a step further, that the Fed would counter that with QE, bond purchases, to try to lower long-term rates, which raises a question how much control they actually have and what the consequences of that are.
Help us answer that. How much control do they have over the long end?
I don't think a whole lot. I don't think they want to have 30-year treasuries on their balance sheet and interfere with the allocation of credit in terms of market pricing of risk. And I think that interfering with that just supports the idea that they're helping the government, the administration, support their agenda, and hurts the long-term inflation expectations.
There's always things to worry about. I worry about lots of things. Here's one. I don't worry so much about the long end selling off more, although that would be worrying. What I'm worried about right now is the fact that it's not rallying on weaker economic data. That last week the data wasn't tremendous. That yes, there was a headline beat and upside surprise on the headline number on NFP, but if you take last week's economic data in totality, and the Fed always talks about the totality of the economic data, hasn't been great. 30 years not rallying. How concerned should you be?
Well, I think the data hasn't been weak enough to justify a stronger view that recession's coming, and that even if the Fed cut rates, long-term rates come down because longer term the recession will drive down inflation regardless. I think that's kind of what the Fed is saying, that if unemployment rate goes up enough today, even if inflation goes up, if they don't cut rates, inflation will be below target in a year from now or 18 months from now. They don't want that either. So I think that the real reason for the Fed, the market, is that 30-year treasuries, why do I need to buy them? It's a niche market. Who are buyers of 30-year treasuries? Structurally, pension funds, insurance companies. If they're fully funded in most cases, or in the public sector, they can't buy 30-year treasuries because they're so underfunded they can't lock in those kind of yields. Who is the structural buyer of long-term treasuries when the government's issuing billions and billions on a regular basis?
Which is why so much more issuance is taking place now, closer to the front end.
Right, and hoping that inflation does come down and long-term rates do come down in the future, then you can move back out the yield curve.
Michael, good to catch up with you. Clinic, as always, Michael Cushman there of Morgan Stanley. The latest in fixed income. Looking ahead to CPI data, PPI data, and to Lisa's point repeatedly, also the bond supply on Wednesday and on Thursday.
A true test of exactly who that marginal buyer is at a time where you have seen some of these auctions get pretty messy. A question about whether the U.S. should sell fewer 30-year bonds, because if nobody wants them, maybe do what Japan is doing and just sell fewer of them, and that's going to be an ongoing conversation.
And kill the 20-year. Just sort of get rid of it. Right?
Spirit.
It's not worked out.
It's been a bad option.
20-year yields up this morning by a full basis point.
There you go, see?
That holds them. All right, let's give you an update on trade talks over in London. The US and China in the same room right now for another round of talks. This time in London, last time around in Geneva. On the ground, Bloomberg's Anne-Marie. Anne-Marie, we've got the officials in the right place. What's next?
Well, Jonathan, this really does just feel like a continuation of the negotiations we saw just a month ago in Geneva. And the contours of what we expect is that the U.S. is expecting more access to those rare earth and magnets, something we heard from the President of the United States after he got off that call with Xi Jinping. And then we heard from Kevin Hassett this morning, the NEC director, the clearest signal yet that export controls are on the table. Now, many people were speculating because we have Howard Lutnick, the Commerce Secretary, now joining Ambassador Greer and Secretary Bessent, part of this trade red line. Most recently, what we've seen with export controls is the U.S. going after chip design software, also jet engine parts. But then earlier in the year, we saw the Trump administration ban the H20 NVIDIA chip going to Beijing, something that NVIDIA developed to go to Beijing under the Biden administration. So what is the U.S. red line when it comes to export controls? And what does this mean for future export controls? Can they continue to use this as leverage? So that's really what we're looking out for in